Hello friends, today we are going to start with a new unit, Financial Reporting Analysis. In Financial Reporting Analysis, there are going to be 12 readings with a combined weightage of 13 to 17%. Before I proceed with FRA, I hope you have thoroughly revised corporate finance. So now, before I jump to my first reading, that is going to be inventories, let's first understand what we are going to learn in financial reporting analysis. So in this unit, you will basically learn that how the companies prepare their financial statements. Now when I use the word financial statements, it means the profit and loss account of the company, balance sheet of the company, cash flow statement of the company. So these three statements collectively are referred to as financial statement. So my first learning would be that how to prepare these financial statement. Second part would be how to analyze these financial statement. Now, for example, there's a company, Hindustan Unilever Limited. Now, how this company is performing in comparison to its peers such as Nestle, or how the company is performing over the years. Now I have to make an analysis with respect to the previous year. So this you are going to learn in this entire unit. Okay. Now what problem basically a student face? That in FRA the content is too much. Lot many formulas are there, lot many concepts, lots many rules are going to be learned. So what approach I'm going to follow specifically for FRA is that we are going to prepare proper handnotes in the class. That means our dependency on reference book would be relatively less, and we are going to practice lot many questions to have a better experience or a better learning of the concepts. Okay, so this is going to be the strategy, and on this note I'm going to start with my first reading, inventories. Okay, so now first point, that what do you mean by financial statements? Now financial statement means profit and loss account of the company or income statement. Second is balance sheet. Third is cash flow statement. Now collectively these three statements are known as financial statements. Okay, and now these financial statements are prepared in accordance with some rules. So those set of rules is known as IFRS, International Financial Reporting Standards. That means if any company is preparing the financial statements, that is going to be by following some set of rules, some set of standards, and those standards are known as IFRS. Okay, and IFRS is based upon some principles. Okay, that means now you need not to remember each and every rule. Before giving me any answer, just remember these three principles. Okay, so the first principle is matching. Second is accrual. Third is prudence. Fourth, consistent. Now these are the four pillars for IFRS, and before giving me any answer you have to keep in mind these four principles. Okay, now my point is, let us assume that you are a lawmaker. Okay, or let us assume that you're an investor and there are two companies. So one company is A. Here I'm writing time period and here are my profits. Okay, and the graph is like this. That means profits are continuously increasing over the last 5 years. On the other hand, there's company B with a profit and loss account graph like this, where this period is signifying that company incurred losses during these periods. Okay. Now my point is, company A or company B, both the companies collectively over the period of 5 years have earned 500 rupees. Company A 500 rupees over the period, company B 500 rupees over the period collectively. Assuming all other things to be constant, in which company you will prefer to invest your money? Company A or company B? Both of them are having the same products, same profits collectively over the period of 5 years, same management. Which company you are going to prefer? Now, you are going to prefer company A over company B. Now, why? So the simple answer is that volatility in the profits is less in case of company A, or company A profits are continuously increasing at a stable rate. They are more stable in comparison to B. That's why I want to invest in company A. That means investors dislike volatility. They don't like volatility. And now you are a lawmaker. You are going to prepare some set of rules. And those rules would be in such a way that they are going to reduce volatility or they are going to promote volatility. So ultimately, as a lawmaker, you are going to prepare rules in such a way that volatility in the financial statements is going to reduce. Okay. Now I give you one example. Now 1 point, rules would be framed in such a manner that volatility has to be reduced. Okay. Now one example is, today I incurred 2 expenditures. Okay. My first expenditure of the day is that I refill petrol in my car for ₹1,000, and second, I purchase a new car for ₹50 lakhs. Okay. Now there are 2 expenditure. One is the petrol expense, fuel cost. You have incurred 1,000 rupees. Second, today you have purchased a new car, 50 lakh rupees, for which you have incurred. So in both the cases, there has been an outflow. Okay. In first case, outflow is 1,000 rupees. In second case, the outflow is 50 lakh. But now my point is, when you incur this 1,000 rupees, okay, what is the feeling? Are you happy? Normal, that means it's my day-to-day expense. Indifferent, or you're feeling sad when you incur 1,000 rupees. So high probability is that you may be feeling normal, or maybe you're feeling sad. But one thing is very clear, that you're not feeling happy. But the moment you purchase a new car, the quantum of expense is way more, 1,000 versus 50 lakh. Now, how you're feeling in second case? Second case, I'm happy today. Despite you're incurring an expense, you're happy. Why? Now, important. That means expenses can be of 2 ways. One, revenue expense. One, revenue expense. And second is capital expenditure. Okay. Now, if the expenditure is going to provide you some economic benefits for more than one period, that will be termed as capital expenditure. It is an expenditure, but it's going to provide you economic benefits for more than one period. That is capital. Okay. If it belongs to that particular period only, that will be a revenue. Now, in both the case, there is an outflow. But the second case may give you some sort of advantages over the period. Now, let's assume that this car is purchased by a Ola driver. Okay. And now he is going to use this car for business purpose, and he estimates the life to be 5 years. So he purchased a car for 50 lakh. He assumes the life to be 5 years. Okay. And now my point is, I have incurred an expense. With the help of this expense, I'm going to generate revenue for the period of 5 years. Now my point is, two options. Number one, I directly put this 50 lakh as an expense in the current year. That means at the end of year 1. And for rest of the years, I'm going to charge 0 expense. So I put here 50 and then 0, 0, 0, 0. Option 2 is, since you're going to earn revenue for 5 years, let's divide this expense over the period 5 years. Each period 10 lakh rupees. Now important, in which case there's going to be less volatility. Option 2, option 1. Now if you compare option 1 versus option 2, in option 2 your profits are going to be relatively stable, or it's going to have less volatility in comparison to option 1. Now this principle is known as matching. First principle, matching. What is the meaning of matching? Match your expenses with respect to your revenue. Important. Now, meaning of matching. Match your expenses with respect to your revenue. Now, if this car is going to generate revenue for 5 years, then the expense of this car will be transferred to your profit and loss account over the period 5 years. And in this way, you're preparing your financial statements more stable. Now the question arises, sir, how we transfer this? So we transfer this in the form of depreciation. Okay, I don't want to emphasize more on the depreciation part as of now, because I'm having a complete reading on this. Okay, but eventually you purchase a car, 50 lakh. It will transfer to P&L account in the form of depreciation. Okay, now important. That means now we have to remember one line. Now that line is expenses are either expense or are either an expense or they are asset. And one day asset eventually has to be transferred to income statement in the form of expense. So expenses are either expense or an asset, and eventually one day asset has to be transferred to income statement in the form of expense. Now what is the meaning of this? Expenses can be of two types. One, revenue expenditure. One, capital expenditure. Now, what do you mean by capital? It is an expense. It is an expense which provide economic benefits. Economic benefits means helps in generating the revenue. It is an expense. It is an expense which provides economic benefits to the firm for more than one period. For more than one period. For example, bank, plant and machinery such as car. So this is a capital. Now, what do you mean by revenue expense? It is an expense which belongs to single period. For example, fuel cost or petrol cost ₹1,000. Okay, now point number 2, accounting treatment. First, you have to create an asset. First, you have to create an asset and eventually transfer to profit and loss account in the form of depreciation. First, you have to create an asset and eventually transfer to profit and loss account in the form of depreciation based upon matching concept. Now, for example, you buy a car for 50 lakh rupees. So, in your balance sheet, at time 0, 1, 2, 3, 4, 5, you will book a car for 50 lakh. Eventually it will reduce to 40, 30, 20, 10, 0. Now where this 10 lakh is going to? You are transferring this to your income statement as depreciation. So depreciation would be 10, 10, 10, 10 and 10. Every year you are going to book an expense of 10 lakh rupees each, and eventually the car which you have purchased for 50 lakh by the end of 5th year would be turned to 0. So this is the way. Now in this manner the volatility would be going to reduce in your profit and loss account. Now second point for revenue expense. They are directly transferred to profit and loss account. So this we will learn eventually how, but they are directly transferred to your profit and loss account. Now remember my tagline: expenses are either expense or an asset, and eventually one day asset will turn into an expense in the form of depreciation in case of fixed assets. Okay, now it was based upon a matching concept. So I've given you one example of matching, and matching eventually reduce the volatility in your profit and loss account. Okay, it was not relevant for this particular chapter anyways. Now, my second example, important. So, you have learned the meaning of matching. Now, my point is, let us assume there's a company, Eicher Motors. Okay, so there's a company, Eicher Motors, and this is their first year of operation, where they have manufactured in the first year, they have manufactured 10 bikes. Okay, and in the second year they have manufactured 0 bikes. Okay, this is with respect to the production, and sold in the first year they have sold 3 bikes. In the second year they have sold 7 bikes. So is it possible? Answer is yes. Where the manufacturing cost per bike is 10 rupee, and manufacturing cost is 9 rupee, and selling price per bike is 10 rupees. You have to prepare the profit and loss account of this company. Okay, profit and loss means how much profit the company has earned in year 1 and in year 2. Okay, now I'm giving you 2 options, but you don't know what is IFRS. Before giving me any answers, you have to keep in mind 4 principles. Out of this, we have discussed only one, that is matching. So as of now, only you have to remember matching concept. Match your expenses with respect to your revenue. Important. Now I'm giving you 2 options. Option A. Option A. Year 1, year 2. Sales. Now you have sold 3, so it should be 30, 70. Okay, now expense, and this is going to be your profit. Now one way is you manufacture 10 bikes, so you book an expense of 10 bikes in year 1. One bike is costing you 9 rupee, so book an expense of 90, and since you have booked 90 here, in year 2 it's going to be 0. So profit and loss account, for year 1 you incurred a loss of 60, and for year 2 you generated a profit of 70. Option A. Where in option A you have booked the in totality of manufactured 9 bikes, you book this in year 1 itself. Option 2. One, 2. Sales is going to remain same, 30, 70, and expenses, since you have sold only 3, so book an expense for 3 bikes. So 3, 9 multiplied by 3, 27, and here you have sold 7, so 9 into 7, that is going to be 63. Profits 3 and profits 7. Now my point is, which option is going to be followed under IFRS? Option A, option B. Now important. Collectively, the profits under option A is 10, option B is 10. So profit in both the cases is going to be 10 collectively. Now which method shall I follow? Option A, option B. Where volatility is less? Answer is then option B. Now option B is based upon which principle? Option B is based upon the principle of matching. I understand that you have manufactured 10 bikes. I am least bothered with this expense. How much you have sold? Now you have sold only 3 bikes. So only this 3 will be transferred to your profit and loss account. Now the question arises, but I have spent 90. What will happen to that 63? That 63 is going to create as an asset with the name inventories, and whenever you're going to liquidate that, your asset will become 0, and this will be transferred to your profit and loss account. Okay, so again, based upon matching, it has to be option B. What was matching? Match your expense with respect to your revenue. Now you have sold only 3 bikes. If you have sold only 3 bikes, an expense of 3 bikes has to be transferred to your profit and loss account. Now what will happen to that 7? We are going to create an asset by the name inventories. And whenever you are going to sold that particular 7 units, that will be transferred from inventories to your profit and loss account. Okay, now I'm going to start with important. So how the accounting treatment will work? I understand in totality you have spent in year 1, the company has spent ₹90. ₹90. This 90 has 2 parts. Okay. One, the goods that has been sold. So goods worth 27 has been sold. This would be transferred to your income statement, profit and loss account as cost of goods sold. And remaining inventories of ₹63 is going to be transferred to your balance sheet as inventories. Okay, so this is for year 1. Expense is an expense or an asset, and eventually asset has to be transferred to your income statement. In this case now what will happen in year 2? In year 2, you have liquidated or you have sold remaining 7 bikes. Inventories at the end of year 2 will become 0, and this will transfer to your income statement as cost of goods sold as 63. Now important. Expense is an expense or an asset, and eventually asset has to be transferred to your income statement, and in case of inventories in the form of COGS, based upon which principle? Based upon the principle of matching, where the meaning of matching is match your expenses with respect to your revenue. You have sold 3 bikes, expense only for 3 bikes is going to be transferred to your income statement. Okay, I hope I'm clear with this, the matching concept. Now I'm going to create a format for income statement, like how a company prepares its income statement. So what is the relevance of income statement? Income statement help us to know what is the profit earned or losses incurred by the company during a period. Now this period could be anything. Now let's talk, we are talking about a year. So my financial year starts from 1st April, it's end on 31st March. During this particular year, how much profit that company has earned. So this is the relevance of this particular statement. Now the format of income statement. Started with sales minus cost of goods sold. Abbreviation is COGS. Abbreviation is COGS. It is also known as cost of sales. So I'm left with gross profit minus other operating expenses Now the resultant value would be EBITDA. The full form is earnings before interest, taxation, depreciation and amortization. Minus depreciation, amortization, I'm left with EBIT minus interest, EBT minus taxation, this is EAT. Okay, so we started with sales and eventually we come to EAT. Now let's understand each of them, each of the particulars. Now what do you mean by EAT? These are the profits which belongs to the equity holder, equity shareholder. These are the profits which has been given to government. So taxation belongs to government. Interest belongs to debt holder. Depreciation is a non-cash expense. So what is the meaning of amortization? As of now, please ignore. Now what is the meaning of depreciation? Depreciation is a sort of non-cash expense. Non-cash expense. Okay. Now three stuffs. Sales. This is the revenue the company has generated from selling the goods. Then two important words, COGS and other operating expense. These are the important ones. COGS is also known as product cost or direct expenses. On the other hand, other operating expenses are known as period cost or indirect expenses. Okay, so now in my next part I'm going to discuss what is the difference between product and period cost. So it's important from the point of view of this particular chapter. Okay, now before I proceed, a quick revision. We started off what is the meaning of financial statements. So as of now, collectively three statements: income statement, balance sheet, cash flow. These three statements collectively are referred to as financial statement. What we are going to learn in FRA, how to prepare these financial statements and how to analyze as an analyst. So analysis part and preparation part. Okay. Now I understand these financial statements are prepared in accordance with IFRS, and IFRS is based upon four pillars. Those four pillars are matching, prudence, accrual, consistent. Where I'm only familiar with the meaning of matching. The meaning of matching is you have to match your expense with respect to your revenue. Eventually it will help to reduce the volatility into your financial statements. First example, if you purchase some plant and machinery such as car, it will eventually transfer to the profit and loss account over the period of the life in the form of depreciation. It is one example of matching. Second example of matching was you manufacture 10 bikes, out of which you have sold only 3. So this 3 will be transferred to income statement. Remaining we are going to create an asset as inventories, and this inventories when liquidated will be transferred to your income. It is again based upon matching, and eventually matching helps to reduce volatility into our financial statements. Okay, then what do you mean by EAT? Earning after taxation. These are the profits that belongs to the equity holder. Taxation. These are the profits which has been paid to government. Interest, the expense which belongs to the debt holder. Depreciation is a non-cash expense, And sales means the revenue from selling the goods and by rendering the services. Now I'm just left with what do you mean by period and what do you mean by product cost. Important. Now I give you a set of examples and you have to say whether it's a direct or indirect. I have not given you any sort of definition, but you have to make some guesses whether it's going to be a direct or an indirect expense. Okay. Now an expense like raw material, labor, power, electricity, freight inward, freight outward, insurance, storage cost, like these expenses, whether they are direct or an indirect one. So now let's understand what is the meaning of direct first. So meaning of direct or product cost is these are those expenses which are incurred to manufacture the goods. So these are those expenses which are incurred to manufacture the goods. And what is the meaning of indirect? Indirect expenses are other than the direct one. Now first you have to identify which one is direct and which one is indirect. Now raw material. Is raw material required to manufacture the goods? Yes. So raw material is a direct one. So here I am writing direct. Here I am writing indirect. Raw material, direct. Correct. Now there are two expenses. One labor and one employee cost. Now let's assume that there's a company like Hindustan Unilever. So this company is basically into the manufacturing of FMCG, for example, toothpaste. Okay. Now they have one factory where they manufacture the goods, and their CEO and the other staffs, admin staffs, sits in their corporate office in Mumbai. Now my point is CEO, CFO and the other admin staff, are they in a way involved in manufacturing the goods? No, they are not working in the factory. On the other hand, whatever the staff there is in the factory, working in the factory, from accounting purpose, it will be termed as labor. And those who are working in office, corporate office, they would be termed as employee. Now, important. Labor, direct, indirect, where the meaning of direct is involved in cost incurred to manufacture the goods. So labor is a direct one. So simple, belongs to the factory, belongs to an office. Factory, direct. Okay. Employee, indirect. Same wise, there are two expenses. One is power, another one is electricity. So power expense of factory is known as power cost. Power expense of an office is known as electricity. Which one is direct? Which one is indirect? So power is direct. Electricity is indirect. Class, this is an important one. Okay. Now, next expense is freight inward. Freight inward and freight outward. Which one is direct? Which one is indirect? What is the meaning of freight inward? Now, let's assume that I'm in the business of manufacturing this calculator, and this panel is outsourced. Okay. Now this panel is coming to my factory. I pay some sort of transportation cost. Until this panel does not reach my factory, this calculator cannot be completed. So I purchase this, and now this is coming to my factory. Freight inward. Inward means the transportation cost of those items, of those inputs that are reaching to my factory. Freight inward. Freight outward means once the manufacturing is complete, now I have to send this to my distributors. To transportation cost incurred to send this complete product to the distributors. Freight outward. Outward means moving out of factory. Which one is direct? which one is indirect. Until the panel does not reach the factory, the manufacturing cannot be completed. That means freight inward is direct, freight inward is direct, and freight outward is indirect. Why outward is indirect? Because that has been incurred post manufacturing. Same wise, storage or warehousing cost of input is direct. Storage of finished goods is indirect. Normal waste, day-to-day waste is direct. Abnormal waste is indirect. Now the question arises, so what is the significance of direct, indirect? Now the important significance is important. The direct expense, let us assume that the summation works out to be 1000, you manufacture 10 bikes. Now the direct expenses has to be bifurcated. For example, you have spent 1000 rupees. This has to be bifurcated between COGS and inventory based upon how much unit you have sold. Now for example, in totality I have incurred a direct expense of 1000 rupees. I manufactured during the period 10 bikes. Okay, now this cost has to be bifurcated between COGS and inventories. Now assume that you have sold 3 bikes. So inventory would be 7. So in this ratio, this cost has to be bifurcated, where COGS is going to be 300 and inventory is going to be 700. On the other hand, indirect expenses are not bifurcated. They are directly transferred to your profit and loss account. Now, what are the other sort of indirect expenses? Selling expense, admin expense, all this would be the part of indirect expense. So simple, you have to understand whether this expense belongs to the factory, whether this expense is with respect to the manufacturing of goods, then it's a direct one. And direct expense would always be bifurcated between COGS and inventory. On the other hand, indirect expense need not to be bifurcated. They are directly transferred to your profit and loss account. So important. Difference between direct and indirect. What do you mean by direct expense? It is the cost incurred to manufacture the final product. It is the cost incurred to manufacture the final product. Indirect expenses. All expenses other than direct. ठीक है? For example, raw material, labor, power, factory rent, freight inward, storage of inputs, normal waste. All these examples of direct. Indirect, for example, electricity, electricity, employee cost, freight outward, storage of finished goods, abnormal waste, selling expenses, advertisement expenses, admin expenses, office rent, now these are the examples of indirect one. Now what is the significance? Third, direct expense incurred during the year has to be divided between COGS and inventories. Based upon matching concept, indirect expense directly transferred to income statement as other operating expenses. Okay, important point. Direct expense is also known as product cost, and indirect expense is also known as period cost. Okay, now let's do one example. Example: raw material 1000, labor 700, employee cost 1700, normal waste 300, abnormal waste 400, now identify direct cost and indirect cost, bifurcate or divide direct cost into COGS and inventories, assuming company or firm has manufactured 10 units, out of which 7 has been sold. Okay, so identify direct, indirect, direct expense, direct, indirect expense, direct expense, indirect expense. So summation of direct is going to be 1000, 1700, 2000. Now this 2000 has been incurred to manufacture 10 units. So per unit cost is 200 rupees. Bifurcate. COGS inventory. COGS is 7, inventory is 3. So this is going to be 1400 and 600. Indirect expenses summation 1700, 421. Directly transfer to your income statement in the form of other operating expense. Okay, so friends, with this we have covered our LOS 1. Okay, where they have talked about period and product cost. Okay, so now I move to the next LOS, a quick revision. Important. Okay, now important one. What do you mean by financial reporting analysis, or what do you mean by financial statements? 3 statements, that is income statement, balance sheet, cash flow, collectively known as financial statements. These are prepared in accordance with IFRS. IFRS is based upon 4 pillars. Prudence, matching, accrual, consistent. Where the meaning of matching is you have to match your expense with respect to your revenue, and this helps in eventually to reduce volatility into your income statement. First example of matching. For example, you have purchased one car having a life of 5 years. It will transfer to income statement over the period of 5 in the form of depreciation. Same wise, let us assume that you have manufactured 10 bikes. You have sold 3. So based upon matching, only the expense for 3 bikes will be transferred to your income statement, and remaining 7 you are going to create inventory. This inventory will transfer to income statement only when this inventory has been liquidated. Okay, now what is the significance of direct, indirect? Direct expense would always be bifurcated between COGS, inventories, based upon the ratio goods sold and goods in the goods lying as inventory. On the other hand, indirect would directly be transferred to your income statement. Okay, so friends, this was my LOS A 1. Now I'm proceeding to my second LOS. So my second LOS is with respect to inventory cost flow methods. Inventory cost flow methods. So there are going to be 3 methods in which we can compute our inventory balances. Number 1, FIFO, first in, first out. LIFO, last in, first out. And then weighted average. Okay. So there can be 3 methods using which we can find out COGS and inventories. Okay. Now let's understand with the help of example. Now there's a company which manufactures first 2 units at a cost 2 rupees per unit, manufacture 3 units at a cost 3 rupees per unit, and manufacture 4 units at a cost 4 rupees per unit. So let's about we are creating a P&L for the year, and during this year company manufactured 2 units at the cost 2 per unit, 3 units at the cost 3, and 4 units at the cost 4. That means collectively company during the year has spent 4, 9, 16. Summation is 29 rupees. Okay. And now company says I have spent 29 rupees and while spending 29, they have manufactured 9 units. Okay. Now company says, out of this 9 units, during the year we have been able to sold only 7 units sold and 2 units is in inventory. Now you have to find out the value of COGS and inventory. There could be 3 methods: FIFO, LIFO and weighted average. With the meaning of FIFO, first in first out, means the goods that has been manufactured first sold first. So collectively you have sold 7 units. Goods manufactured first sold first. I have sold 7 units. So 7 units means 2 units from lot 1, 3 units from lot 2 and remaining 2 units from lot 3. Okay, I have sold 7 units. From first lot, 2 into 2. From second lot, 3 into 3. And from the third lot, I am left with 2 units. From the third lot, I have sold 2 units at the rate 4. So what should be my COGS? Cost of goods sold? 4, 9, 8. Answer should be 12, 21. And inventory? Inventory, the ones remaining, that has to be from the last lot. And I am left with 2 units at the rate 4. Answer is 8. So simply you are bifurcating 29 rupees. Out of that 29 rupees, 21 is your COGS and 8 is your inventory. So this calculation is based upon which method? Based upon the method FIFO. Company is using FIFO method. That means goods manufactured first, company has assumed that good has been liquidated first. So using the FIFO method, my answer is 21 and 8. Now let us assume that company is using weighted average. During the period you have manufactured 29, you have spent 29 rupees and you have manufactured 9 units. So approximately per unit have cost you 3.22 per unit. Now bifurcation, COGS 7 units, inventory 2 units, multiply by 3.22 multiply by 3.22. If I solve, my COGS is going to be 22.56 and inventory is going to be 6.44. So this was the method, this was the values using weighted average method. We compute the weighted average cost first and then we bifurcate this between COGS and inventory. Now my third method. Third method is LIFO. Now LIFO means the goods which has been manufactured late or which has been manufactured last has been liquidated first. Okay, so 2 into 2, 3 into 3, 4 into 4. Goods manufactured first, manufactured last, liquidated first. Now you have sold 7 units. So you have sold 7. Now first would be from lot number 3rd, then from lot number 2nd. 4 into 4, 16, 3 into 3, 9. So collectively 7. And now I am left with 2 units. That 2 units would be from the first lot, that is 2 into 2, 4. This is going to be 25. Again simply I'm bifurcating 29. So 25 is going to be COGS and 4 is going to be inventory. Now there can be three methods in which company can find out these values. One, FIFO, LIFO, weighted average, where the meaning of FIFO is goods manufactured first, liquidated first. LIFO means goods manufactured last, liquidated first. And weighted average means the answers would be based upon weighted cost. So now if I make up a conclusion, it's an important one. So three methods: FIFO, weighted average, and LIFO. Particulars. So one was your COGS and second inventory, and in all the three cases your summation should be 29. So 25, 4. In case of weighted average, answer is 22.56. 6.44, and in case of FIFO, answer is 21 and 8. Now some analysis. So important. Your answer is coming out to be 21 in case of FIFO and 25 in case of LIFO. Okay, and your inventory is coming out to be 4 in case of LIFO and 8 in case of FIFO. Now important point is answer your values. This is an important point. Values under weighted average method would always be in between FIFO and LIFO. Be it be inventory, be it be COGS, values would always be in between. This is point number 1, conclusion number 1. Now my point is, okay, so before we make some further conclusions, let's practice some question on this. Okay, then I'm going to move to the analysis part. Okay, so I hope now you're familiar with that there are three methods to bifurcate. One, FIFO, LIFO, weighted average. And now I'm solving some examples to have a better understanding of the concept. Then I'm moving to the analysis part. But one analysis that we made, that answer under weighted average method would always be in between FIFO and LIFO. Okay, so now let's solve some questions. So now question number 1. Inventory cost least likely to include which of the following? That means which of the following is period cost? Production related storage, that means storage of inputs? No. Cost incurred as a result of normal waste, again this is a part of production. Transportation cost of shipping goods to customers, this is nothing but freight outward. Answer is C. Next, a company uses IFRS. It purchased inventory for rupees itna and spent 5 million for storage prior to selling the goods. The amount it charged to inventory expense was closest to. Okay, so what's happening in question number 2? So you purchase one product. Your company is basically a trading company. Trading company means you purchase ready-made goods and then sold to some other person. So you are basically into a trading activity. Now you purchase the goods for 100 million and then you sold this goods. But before selling this goods, you incurred some storage expense of 5 million. Okay, now my point is, the storage that you are spending, is it over storage of inputs or storage of finished goods? Are you manufacturing anything? No. That means this 5 million that you have spent over storage, this is nothing but storage of finished goods. Now question is asking, what is my COGS? Two options, 100, 105. Now this 5 is storage of finished goods. Storage of finished goods is going to be your period cost. If it is period cost, then it's not going to club under COGS. Now my point is, what is your COGS? So my COGS is B. Okay. The amount it charged to inventory expense. Inventory expense is nothing but COGS. That is going to be 100 rupee. Now we have to solve question number 13. Company started its operation in 2017 and uses weighted average cost method. Okay. During 2017, it purchases 45,000 of inventory, 45,000 units of inventory at 10 rupee and sold 40 units for 20. In 2018, it again purchases 50,000 units at 11 and sold 45. Its 2018 cost of sales. Cost of sales means cost of goods sold is going to be. So question number 13, important. You started your business in 2017. So what happened in 2017? You purchased 45,000 units at a rate 10, out of which you have sold 40,000. So now you are left with 5,000 unit at the rate 10. So now 2018. So now in 2018, what is the opening value of inventory? Now opening value of inventory is going to be which remained unsold in the previous year, that is 5,000 units with a rate of 10. And then again in 2018 you purchased 50,000 at the rate 11 each. Now finally you are having how much? Now you are having in totality 55,000 units. Total rate, this is going to be 50,000, 5,50,000. Now collectively you are having a goods worth 66 lakh rupees, and in totality you are having 55,000 units. What is going to be per unit rate? 6 lakh divided by 55,000. So now this value is 10.909. Okay. So this is your total value of inventory for 2018. Now out of this 55, you have sold 45. So now I have to bifurcate this. You have sold 45,000. So this is going to be your COGS, and 10,000 is going to be your inventory, where per unit cost is 10.909 multiply by 10.909. My answer is, so this should be 49,090.9, and this should be 1,09,091. So question is, what is your COGS in thousands? So my COGS in thousands, so divide this by 1000, so 490.909, rounded off, this would be 491. So what is your COGS in thousands closest to? Answer is B. So class, you have to prepare. Now, how we find out the final value? First, what was the opening balance? In my case, opening balance was 5,000 unit at the rate 10. Then I purchased 50,000 unit more at a rate 11. Now this is known as goods available for sale. In totality, I am having 55,000 units available for sale, and for this 55,000 I have spent 6 lakh. I am using weighted average cost method. Weighted average cost method now signify what is your average cost per unit. Now my average cost per unit is 11 rupees approximate. Now I have sold 45. Now this 45 has to be transferred to your COGS, and I am left with 10,000. So what is the schedule? How we prepare the schedule? First, opening value plus goods purchased or goods manufactured during the period. This is known as goods available for sale. Now this available for sale has to be bifurcated between COGS and inventory. So my answer for question number 13 is B. Now important. Question number 14. Same one. Started business in 2017. You are using FIFO method. During 17 purchased 45,000 at 10. Then you have sold 40. In 2018 again purchased 50. You have sold 45. You have to find out ending inventory balance. So in 13 you have to find out cost of sales. In this you have to find out inventory balance, and company is using which method? Company is using the FIFO method. 14. Now I'm solving 14. So 2017 you purchased, this is unit rate, so you purchase 45,000 at 10, out of which you have sold 40,000. I'm left with 5,000 unit at 10 rupees. This is my closing inventory. Now 2018 opening inventory. Opening inventory is going to be 5,000 unit, 10 rupees. That means in totality I'm having 50,000 worth inventory. You purchase 50,000. You purchase 50,000 at the rate 11. That means now I'm having 55,000 units available for sale, representing inventory worth 6 lakh rupees. But now you are using FIFO method. Okay, so bifurcation. FIFO, COGS, inventory, you are using FIFO method. You have sold 45,000 unit. So inventory is going to be 10,000. Now COGS, goods manufactured first, liquidated first. So 5,000 at a rate 10, in totality 45, so 40,000 at a rate 11. Now I'm left with 10,000. This 10,000 has to be from the last lot. Last lot has been manufactured at 11. So if you solve, I have to find out inventory only. So my answer should be 1,10,000. So answer in terms of thousands is going to be 110. So my answer for 14 is C. Now I'm giving you one more example. Let's just assume that you manufactured 4 units. So you manufactured 4 units at 7 rupee per unit, 10 units at 13 rupees per unit, and 19 units at a rate 21 rupee per unit. Okay, so collectively you have manufactured how much? 4 plus 10, 14 plus 19. So you manufactured 33 units. And how much you have spent? This is going to be 7 into 4, 28, 130, 21 into 19, that is 399. So collectively you have spent 557. Now question says sold 20, inventory is 13. You have to bifurcate between COGS inventory based upon 3 methods. Now FIFO, weighted average, and LIFO. So COGS inventory, COGS inventory, COGS inventory. Okay, now before we start whether our answer is correct or incorrect, the summation in all of the 3 cases has to be 557. So this is a hint. Now first start with the simpler one, that is weighted average. Now my weighted average cost is 557 divided by 33. 557 divided by 33. I have sold 20, inventory is 13. So answer is 338 219. Okay, now if I make up the summation, answer is 557. Now FIFO, goods manufactured first, liquidated first. In totality I have sold 20. So 20 means 4 would be from first lot, 10 would be from second lot, collectively 14. Total has to be 20. That means from third lot how much? From third lot I have sold 6 units. This is my assumption. Now 4 into 7, that is 28. Then 10 into 13, 130. And finally it has to be 6 into 21. So 6 into 21, this is 126. Summation is 284. And how much inventory I'm left with? So out of the third lot I have sold 6. I'm left with 13 units. That 13 units at a rate 21. $273. Now make up the summation. Answer should be 557. Answer is correct. Now LIFO, goods manufactured last, liquidated first. in totality, I have sold 20. So 19 would be from lot 1. And how much from lot 2 to make it 20? 1 from lot 2. So 19 into 21 and 1 into 10. This is 10. This is 399. Summation is 409. Now I am left with 4 units at 7 and 9 units at 13. So 9 into 13 and 4 into 7. So this is 28. 13 into 9, 117. Summation is 145. And summation of 409 plus 145 has to be 5. I think I made some error. So 19 into 21, 399 and 1 at the rate 13. Sorry. So this should be 1 at the rate 13. 412. Now 412 plus 145, 557. So my answer is correct. So friends, in this way we are going to bifurcate, or we are going to find out the value of COGS inventory based upon these 3 methods. Okay, now I'm proceeding further. Now I'm coming to the analysis part, where my first analysis was that values under weighted average would always be in between FIFO and LIFO. But now I want to make some more analysis part, some more conclusions. So in the above example, 2 into 2, 3 into 3, 4 into 4, it was a rising price scenario or declining price scenario. So important. Assume that you have manufactured 2 units at the rate 2, 3 units at the rate 3 and 4 units at the rate 4. So is it a rising price scenario or a declining price scenario? So a rising price scenario. Okay. So I put this on a graph paper, where this is my time period and it is the cost of manufacturing per unit. FIFO, LIFO. And it's a rising price scenario, important. So rising price, I prepare the graph upward sloping, and under FIFO, the first part, the goods manufactured first. So goods manufactured first transferred to COGS, and goods manufactured later would be transferred to your inventory. But what happened in case of LIFO? It's an important one, friends. So what happened in case of LIFO? Goods manufactured last transferred to COGS, and goods manufactured earlier would be transferred to your inventory. Okay. Now with the help of this graph, you have to answer. If it is a rising price scenario, you have to make comparison, assuming that I'm using FIFO method. You have to make comparison with LIFO. I'm using FIFO. It's a rising price scenario. COGS under FIFO method in comparison to LIFO, higher, lower. COGS under FIFO method in comparison to LIFO is going to be lower. Now graph. This is COGS. It is on the lower side in comparison to LIFO. So my COGS is going to be lower. Okay. Now what about my inventories? Important. So inventory under FIFO method going to be Under FIFO method, inventory is going to be higher. Okay. Now my next point. If COGS is lower under FIFO, your expense is lower. So what is going to be the profits, gross profit under FIFO? Expense is lower. So if expense is lower, sales is anyways going to be remain the same. If cost is lower, then profits are going to be higher. Okay. And now next, if profits are going to be higher, now we are going to learn two more ratios. One is ROE and second is inventory days. So what is the formula? We will learn eventually. But the method is very simple. If profits are higher, return on equity means the percentage, in percentage terms, profit earned by equity holder. Your profits are higher. ROE is going to be higher. And last one is inventory days. Your inventories is higher. If I compute this in terms of days or in terms of some ratio, so this value is again going to be higher. So now I have to explain what is the formula for ROE and inventory days. But simply ROE is linked with profits. Your profits are higher, so your ROE has to be higher. And you are having more inventory. If you are having more inventory, if I compute this in some sort of ratio, that is inventory days, the answer is going to be higher. Now important. Now in exam they say it's a rising price scenario, it's a declining price scenario. You have to make some comments over the ratios, or you have to make some comments over the absolute values. So simple way is prepare this graph. Okay, now it's a rising price scenario. If it is a rising price scenario, assuming that I'm using FIFO method, my COGS is going to be, compare this vis-a-vis this, my COGS is going to be lower. Now verify it. Your COGS under FIFO is coming out to be 21 and under LIFO is 25. So my COGS has to be lower. Okay. My inventory is going to be higher. Now inventory under FIFO is 8, under LIFO is 4. So my inventory value is going to be higher. Now your COGS is lower. That means your profits are higher. If your profits are higher, what is going to be ROE? ROE is going to be higher. And now the last point. Inventories are higher. Inventory days, or it is some ratio with respect to the inventory. So inventory days are again going to be higher. So this was the case in case of rising price scenario. Now let's reverse it. Assume that instead of a rising price, it is a declining price scenario. So everything remains the same. Now declining price. So this is going to be your COGS under FIFO. This is going to be your inventory. This is going to be your COGS inventory. Okay, I'm using FIFO method. Now compare. It's a declining price scenario. I'm using FIFO method. My COGS in comparison to LIFO is going to be, my COGS is going to be higher. My COGS is going to be higher. My inventory is going to be lower. Now my COGS is higher. If my COGS is higher, my profits are going to be lower. ROE is going to be lower. You are having a lower inventory. If my inventory is lower, then inventory days are going to be lower in comparison to LIFO method. So this was your LOS 3, again a double star. So let's revise from the notes. So LOS 2 was talking about three methods, that is FIFO, LIFO, weighted average. So there is one more method, specific identification. This we will cover eventually. And in LOS 3, they are making some comparisons. FIFO results in comparison to LIFO, assuming it's a rising price scenario. COGS is going to be lower. Gross profit is going to be higher. Inventory balance is going to be higher. Now what is inventory turnover? Skip as of now. And the important point is, answer under weighted cost method would always be in between LIFO and FIFO. Now to prove this, again, I'm going to take one more example. Okay, now example. It's a declining price scenario. You manufactured 4 units. 4 units at 4 rupees each. 3 units at 3 rupees each. And 2 units at the rate 2 rupees each. In totality, company manufactured 9 units, have incurred 16, 9, 4, 29, out of which company has sold 7 units, is having an inventory of 2 units. Okay, now let's divide. FIFO, weighted average, LIFO. Important, it's a declining price scenario. So under weighted average, my answer is 29 upon 9 into 7, 29 upon 9 into 2. So if I solve, I think 29 divided by 9 into 7, 22.55. This is 6.45. Now FIFO, goods manufactured first, liquidated first. I have sold 7 units, 4 from lot 1, 3 from lot 2. Collectively they are making up 7. Now 16, 9, this is 25. I am left with inventory of 2 into 2, that is 4. Summation is 29. LIFO, goods manufactured last, liquidated first. So 2 from this, 3 from this, collectively 5. I have to make it 7, 2 from this. So this is going to be 4, 9, 4, 9 and 2 into 4, that is 8. I am left with 2 into 4, 8. Summation is 12, 21. Again 29. Now important. So numerical part is not important, the analysis part. It is a declining price scenario. Declining price. FIFO, LIFO. So in FIFO, the first component would always be transferred to COGS. In LIFO, the last component is going to be transferred to COGS. The last part, goods manufactured late, would be transferred to inventory. And here goods manufactured first would be transferred to inventory. Now you have to make some conclusions. I'm using FIFO method. My COGS is going to be, higher. My inventory is going to be lower. If my COGS is higher, my profits are lower, my ROE is going to be lower. Then inventory balances is lower. If inventory balance is lower, inventory in terms of days is also going to be lower. So this is going to be an important one. And based upon the graphs, your answer would always comes up to be correct one. Now I have to explain 2 two ratios. One is ROE. So the formula for ROE is EAT upon equity. And the formula for inventory days is equal to 365 upon inventory turnover ratio, where inventory turnover ratio is equal to COGS upon average inventory. Okay, now I'm left with these two ratios. So inventory days, inventory turnover ratio, this you have covered in your working capital management under corporate finance, and this ratio we have learned in leverage, okay, under corporate finance. So now again I'm repeating. Now my point is, if your COGS is lower, that means your gross profits are going to be higher, and eventually your EAT is going to be higher, and this EAT would get clubbed into your equity. So now these are the profits which belongs to the equity holders, and they plan that they are not taking out this money in the form of dividend, they want to reinvest. So now equity eventually will increase by, now let us assume this is increased by 10, so equity will eventually increase by 10. Okay, profits eventually increase by 10. This profits belongs to the equity holder, equity increased by 10. Now my point is, what would be impact over ratios? It's an important one. Now numerator formula is ROE is equal to EAT upon equity. Okay. Now both your numerator and denominator are increasing by 10. What would be impact over ratio? So point to be noted, your ratio will increase. Now the question arises, why when numerator denominator both are increasing by 10? Now important. Now let's assume that, okay, so I scored 90 out of 100. Okay, I scored 90 out of 100 in my maths exam, and today the teacher announces that one of the question was out of syllabus and we are going to delete that. Okay, and that question was of 10 marks, and assuming that I know the answer to that, so that my 90 is inclusive of this 10. Now teacher says that we are going to deduct, so the paper was not of 100 marks, it is of 90. Okay, and based upon that we are going to compute the revised score. My earlier percentage was 90%. Now they are going to make the paper of, they are going to reduce the paper by 10 marks, so minus 10. And I corrected this, I have solved this correctly, and for which I got 10 marks. So this 90 has to be reduced by 10 as well. Now I am reducing my numerator and denominator both by 10. Earlier my percentage was 90, and now my revised percentage is 80 divided by 90. My percentage is going to be 88.89%. That my percentage has reduced. Now the question arises, why? Though numerator and denominator are reducing by the same value. Now important. Here values are not important. Now watch carefully. The denominator is reducing by 10%. The denominator is reducing by 10. But numerator is reducing by how much percent? 10 upon 90. 10 upon 90 means your numerator is reducing by 11.11%, your denominator is reducing by 10%. Since your numerator is reducing more, value will fall. Same wise, in this particular case, important. Always. Now how we make up this? So this is equal to EAT upon money that they have invested. So money invested plus EAT. Okay. So that means it's very obvious this ratio would always be less than 100%, or this ratio would always be less than 1 in every case. Now my point is, let us assume that company is having an ROE of 20%. Now profit has increased by 10, equity increased by 10. Your ratio will improvise or your ratio will deteriorate. Now numerator is increasing by 50%. Denominator is increasing by 10% only. Your ratio will improvise. Okay, so it's very simple. Equity always include EAT, or in simple words, your ROE would always be less than 1. It is not possible that ROE is greater than 1. Same wise, it's a 100 marks paper. Always you are going to score less than equal to 100. So ROE always going to be less than 1. Now my point is, my numerator is increasing, my denominator is also increasing, my ratio will always improvise. Okay, so what would be the impact over equity? Equity increases by 10, but in a way ROE will improvise. Okay, now second is, what do you mean by inventory days? Now let us assume that I'm having inventories. I'm having inventory worth 50 rupees and COGS of 700. Okay, now I'm having inventory of 50, or make it 70, and COGS of 7,000. So as a percentage of COGS, how much inventory I'm having? Make it 700. So inventory as a percentage of COGS is going to be 10%. Okay, and now this COGS is of 365 days. I want to compute inventory in terms of days. So inventory as a percentage tha. Now inventories in terms of days. So in totality there are 365 days. I'm having 10%. So 10% works out to be 36.5 days. Now I can get this answer in some another way as well. Inventory days is equal to 365 upon inventory turnover ratio. 365 upon where inventory turnover ratio is COGS upon inventory. 365 divided by COGS is 7,000. 700 is inventory. 365 divided by 10. My answer is coming out to be 36.5 days. Now higher the inventory. So higher the inventory, higher would be inventory days. And how inventory days and inventory turnover ratio linked? Higher the inventory days signify inventory turnover ratio has to be lower. Now how we computed that? First COGS, first inventory divided by COGS multiplied by 365. This is the formula for inventory days. Higher the inventory, higher would be inventory days, and higher would be inventory days signify lower is going to be inventory turnover ratio. So friends, with this we have covered 3 LOS, LOS 1, LOS 2, LOS 3. LOS 1 was talking about which cost to be included or which cost is going to be direct and which cost is indirect. Second LOS was talking about inventory methods. One is still left, that is the specific identification. There we have learned that company can use 3 methods, that is going to be FIFO, LIFO, weighted average. And third, we have to do some analysis that answer under FIFO is going to be higher or lower. Okay, so this we are going to solve with the help of some graphical methods. Okay, fine. So now I'm not proceeding further. First, revise these 3 concepts before proceeding to the next part. Thank you. Now friends, I'm moving to my next LOS, methods of updating inventory schedule. So there could be 2 methods. One, periodic. Second, perpetual. Okay. Now let's understand what is difference between the two. LOS 4. There are 2 methods to update inventory register. Periodic system and second one is perpetual system. Periodic, where inventory register updates after a period. After a particular period, say after 1 month. Perpetual, where inventory register updates on daily basis. On continuous basis. Okay, now what is the meaning of this? For example, you manufactured 2 units at 2 rupees each, 3 units at 3 rupees each, and 4 units at 4 rupees each, out of which you have sold, there are going to be 9 units, out of which you have sold 7 units. Okay, but now in this case is this, you have been provided with dates. So if you are provided with dates, there is a hint that you have to use perpetual system. Okay. Now the dates are, you manufactured 2 quantities on 1st January 2022, then 7th January 2022 and 15th January 2022, and now you have sold 7 units. In totality during the month there is a sale of 7, out of which on 5th Jan you have sold 2, on 9th Jan you have sold 3, and on 17th Jan you have sold 2 units. Okay, now what's happening in this case, your inventory register is being updated on regular basis. Okay, now make it to simplify, make it 1. To simplify, make it 0. And on 17th you have sold 5 units, or collectively 7. Now in perpetual, your inventory register is being updated on continuous basis. Okay. Now let's assume that I'm using FIFO method and I'm using LIFO method. So first I'm writing the conclusion. In FIFO method, whether using perpetual or periodic inventory, answer is going to remain the same. Okay, so the earlier that we have done the example that was of periodic system. Okay, now under FIFO, whether it's perpetual or periodic, your answer would remain the same. Now let's check. On 5th January, you have sold 2 units. I'm using FIFO method, so that 2 units would be from lot 1. Okay, I have to bifurcate between COGS and inventory. So 2 into 2. Then again I have sold 5 units. Now this 3 units from lot number 2nd and 2 units from lot number 3rd. So 3 into 3, 2 into 4, 4, 9, 8. Summation is 21 and I'm left with 2 units at a rate of 4. Answer is 8. Now this answer 21 and 8 you are getting under periodic system as well. That means in the previous example. So in the previous example, your answer was COGS 21, inventory 8. That means whether it's a periodic system or perpetual system, COGS and inventory value would remain same if you are using FIFO method. But now under LIFO and weighted average, answers differ. Now important, LIFO means goods manufactured late, sold earlier. Now on 5th Jan, I have sold 2 units. Now these 2 units would be from which lot? Goods manufactured last, sold first. So this 2 units has to be from this lot only. It cannot be possible now from this lot because this lot has not been manufactured yet. And my inventory register under perpetual system is being updated on regular basis. I'm using LIFO method. I have sold 2 units. Now this 2 units has to be from the latest manufacturing lot. That means from lot number 1. Okay. On 17th Jan, again I sold 5 units. Now this 5 unit has to be first from the latest lot. So out of 5, I've sold 5. Now 4 units would be from the latest lot and 1 unit from the second lot. Now what is my COGS and inventory? So your COGS is going to be 2 into 2. These 2 units are from first lot. Then you have sold 5 units. Out of 5, 4 are from third lot. That is 4 into 4. And 1 unit from second lot. Answer is 4, 16, 3. Summation is 23. I am left with 2 units with a rate of 3. Answer is 6. Now, if you compare this, so this is the answer under periodic. So this is the answer under perpetual. And if you compare with the previous example, your answer under periodic was, under LIFO method, COGS as 25 and inventory as 4. But now the answer has been changed. Now your revised COGS is coming out to be 23 and inventory as 6. So point to be noted. There are 2 methods to update your register. If you are updating a register continuously on daily basis, perpetual. At the end of a particular period, perpetual. Now in case of FIFO, your answer are going to remain the same. But in case of weighted average and LIFO method, your answer will differ. Okay. So this was my LOS4, where we have learned that there are two methods to update your inventory register. Now I'm going to solve one question on this. Question number 4 and 5. So this is the table, and now you have been provided with dates. So hint, if they have given you the dates, you have to use which method? You have to use perpetual method. Okay. Now, a retail company is comparing different approaches to value inventory. The company has one product that it sells for $50. Selling price is irrelevant. I'm there to compute the cost. Okay. Now, what is the value of ending inventory for the first quarter if the company uses perpetual LIFO method? So, this is your first quarter, and you have to find out the inventory value assuming that you are using perpetual LIFO method. Okay. So, solution number 4. Now on 2nd January, I purchased 1000 units, and on 17th January, I have sold 500 units. So this 500 has to be from the latest lot. That means LIFO perpetual method. Okay. So initially I purchased 1000 units at the rate 20. Then I sold 500. Now this 500 has to be from the first lot. Multiply by 20. I'm left with 500 units. I'm left with 500 units at 20. Again proceeding. I purchase another 1000 at a rate 18. So 1000 into 18. And then I sold 1200. Now you have sold 1200. Now 1200 in totality you have sold. Now 1000 from this lot, because you're using LIFO method, that is 1000 into 18, and 200 from the above lot, multiply by 20. Now you are left with, now again you are left with 300 quantity with a rate of 20. Proceeding further, you purchase another 1000 at 17. 1000 at 17. And now you sold 500. So the 500 has to be from the lot purchased at 17. I'm left with 300 into 20, 500 into 17. Next, now you have to find out your inventory value. So important. In totality, you have purchased 3000 and you have sold 2200. That means I'm left with 800 units as inventory. So again, here I'm left with 800. Now you have to find out the value. So it is very apparent from this, but allow me to explain you again. I purchase 1000 units at 20. I sold 500 units at the rate of, I sold 500 units. Now this 500 would be belonging from this particular lot. I'm left with inventory leftover. I'm left with 500 units at 20. Again I purchase 1000 unit at 18. Sold 1200 units. Now in totality I have sold 1200. 1000 would be from this lot, the one purchased at 18, and remaining 200 from this lot. So if 200 has been subtracted from 500, I am left with 300 units at 20. 300 units at 20. Again I purchase 1000 unit at the rate of 17. Now collectively I am having 1300 units. Out of the 1300 I have sold 500. The 500 has to be from the latest lot. I am left with 500 units at 17 and 300 units at the rate 20. Now you have to compute the inventory value. So inventory value has to be 6,000. 500 multiplied by 17, 8500. So your inventory value should be 14,500. This is inventory. And what is COGS, cost of goods sold? Though this is not required. So my COGS is going to be 1000, then 18,000, 4,000, 500 multiplied by 17, 8500. If I sum up, answer is 31,500. Now please verify your answer. In totality, you have purchased 3000 unit and you have spent 55. The summation of these two, is it coming out to be 55? If answer is yes, then I made some mistake. 20,000. 20,000, 18,000, 17,000. 20,000, 18,000, 17,000. 55. Okay. I sold 500 for 20. So this is 10. Sorry. 10,000 plus 18,000 plus 4,000 plus 8,500. So summation is 40,500. Now if you sum up, answer should be 55. Yes, that means you have computed the correct answer. In a way, I am bifurcating 55. Out of this 55, 41,500 is going to be my 40,500 is going to be my COGS, and 14,500 is going to be inventory. Now, what is the meaning of perpetual? What is the meaning of periodic? Perpetual means your inventory register is updating on regular basis. So if the question wants you to solve using the perpetual, dates would be given. Okay. And periodic means inventory register is updating after a period. Okay. Now, whether it's a perpetual, periodic, answer in case of FIFO remains same. Answer in case of LIFO is going to change. Now, what is the meaning of LIFO? Goods manufactured first, sold. Goods manufactured later, sold first. So in this way, we have solved question number 4. So answer for question number 4 is 14,500. Okay. Now I'm solving only the 4th one. Proceeding further to my next LOS. LOS 5. Now LOS 5, there is a concept of LIFO liquidation. Now, what do you mean by LIFO liquidation? Okay. Now, assume that it's a rising price scenario. Okay. So, it's a rising price scenario. And your company is using the LIFO method. So, if you're using a LIFO method, this component would be transferred to your inventories, and goods manufactured later will be transferred to your profit and loss as CAGS. Okay, so it's a rising price scenario. Let us assume that, let's create one. Manufacture 2 units at the rate 2 per unit, 3 units at the rate 3 per unit, and 4 units at the rate 4 per unit, out of which you have sold 7 units. Okay, now if you sold 7 units, if you are using LIFO method, then your COGS is going to be 25. Inventory is going to be 2 units, that is 4 rupees. And collectively, you are bifurcating 29 rupees. Okay. Now my point is, what happened? Now in the second year, there is some decline in the demand. Okay, I'm already having 2 units, and this was, I'm talking about year 1. And in second year, there is a decline in the demand for the product. Okay. So hadn't been company manufactured further, it's a rising price scenario. So now the per unit cost is going to increase, and it has to be any value greater than 4. So assuming that it's a rising price scenario, okay, it's a rising price scenario, and what company does now, instead of manufacturing further, instead of producing the goods further, company stopped production and liquidated the existing inventory. So this is happening in this particular case. Now assuming that my selling price is 10 per unit. Now let's compute first gross profit ratio for year 1. So this is your year 1. In year 1, you have sold 7 units. So your sales is going to be 70. COGS is going to be 25. And your gross profit is going to be 70 minus 25, that is 45. So gross profit margin is equal to gross profit upon sales. Now what is your margin? 45 divided by 70. So in year 1, your margin was 64.285%. Now in the second year, instead of manufacturing the goods, company stopped the production and liquidated the existing inventory. Now I'm talking about year 2. So how much inventory I'm having? 2 units. By selling this at 2 at the rate of 10, I'm getting 20. Now what is the cost of this inventory? You have liquidated it. So cost is coming out to be 4. Answer is 4. I'm left with 16. And now your revised margins are 16 upon 20, that is going to be 80%. Now my point is, in year 2, your margins has increased from 65% to 80%. This increase in margin is a sustainable one or an unsustainable. Again, I repeat the entire scenario. Company is using LIFO method. Company is operating in an environment where there is a scenario of rising prices. Now, in the second year, instead of manufacturing the goods further, company liquidated the existing stock. As a result of which, the margins have increased from 65% to 80%. Now, my point is, this increase in margin is representing the increase in the profitability. That means when you're saying increase in the profitability, that means you're saying that this increase is a sustainable one. So this margin improvement which we are getting mathematically, is it a sustainable one or an unsustainable? Now, this is sort of similar to one-time event. Yes, in year 2, your margins have improvised, but these margins are an unsustainable one. These margins on account of liquidating the inventory which you have manufactured at a lower cost. But this is one-time event. Now you have liquidated everything. From year 3rd onwards, again you are going to manufacture the goods. Okay, again you have to begin your manufacturing, and then again there's going to be a sharp drop in your margins. This concept is known as LIFO liquidation. Now, simply, what do you mean by LIFO liquidation? So, LIFO liquidation means it's a rising price scenario. So, company is operating in a rising price scenario where the inputs cost are increasing. And what company does? Company liquidate existing inventory. In simple words, let us assume that their sales is of 10 units. So they have manufactured the goods less than that. Okay, so they have company liquidated existing inventories. As a result of which margins, gross profit margin for year 2 rises. This rise of gross profit margin is an unsustainable increase, and eventually from next year onwards margins has to reduce. So though no doubt your margins has increased, but this increase is on account of liquidating your existing inventories, and from the next year onwards they has to decline. Now why this concept is important, or now when you understand that it's a red flag, that means the increase is not good. So hint, your sales is declining. In year 1 you have sold 7, in year 2 you have sold 2 units. So your sales is declining. On the contrary, your margins are improvising. There is a red flag as an analyst that maybe the company, what company has does to inflate the margins, what company has does, company may be selling more than what it has produced, as a result of which the margins have inflated. But this is one-time event. Again in the future, margins are going to reduce. Now for example, this is one of the company like edZeb. And now as per the analyst, in year 2, margins have improvised, and maybe you raise your equity target price of edZeb to 3,000 rupees only on account of this increase. So this increase is a sustainable one? No. You have to analyze properly whether the margins that are increasing, is it a sustainable or an unsustainable one. So I hope you have understood the meaning of LIFO liquidation. So now I have covered 2 concepts. One, LOS4, which deals with, there are 2 methods to prepare the inventory register. One, perpetual. Second, periodic. And LOS5 deals with LIFO liquidation. Now I'm proceeding further to my next concept. Next concept is LIFO reserve. Now, okay, so before I jump to the LIFO reserve part, So I understand in totality there are going to be three methods. One, FIFO, second, weighted average, and then LIFO. And the rules in accordance with this, we are going to prepare our financial statements are known as IFRS. Okay. Now there are two set of rules. One is IFRS and second one is US GAAP. Okay. Now IFRS is applicable to all the companies around the world. IFRS is a single set of standards which are applicable to all the companies around the world. Okay, including US. And US GAAP is a set of standards which has been specifically framed or drafted for US companies. Okay, that means there are two set of rules. One applicable around the world, IFRS, including India, IFRS, and one specifically designed for US, that is US GAAP. There are two sets of standards. Eventually we will learn that even US GAPs are being converged to IFRS. That means now after some years, after somewhere down the line 2 to 3 years, US GAAP will not be in existence and only IFRS will remain. But this is in process. Okay. Currently there are two set of standards, IFRS, US GAAP. Now you have to remember both. Now both will be telling different stuffs. But from exam point of view, if your question is silent, and highly testable one is going to be IFRS. Okay. Now what IFRS is saying? IFRS is saying, I will allow only two methods. I understand there are going to be three, but only two methods are allowed to the companies. That is FIFO and weighted average. This is as per IFRS. That means under IFRS, LIFO method is prohibited. But US GAAP permits all the three methods. So this is one difference between IFRS and US GAAP. Now there's a concept of LIFO reserve, double star. Now what do you mean by LIFO reserve? So again, these concepts of LIFO is applicable only, these concepts exist only under US GAAP and these are applicable only to US companies. Okay. So now before we start with LIFO reserve, let's prepare one table where we are getting the answer for FIFO and LIFO. Same example, 2 into 2, 3 into 3, 4 into 4, out of which we have sold 7 units. So your COGS is coming out to be 21 and 25 and inventory balance was 8 and 4. Now under US GAAP it is permitted to the companies to use LIFO method, but now they have to disclose one value. Now what is that value? That value is LIFO reserve. Now they have to disclose this. Now what is the meaning of LIFO reserve? Important. What should be added to, again I repeat, what should be added to inventory balances as per LIFO to convert them into FIFO. Okay. So in your case, inventory value as per the LIFO method is 4. Now what should be added to 4 so that to convert into inventory balances as per FIFO? So answer is, how much should be added to 4 to make it 8? So plus 4. Now this is going to be LIFO reserve. So what is the meaning of LIFO reserve? What amount we should add to LIFO inventory to convert this into FIFO inventory. Now what should be added to LIFO inventory to convert this into FIFO inventory? Answer is positive 4. That means LIFO reserve is 4. Okay. Now why this concept is important? Though in book there is a concept of LIFO, but majority of the companies follow FIFO, either FIFO or weighted average. Okay. Now my point is, let us assume that my company under US GAAP is using the LIFO method. Now to make my comparison easy with the other companies, there's a requirement that you have to disclose LIFO reserve. And now, as an analyst, it will be testable how to convert financial statements prepared as per LIFO method into FIFO method. So a testable one. So let's assume that this company name is ABC. It has prepared its accounts using the LIFO method. Now you have to convert these financial statements from LIFO to FIFO. Important. Now first there are going to be two parts. First is going to be balance sheet, and the balance sheet total always tallies. Now my first point. I want to convert this from LIFO to FIFO. So I should increase my inventory values by. So inventory is valued to be increased by 4. And if I'm going to increase my inventory's value by 4, ideally now I'm going to reduce my COGS by. You should reduce your COGS by 4. Okay. And the moment my COGS reduces by 4, my profits jumps by 4. Correct? Now, assuming that the tax rate is 10%. The tax rate is 10%. Now, profit in totality increases by 10. Now, why? Oh, sorry. Profit in totality increases by 4. How profits are increasing? So, you're saying that I'm going to increase my inventory by 4. So if you're going to increase your inventory by 4, that means you're going to reduce your expenses by 4. Okay. Ideally the summation has to be 29. Now my point is, the moment my COGS will drop by 4, my profits will increase by 4. Now increase in profits has to be divided between two persons. One company, one government. In totality, profit has increased by 4. How much out of this 4 belongs to the government? So this 4 has two parts. One belongs to the government, that is 0.4, tax rate is 10%, and one belonging to the equity holder, that is 3.6. Now I have to tally the balance sheet. Now equity is going to be increased by 3.6, and you have to pay additional taxes to the government now, and your cash is going to be reduced by 0.4. Eventually my balance sheet will tally I'm increasing the asset in totality by 3.6, and I'm increasing the liability in totality by 3.6. Now important, again I repeat, to tally the balance sheet there are going to be 3 steps. Increase your inventory by 4. So increasing inventory by 4 means reducing your expenses by 4. Reducing your expenses by 4 means increasing your profits by 4. This 4 has to be divided between two persons. Now let us assume that your EBT will increase by 4. Now your taxation will increase by 0.4 and your EAT will increase by 3.6. So this 3.6 will be added to equity, and this additional 0.4 will be subtracted from the cash component because you have to pay additional taxes to the government. I have to tell you the balance sheet. So there are going to be three steps. Inventory to be increased by closing LIFO reserve. Cash to be reduced by closing LIFO reserve multiplied by tax rate, and equity is going to increase by closing LIFO reserve into 1 minus tax rate. So in my case, inventory increases by +4, equity increases by +4 multiplied by 1 minus 0.10, this is 3.6, and cash reduces by 4 multiplied by 0.10, that is minus 0.4. Collectively, I'm increasing my liability by 3.6 and my assets by 3.6. In this manner, your balance sheet tallies. But now I have to prepare a revised profit and loss account as well. Okay. Now, how to prepare the profit and loss account? So first, revise from the notes. Under US GAAP, it's mandatory for the companies to disclose LIFO reserve. Now, what do you mean by LIFO reserve? The amount that should be added to LIFO inventory so that it is converted as per FIFO method. Okay. Now, to convert the firm's financial statement from LIFO to FIFO, add the LIFO reserve to the inventory, decrease cash by LIFO reserve multiplied by tax rate, and increase equity or retained earnings, means the profits, increase equity by LIFO reserve multiplied by 1 minus tax rate. Okay. Now, how to tally the profit and loss account? Again, important. Now my point is, let us assume that I'm having a total opening inventory of, in the beginning of the year, I'm having opening inventory of 400. During the period, I manufactured goods for 600. Now goods available for sale is going to be 1000 available for sale, and out of this I sold goods costing 700. This is going to be 700. So my inventory value, closing inventory, is going to be 300. Okay. Now let us assume that if I've been provided with opening inventory, additional purchases, and closing inventory, can I find out COGS? Yes. So formula is COGS, cost of goods sold during the period, is going to be opening inventory plus purchases or manufacturer minus closing inventory. My opening inventory was 400 plus I manufacture for 600. Collectively I am 1000. Out of that 1000, 300 still is in my go down. So how much I have sold the goods? Goods worth 700 has been sold. So what is the formula for COGS? Opening inventory plus manufactured minus closing inventory. Okay, so this is the formula. And now my point is, in my P&L account, I would be having one figure, that is COGS as per LIFO method. Okay, and now I want to convert this to COGS as per FIFO method. So first, how this value is computed? This value. So COGS as per LIFO is going to be opening inventory as per LIFO plus goods manufactured or purchased during the year, goods manufactured during the year, less closing inventory as per LIFO. And now I want to compute revised amount as per FIFO method. So simple. You have to change now. So this answer should be opening inventory as per FIFO plus goods manufactured during the year minus closing inventory as per FIFO. Okay. Now I'm proceeding further. Now my point is, let us assume that this value is 100 or this value is 700. This is 100. No, this is 400 plus 600, 1000 minus 300. Now I want to convert this into FIFO. Now my point is, if I open up the bracket, now can you suggest me a good name for this? What should be opening inventory as per FIFO? So can I write like this? Opening inventory as per FIFO should be opening inventory as per LIFO plus opening LIFO reserve. So what was the meaning of LIFO reserve? What should be added to LIFO inventory? What should be added to LIFO inventory so that it's going to convert into FIFO? So FIFO inventory is nothing but LIFO inventory plus LIFO reserve plus this value is anyways going to remain the same. Goods manufactured during the year minus closing inventory LIFO. So this is going to be closing inventory LIFO plus closing LIFO reserve, bracket close. Now if I open up the bracket, opening inventory LIFO plus goods manufactured minus closing inventory LIFO plus opening LIFO reserve minus closing LIFO reserve. Can I write like this? Yes. Now what this particular paragraph is signifying. Now what this is signifying. Opening inventory LIFO plus good manufactured minus closing inventory LIFO. This is nothing but equivalent to COGS as per LIFO. Now you have to add opening LIFO reserve and you have to subtract closing LIFO reserve. This is going to be the adjustment to compute the revised COGS. Now important. What you have to remember. So, how to tally balance sheet? There are going to be 3 steps. Those 3 steps are: increase your inventory by LIFO reserve. Okay. As a result of this, in totality, your cost is going to reduce by 4. In totality, your profits are going to increase by 4. Now this 4 has to be bifurcated in 2 parts, 2 students. One is government, one is equity. So reduce your cash by 0.4, increase your equity 3.6. Collectively your balance sheet tallies. That is correct. Like now P&L talks about a period. it has an opening value, it has a closing value. It talks about a period. Now that is 10% correct. That is 10% correct. I should reduce to compute COGS as per FIFO. I should reduce closing LIFO reserve. That is correct. But to compute the answer during that particular period, students forget to add this opening LIFO reserve. Now there are going to be 4 steps. Now there are simply going to be 4 steps. First, for the balance sheet, inventory, add LIFO reserve, closing LIFO reserve. Equity, closing LIFO reserve multiplied by 1 minus tax rate. Correct. And your cash is going to be reduced by LIFO reserve multiplied by tax rate. Your balance sheet tallies. 10% correct. Now, to compute the revised COGS as per FIFO, you have to subtract closing LIFO reserve, and you have to add opening LIFO reserve. Now, this adjustment is required. Now, let us assume that in your case, closing LIFO reserve is 10. Closing LIFO reserve is 10. Opening LIFO reserve is 7. And COGS as per LIFO method is going to be 300. Now, COGS as per FIFO is going to be 300 minus 10 plus 7. This is going to be 297. Now my point is very simple. If you are converting to FIFO, for now your COGS for that particular period will reduce by 3. Your COGS for that particular period will reduce by 3. But in totality, your profits will increase by 10. So balance sheet talks about in totality. However, P&L talks about during that period. So how to tally the balance sheet? 3 steps. Lekin how to prepare the revised P&L? You have to deduct closing LIFO reserve, but you have to add up opening LIFO reserve as well. This is going to be the revised COGS as per FIFO. And P&L, on the contrary, is prepared for the period. For the period means it has an opening value, it has a closing value. On the other hand, balance sheet is prepared as on date. That means balance sheet talks about in totality. Okay. Now, I hope you're clear with this particular concept. Now, I'm not proceeding further. Let's have a good practice of these concepts. Now, LOS 4, 2 system, perpetual, periodic. LOS 5, that is LIFO liquidation. An unsustainable increase in the gross profit margins on account of liquidating existing inventory. LOS 6, LIFO reserve. In totality, there are going to be 4 steps to tally the P&L and the balance sheet part. So now, let's revise first. To convert a firm's financial statement, add LIFO reserve, decrease cash, increase equity, and the 4th part is subtract the change in the LIFO reserve from COGS. Now what 4th point is trying to convey? That to compute the revised answer as per FIFO, you have to subtract closing LIFO reserve and you have to add opening LIFO reserve. Okay, now let's practice this concept. Fine. Question number 6. During the period of rising inventory cost, a company using FIFO method rather than LIFO method will report a lower. Now, will report a lower important. So, rising price scenario. This is going to be your COGS. This is going to be your inventory COGS. Now, this is LIFO method, FIFO method. You are using FIFO. So, your COGS is going to be lower. Okay. So, COGS is not an option. Your inventory balance is going to be higher. If inventory is higher inventory days, and inventory days are higher, that means lower inventory turnover ratio. So inventory turnover ratio. So during the period of rising prices, a company using FIFO will report a lower inventory turnover ratio. Answer is B. So for 6th, question number 6, answer is B. 7th, LIFO reserve. Now, LIFO reserve is most likely to increase when inventory's value are, again important. Question number 7. Now, 1, a rising price scenario, 2 into 2, 3 into 3. So this is 4, this is 9. In totality, you purchase 5 units at the rate of 13. And now I say that you have sold only 1 unit. So if you have sold 1 unit, COGS inventory as per FIFO method. If you have sold 1 unit, FIFO COGS is going to be 2 and 11 is going to be your inventory. As per LIFO, if you have sold 1 unit, so that 1 unit from this lot, it has to be 3 and inventory is 10. Now my point is important. It's a rising price scenario, and in this particular case, what is going to be your LIFO reserve? LIFO reserve is nothing. What should be added to LIFO inventory to convert this into FIFO? My LIFO inventory is coming out to be, my LIFO inventory is nothing but a positive number. Hadn't been, it is a declining price scenario. 3 into 3, 9, 2 into 2, 4. I have sold only 1 unit. If I have sold only 1 unit, my COGS is going to be 3. Inventory is going to be 10. 1 unit from this lot. This is the answer as per FIFO. And answer as per LIFO. COGS is going to be 2. Inventory is going to be 11. Now, if it is a declining price scenario, then LIFO reserve is going to be, what should be added to 11 to turn this into 10? So LIFO reserve is going to be negative. So simple. If it is a rising price scenario, LIFO reserves are going to be positive. If it is a declining price scenario, LIFO reserves are going to be negative. Answer it. LIFO reserve is most likely increase when the inventory's value are, cost are. So LIFO reserves are going to increase, or it is going to be a positive number when costs are increasing. Answer is A. Proceeding further, question 9. A company is using the LIFO method, reports the following figures: COGS, ending inventory, reserve, you have to find out COGS for 2018 under FIFO method. So question number 9. COGS as per FIFO is equal to COGS as per LIFO minus closing LIFO reserve, add opening LIFO reserve. So 50,800 minus closing reserve, that is 10, minus 4320 plus 2600. So if I solve this, my answer is 49,080 rupees is going to be COGS. Answer is B. Now proceeding further. Seventeenth, like many technology companies, TT operates in an environment of declining prices. Its reported profits will be highest if it accounts for, now answer is not C, either it's going to be A or B. Now it's a declining price scenario. 17, so declining price. If FIFO is followed, this is going to be your COGS, this is going to be inventory. LIFO is followed, this is going to be inventory, this is going to be your COGS. Now my point is where the profits would be more. Profits would be more where COGS are going to be lower. So now the point is where COGS is lower. So COGS is going to be lower in case of LIFO method. For 17th, answer is B. Now question number 37. An analyst is comparing the inventory turnover ratio based upon year's average inventory of two competitors. Company A uses the FIFO method for its accounting and has an inventory turnover ratio of 3.5. Company B uses the LIFO method. This is the data for company B. And now you have to convert company B's financial into FIFO and compute revise inventory turnover ratio. Question number 37. Inventory turnover ratio is equal to COGS upon average inventory. Now COGS as per FIFO, average inventory as per FIFO. So now COGS as per FIFO is going to be COGS as per LIFO. Now you are provided with profits, gross profit and sales. That means 2841 minus 839. Now this will signify your COGS as per LIFO minus closing LIFO reserve 48, add opening LIFO reserve 20. Now you have to compute average inventory. Now opening inventory is going to be 526 plus 20, I converted this into FIFO, plus closing FIFO inventory, which is 534 plus 48. You have to compute average, that means divide by 2. So answer is 2841 minus 839 minus 48 plus 20, 1974 divided by 526 plus 20 plus 534 plus 48 divided by 2, 564. Now if I solve, my answer is 3.5. Now the best conclusion, companies B inventory turnover ratio on FIFO basis is going to be exactly similar. So again I repeat, first I compute COGS FIFO using the formula COGS LIFO minus closing LIFO reserve plus opening LIFO reserve. Okay, where COGS LIFO is equal to sales minus gross profit, and I computed opening FIFO inventory by adding a LIFO reserve to LIFO inventory. I computed closing FIFO inventory by adding up closing LIFO reserve to LIFO inventory. Take up the average. Answer is coming out to be 3.5. Now using year-end inventories, that means whatever the formula that we are going to use, you need not to use average, you have to use year-end inventory. Now using year-end inventory, FIFO instead of LIFO, to determine the number of days in inventory on hand for 2014, the difference in days will be greater by. Okay, so now in what is happening in 58th, first you have to compute inventory days. Now formula to compute inventory days is 365 upon inventory turnover ratio. 365 where inventory turnover ratio is equal to COGS upon closing inventory. Why closing inventory? Because specifically given using year-end inventories. Okay, now my answer is coming out to be 365. This is the answer using LIFO method. 365 divided by, now sales, gross profit margin is 0.48. So if gross profit margin is 0.48, that means COGS is 52%. 2173 multiplied by 0.52. So my cost is coming out to be, so how I computed cost? That is sales minus gross profit divided by closing inventory equal to 365 divided by sales is 2173, gross profit is 0.48 multiplied by 2173 divided by closing inventory. Now closing inventory is 310. So this is going to be an answer using LIFO. This is the inventory days using LIFO method. Now I have to find out inventory days using FIFO. 365 upon COGS. So now COGS is going to be this minus this. This is 1129.96. You have to subtract closing LIFO reserve 77, add 59 divided by 310. Now you have to turn this using FIFO. So add reserve, that is 77. So now your answer is minus 77 plus 59 divided by 310 plus 77 inverse into 365. Answer is 127.03 days. Now what is the difference between the two? So difference between the two is close to 27. Next, 59. Sales, year-end inventories, LIFO reserve, net profit margins. Corporate tax is 30%. If FIFO method instead of LIFO method is used, net income for 2014 will be higher by 59 is a double star. Now 59. Now you want to convert this into FIFO. Okay. So sales, what going to remain constant? Sales value is going to remain constant, that is 2125. And now COGS as per FIFO is going to be now let's assume that this is X minus closing LIFO add opening LIFO. That means now your COGS minus 82 plus 64. That means on net basis your COGS will reduce by 18. How come? Minus 82 plus 64. That means net your COGS will reduce by 18. So if your COGS will reduce by 18, your gross profit will increase by 18. If COGS reduce by 18, gross profit will increase by 18. Then your EBT will increase by 18. Tax rate is 30%. Now government taxation will increase by 5.4 and your net EAT will increase by 12.6. Answer is C. Now how come, friends? Not saying that if you convert your financial statements from LIFO to FIFO, on net basis your profits will increase by, so you're subtracting 82, you're adding up 64. So your expense in a way will reduce by 18. That means your profits will increase by 18. But now this increase has to be divided between government and the equity holder. Government will take up the 30% and balance 70% belongs to equity. Okay. So all these concepts are very important one. Now, before I stop the video here, I want to revise all these three concepts again, or rather I want to make a complete revision of whatever we have discussed till date. Okay, till in this particular chapter. Now, first, we started with that what do you mean by financial reporting analysis? Here, we will be learning how to prepare the financial statements and the analysis part. Financial statements are collectively referred to three statements: profit and loss account, balance sheet, cash flow statements. These financial statements are prepared in accordance with IFRS, in accordance with US GAAP. And there are four pillars to these standards. 1. Matching. 2. Accrual. 3. Prudence. 4. Consistent. Now, my chapter name is Inventories. And my first pillar was matching. Match your expenses with respect to your revenue. Now, I manufactured, let us assume 100 bikes, out of which I have sold 70. Now, the 70 is only going to be transferred to your P&L account, and remaining 30 is going to become your assets. And they eventually transfer to your P&L account whenever you're going to liquidate that. That means expenses are either expense or expenses are an asset. And eventually asset one day will be converted or eventually transferred to your profit and loss account in case of inventories in the form of COGS. Okay, so this was the first example of matching. Now then we discuss two costs. One period, one periodic. One product, one period. Now, or direct, indirect. All the expenses that has been incurred to manufacture the goods. Raw material, labor, power, freight inward, storage of inputs, normal waste. All these are examples of production cost. All these are examples of direct expenses. On the other hand, indirect expenses are selling and admin expenses, freight outward expenses, storage of finished goods, employee costs, selling admin, then your employee cost, electricity cost. All these are examples of indirect cost. Now, direct cost is going to be bifurcated between COGS and inventory based upon matching concept. On the other hand, indirect expenses are directly transferred to your P&L account as other operating expenses. So this was my LOS 1. Then LOS 2 says that in totality there are going to be three methods to compute inventory and COGS: FIFO, LIFO, weighted average. IFRS says that I am allowing only FIFO and weighted average. On the other hand, US GAAP says I am allowing you all the three methods. You are permitted to use all the three methods. However, LIFO method is prohibited under IFRS. Then in LOS 3rd, we draw some conclusions. If it is a rising price scenario, if it is a declining price scenario. Now, whatever the case is going to be, answer in case of weighted average always has to be in between. And then my point was, if it is a rising price scenario and I'm using the FIFO method, rising price scenario, FIFO method, your COGS is going to be lower, your inventory is going to be higher. COGS lower, that means profits are higher. Inventory higher, that means higher inventory days and lower inventory turnover ratio. So this was the conclusion which I can draw whether it's a rising price or a declining price scenario. Then LOS 4 important. Now you can update your inventory register either perpetual or periodic. Periodic means after a particular period. Perpetual means on a continuous, on a regular basis. Now answer under FIFO is going to remain same. Yes, but definitely answer under LIFO is going to change, and on that we have done some examples. Then what do you mean by LIFO? Liquidation. LIFO liquidation signifies it's a rising price scenario and company liquidates, or company stops production and liquidates its existing inventory. As a result, in a particular year, there could be a possibility that gross profit margins may increase, but this increase is going to be an unsustainable one. Then last was LIFO reserve. What do you mean by LIFO reserve? US GAAP permits to use LIFO method, but every company that is using the LIFO method has to disclose LIFO reserve as well. Now, what is the meaning of LIFO reserve? What should be added to LIFO inventory to convert this into FIFO? Now you have to tally the balance sheet. Add LIFO reserve to your inventory. As a result, in totality, your profits, your cost will reduce by LIFO reserve. For example, you are adding 4. So your cost in totality will reduce by 4. Now the moment the cost is reducing by 4, in totality profits will increase by 4. This 4 has to be shared between two persons, one government, one equity. Reduce your cash by 0.4, assuming tax rate is 10%, and increase your equity by 3.6. My balance sheet tallies. But now to prepare up the financial state, to prepare up the P&L, or to find out the COGS as per FIFO method, it is going to be equal to COGS as per LIFO minus closing LIFO reserve plus opening LIFO reserve. Now if you do all these adjustments, in this case, taking up the example of taking up question 59 as example, in this case your COGS for that particular period will reduce by 18. Your profits for that particular period will increase by 18. This increase has to be divided between equity and the government. Government will take away 30% and your equity will increase by 12.6. So now class, this was the, I think, in this part we have covered up the most difficult part of this lecture. Students find it difficult. Students may find the concept of LIFO reserve to be difficult, but to simplify, in totality there are going to be 4 steps, and applying those 4 steps you will get the correct answer. Okay, now the rest of the part of the chapter is not that much difficult, but it's very important that you solve all these examples that we have covered before proceeding to the next part. Thank you. Now friends, I'm moving to my next LOS 7, Inventory Valuation. So this concept is based upon principle of prudence. Okay. Now let us assume that today you manufacture a product and that product cost you 10 rupee. Okay, so this is your manufacturing cost, and suddenly the demand for this product declines in the market. Now for example, your manufacturing cost is 10, but now you anticipate that the management anticipates the selling price of this product in the market is 8 rupees. So eventually you are going to sell this product for 8 rupees in the market, and you are going to book a loss of 2 in the future. Now based upon prudence, what we are going to do, we are going to book losses today. Now inventory valuation. So first I want to discuss about IFRS. Under IFRS, inventory will be shown at cost or net realizable value, whichever is lower. Now I'm talking about the inventories, the goods which has been unsold. Now you have in totality incurred a cost of 10 rupees. So either you're going to show at 10 or NRV, net realizable value. Now what is the meaning of NRV? By selling this product in the market, how much you are getting? That means NRV is equal to selling price minus estimated selling cost. That means if you are going to incur some selling cost to sell this product, that are going to be deducted. Now this is known as NRV. Now let us assume that I incurred a cost of 10, and by selling this product in the market, I'm going to get 8 rupees. So today what I am going to do, I'm going to show my inventory at 8 rupees. So you incurred a cost of 10, you're showing at 8, and eventually 2 rupees loss is going to be booked in your profit and loss account. Now what is going to be the name of this particular expense? This 2 rupees expense which you have booked today is known as impairment charges. So impairment charges, or the another name is written down. So you have written down your inventories by 2 rupees. Now this expense is going to be clubbed under COGS. So let us assume that you manufactured a product where you incurred a cost of 90 rupees. Now you anticipate that net realizable value is going to be 70. So 20 rupees loss is going to be booked today. This 20 rupees is nothing but known as impairment charges. Now my point is, let us assume you are going through annual report of any company. Thus, impairment charges, from an investor point of view, is it a positive news? Is it a positive item? Answer is no. Impairment signifies that the demand for your product is declining in the market. Now, why we do the impairments? The impairment is based upon the principle of prudence. What do you mean by prudence? If you're going to incur any loss in the future, that has to be booked today. Now, what is going to be the impact of impairment? Now, important. Now, what is going to be impact of impairment? So, impairment, first of all, will reduce your inventory value, will increase your COGS, will reduce your EAT, and eventually will reduce your equity. Now, impact over some important ratios. Inventory reduced. So what would be the impact over inventory days? Inventory days again reduce. What would be the impact over inventory turnover ratio? Inventory turnover ratio will increase. Impact over ROE. Profits has reduced. Now ROE is going to reduce. So impairment is a positive thing? No. If there's an impairment, it signifies that the demand for your product is continuously declining in the market. Okay. Now let us assume that today I booked an impairment of 2 rupees. Okay. And tomorrow again, and tomorrow means after 1 year, again hypothetically assumes that demand for your product improves in the market. Okay, you have incurred a cost of, today let's assume that you have incurred a cost of 10 rupee, and now you anticipate that two options. Now you anticipate that you can sell your product in the market for rupees 9. Okay, so you have already written down to this value to 8. Okay, so you have already written down to 8. Sorry. Now you anticipate that this inventory can be liquidated at 9. You anticipate that this inventory can be liquidated at 11. Now my point is, can we reverse the impairment charges of previous year? So first I'm talking from the point of view of IFRS. Now in the earlier years, how much impairment you have charged? So you have charged impairment to the tune of 2 rupees. Okay. Now the cost is 8. You anticipate that you can sell this for 9. That means in the future, you're going to earn 1 rupee profit by liquidating this. Already you have booked an expense of 2 rupees. Does reversal of 1 rupee is allowed? Answer is yes. 1 rupee reversal is allowed. Now when you're going to do reversal? So in case of reversal, again, you're going to increase your inventory value. You are going to reduce your COGS by 1 rupee, and in this case this 1 rupee would be termed as reversal of impairment charges. Your profits will increase and eventually equity will increase, and I'm going to reverse the impairment charges to the tune of 1 rupee. Now let us assume that management anticipate the product can be sold in the market for 11. Cost is 8, 11. That means you can earn a profit of 3 rupees. Already impairment is to the tune of 2 rupees. Keeping in mind the prudence, reversal of impairment is allowed. but reversal is allowed maximum to the tune of losses booked earlier. So important. Again, I repeat. Number one, I'm talking from IFRS point of view. IFRS. Under IFRS, inventory value is equal to NRV or cost, whichever is lower. So in majority of the cases, cost is lower. Okay. Now, if NRV is lower, this concept is known as impairment or written down impairment, which signifies that demand for your product is declining. Now, impact over your balance sheet and P&L. Inventory reduce by the tune of 2 rupees. COGS increases by the name impairment charges. Again, EAT reduces and eventually equity reduces. Okay, so this was the impact over my balance sheet and P&L. Ratios, inventory days reduces, inventory turnover ratio increases, and ROE reduces. Okay, I booked a loss of 2 rupees. Now in the future, I anticipate I can sell this product for 9 rupee. Reversal allowed? Yes. But reversal of 1 rupee or 2, whichever is lower. So 2 already booked. 1 is going to be the profit of future period. 1 or 2, whichever is lower. So reversal is allowed of 1 rupee. But in case you anticipate that you can sell this for 11. So 2 or 3, whichever is lower. So reversal would be maximum to the tune of 2 rupees. Again, keeping in mind the principle of prudence. And if there is a reversal means the demand for product is again increasing. Now, reversal of impairment signifies increasing the inventory value, reducing the COGS, profits will increase, and eventually equity increases. Reversal of impairment is positive for any business. Now, what would be the impact over the ratios? Inventory days increases, inventory turnover ratio reduces, ROE increases. So this was covered in LOS 7 and LOS 8. Now let's understand from the point of view of US GAAP. Okay, so US GAAP. Now I want to divide this into two parts. Weighted average and FIFO method if you're using, and LIFO method if you are using. So if FIFO and weighted average, similar to IFRS, cost or NRV, whichever is lower. Okay, but one different point is reversal of impairment charges not allowed. So throughout US GAAP, reversal of impairment charges is not allowed. Okay, but for LIFO they have given a different formula which you have to remember. No logic behind that. Now you have to mark up this particular point. So LIFO, if you are using a LIFO, then the point is cost or replacement, whichever is lower. Okay, now what is the meaning of NRV? Net realizable value. Net realizable value means if you go to the market, if you sell this product, how much you're getting, how much money you're getting. This is NRV. Now what is the meaning of replacement? The meaning of replacement is if today you're going to the market and if you purchase the same product, how much you are going to pay. So replacement cost means I go to the market, I'm going to buy the same product. If I buy the same product, at what price I'm going to buy it. Okay, so cost or replacement, whichever is lower, where again there is a window where replacement there's a range where replacement cannot be greater than NRV and cannot be less than NRV minus profit margin. Okay, again, reversal of impairment not allowed. Now let us assume that your cost is 10, your replacement value is 8, whichever is lower. Okay, so now 8 is lower, you incurred a cost of 10, that means impairment is 2. Okay, now where replacement cannot be greater than NRV. Let us assume that NRV is 9 and cannot be less than NRV minus profit margin. Let us assume this value is 7. That means this 8 should fall between 7 and 9. Now, hypothetically assuming NRV is 7.7. So NRV is 7.7. So replacement cannot breach this value. So now here I'm not going to assume 8, I'm going to assume 7.7. Same wise, let us assume that NRV is 9, NRV minus profit margin is 8.5. Now replacement cannot be less than this value. It has to fall within this range. So this is the lower band, this is the upper band. Now replacement is less than this. It cannot be. So here I'm not going to consider 8, I'm going to consider 8.5. So incurred a cost of 10, value is 8.5. 1.5 is going to be impairment charges. So again I repeat, cost or replacement, whichever is lower, where replacement cannot be greater than NRV and cannot be less than NRV minus profit margin. It has to be fall within this range. Now if it is breaching, so we are going to cap it at NRV level and the floor value is going to be NRV minus profit margin, and accordingly we are going to compute the impairment charges. Now sir, what is the logic behind these calculations? So eventually I prove behind IFRS, yes, there is some principles, but for US GAAP, eventually we conclude that yes, the strong backing or strong evidence or strong principles is somewhat missing. Okay, so now this you have to mug up, but again from an exam point of view, I don't think US GAAP is important. Okay, more logical is IFRS. Eventually US GAAP are converging into IFRS, so keeping that in mind, IFRS are important than US GAAP. Okay, so important point, under IFRS, cost, NRV, whichever is lower. Okay, if NRV is lower, it is known as impairment charges. Reversal of impairment charges are again allowed, but maximum to the tune of losses booked earlier. Then we have understood the impact over P&L, balance sheet and ratios part. Then under US GAAP, FIFO weighted average, exactly similar to IFRS, only that reversal of impairment charges not allowed. LIFO method, cost or replacement, whichever is lower, where replacement cannot be greater than NRV, cannot be less than NRV minus profit margin. It has to be fall within this range. And again, reversal of impairment charges not allowed. Okay, so this was your concept number 7 and concept number 8. So let's go through notes 1. Under IFRS, inventories are valued at cost, NRV, where NRV is fair value minus selling price. Write-ups are allowed, but only to the extent previous written down to NRV. Maximum to the losses booked earlier. Under US GAAP, inventories are valued at cost, NRV, similar to the IFRS. But the exception is LIFO. Inventories are valued at lower of lower of cost or market, where market is equal to replacement, subject to maximum value of NRV and minimum value of NRV minus profit margin. No subsequent write-ups is allowed under US GAAP. Impact over ratios. It is going to decrease the inventory value. As a result, inventory days will reduce. Impairment losses reduce profits, thus equity for the ROE will reduce. And then they have explained increase debt to equity and debt to asset ratio. So now in totality, if I consider my balance sheet, your equity has reduced, so your asset will reduce eventually, equity reduce and debt remain constant. So debt to equity ratio, now equity is reducing, so debt to equity ratio will increase. Debt to total asset ratio, asset is reducing, debt is constant, so debt to total asset will again increase. Okay, now increasing debt to equity ratio and debt to asset ratio is not good for any company. So now we covered LOS 7 and 8. Now I'm moving to the next one, disclosure requirements. Okay, now disclosure requirements you have to mark up. Now let us assume that I download the annual report of any company, let's say C8 annual report. Okay, so for 2020, now if I do Control F, here you will find in this annual report you will find the financial statements of the company, and so that analysts are in a better way to understand these financial statements, now company has to give some disclosures. Disclosure means notes to accounts, explanation, some explanatory statements. So this is known as disclosure. Now if I Control F and if I search here inventory valuation or weighted Now these are notes to accounts. So there's a specific column for inventories. Now how you have valued your inventories. So inventories are valued at cost or NRV, whichever is lower. Now in order to determine the raw material, in order to determine the cost method which we are using, now C8 is using weighted average method. So now you're going to give some sort of disclosures. Now what disclosures are required in your annual report? Number one, which method you are using. Now you're using FIFO, LIFO, weighted average. You have to disclose. Second, you have to bifurcate your inventory into three parts. Number one, raw material. Number two, WIP, work in progress. And number three, finished goods. Now what is the significance? This we learn in next LOS. But whatever your inventory is, you have to bifurcate into three parts: raw material, WIP, finished goods. Then, if there has been some sort of impairment, you have to disclose that as well. If there is a reversal of impairment, then disclosure of that. What are the circumstances that led to the reversal of the impairment charges? And if you have borrowed money, with the help of pledging your inventory as collateral, you have to disclose that. That means in totality there are going to be how many disclosures? 8. And one more disclosure in case of US GAAP, that is going to be company, those are using LIFO method, that is going to be LIFO reserve disclosure. which method you are using, then bifurcation between raw material, WIP, finished goods, value of inventory carried at NRV. Okay, then in your profit and loss account, you have to specify what is your COGS, then amount of any written down, the amount of reversals, descriptions of the circumstances that led to the reversals, and the inventory and the carrying amount of the inventory pledged as collateral. Now, for example, you have borrowed the money, and for that you have kept your inventory as collateral. So all these disclosure has to be provided in your financial statements. Now, what is the objective of disclosures? So that I can make a better analysis and to better understand the financial statements. That is why these disclosure requirements are there. Okay, so this is a simple one. Now I'm proceeding to next one. LOS 10 and LOS 11. Now there are three kinds of inventory: raw material, WIP or raw material and WIP. This is one set, and second set is finished goods. So now please help me. You are analyzing the financial statement of a company, and on continuous basis, year-on-year basis, the inventory of finished goods is continuously increasing. Now, earlier the finished goods was of 100 rupee, 200, 700 and so on. They are continuously increasing. What does it signify? It signifies two things. It signifies that demand for your product is continuously increasing in the market. Okay. And second is, it could signify that demand for your product is continuously reducing. Your finished good inventory is continuously increasing on regular basis. Now, as an investor, if finished goods are continuously increasing, it signifies that demand for your product is reducing in the market. So demand for your product is declining in the market. That means we don't want the value of finished goods to increase. You are unable to liquidate your inventory. On the contrary, nothing. If the values of raw material is increasing, inventory value of raw material is increasing, what does it signify? Nothing from this point of view. Now, you are continuously buying, the quantum of your raw material is increasing. So now it signifies that you are going to receive, or you have already received, some big order. The demand for your product, there's going to be some strong demand for your product, or the demand for your product is going to reduce. Now, if the values of raw material are continuously increasing, this estimates that this signifies that management is estimating strong demand for product, or management has received a big order, or management has received some bulk orders. Now, is it a good thing, is it a positive thing, or a negative? Now, increasing the quantity of raw material is important, is considered as a positive sign. On the other hand, increasing the quantity, increasing the value of finished goods signifies the demand for your product is declining. Now, some analysis with respect to ratios. Now, let us assume your inventory balances. Now, inventory balances in comparison to peers should be higher, should be lower. Now, if the value of inventory is higher, that signifies that you are unable to liquidate the goods, And this signifies that it is not a good management of your inventory. That means if inventory balance is high, this signifies mismanagement of inventories. You are unable to liquidate your existing inventories. So there are the chances of the inventory being obsolete or outdated. Okay. Now, is it good to have inventory balance lower? Now, yes, inventory balance lower is a good thing, provided that your sales growth is in line with industry. Provided that your sales growth is in line with industry. But if you're having a lower inventory and there is no sales growth, it signifies that you are not having or you're not maintaining significant inventory to meet the demand from your customers. So again, important one. Inventory balance. Is it going to be higher? Means having higher inventory balance positive? No. It signifies mismanagement of inventory. You are unable to liquidate. That means lower is a good thing. But lower is a positive only in one case, when you are able to meet, when your sales growth is in line with your industry. That means you have a better management with respect to inventory. Okay. But you are having a lower inventory and subsequently your sales growth is less in comparison to industry. It signifies that you are not maintaining significant inventory to meet the requirement from your customers. Now, if inventory would be too high, there is a risk of inventory being outdated. If inventory being too less, that inventory has to be optimum. If inventory being too less, then there is a risk that customer will come to your shop, but you don't have material to deliver. So inventory neither too high, neither too low. High has a risk of inventory being outdated. Low has a risk that a customer visited you, but you don't have goods to meet the requirement of the customer. So lower inventory balance is good, provided that your sales growth is in line with the industry. If it is less than the industry growth, it signifies you are not maintaining sufficient inventory. Okay, now let's go through the notes first. Now, finished goods is growing. If finished goods is growing, there may be the chances potential written down or inventory being outdated. Raw material inventory increasing, that means future demand and higher earning. Same wise, higher inventory days. Higher inventory days means higher inventory signifies slow moving inventory, not good. Low inventory days with low sales growth. That means you are losing your sales because you could not fulfill customers' order. Low inventory days and high sales growth. That means you are an efficient player. Okay, so this was LOS 10 and 11. Now LOS 12. Now LOS 12 says that whenever you are going to make some sort of comparison. Okay, now let us assume that we are making a comparison between HUL and Nestle. Make sure that they are using the same principles. There has to be an apple-to-apple comparison. Now, for example, Nestle is using LIFO. HUL is using FIFO method. Now, you have to convert this to LIFO first and then you are going to make the comparison. So, comparison has to be apple to apple. And my LOS 13 talks about the principle that is consistency. Now, one principle you have adopted. For example, you have adopted that I'm going to follow FIFO method. Now, for all the upcoming future periods, you are going to follow the same method. You are not allowed to change from one method to another. It has to be consistent from year to year. And if you want to change from, for example, FIFO to weighted average, then it has to be retrospective. That means one of the pillars of IFRS was consistent. Once a principle adopted, it has to be followed for all the future year financial statements. And if you want to change, that change is retrospective. Now same goes with US GAAP as well. But one exception. That exception is that when you're going to change to LIFO method, it has to be prospective one. Okay. So how the adjustment would be made? This is out of our syllabus. Okay. So they have only discussed that part. If you want to follow one method, it has to be applied to all the future period earnings, to all the future period financial statements. And if you want to change, it has to be retrospective. One exception under US GAAP is when you're going to adopt LIFO method, then it has to be applied prospectively. So friends, with this, we have covered entire inventories. In totality, there are going to be 13 LOS. And now we have to solve the questions part. Okay. So now what should be our strategy? So before I jump to the questions, first let's revise all the concepts. Okay. And then you have to pause the video, try to solve questions yourself, and then you are going to refer the video part. Okay, so revision is important. Now my first LOS. My first LOS talks about there are two kinds of cost, product, period. Now all the product cost is going to be bifurcated between COGS, inventory, whereas the indirect cost will directly pass to your profit and loss account. Examples of period cost. Example of product cost. All the cost that has been incurred to manufacture the product. Raw material, labor, power, freight inward, storage of inputs, rent of factory. All these are examples of normal waste. All these are examples of direct expenses. Then in totality there are going to be how many methods? There are going to be 3 methods. FIFO, LIFO, weighted average. Now IFRS says that 2 methods are allowed. LIFO is prohibited. US GAAP says all the 3 methods are allowed. Okay. Then there were 2 methods. Okay. Then what would be the impact on financial statements under different method? So point to be noted, answer under weighted average has to be between LIFO and FIFO. Now it's a rising price scenario, you're using FIFO method. So your COGS is going to be lower, your inventory is going to be higher. Then if inventory is higher, inventory days higher, inventory turnover ratio lower. COGS lower, that signifies profits are higher. If profits are higher, ROE is going to be higher. Okay, then there are 2 methods to update your inventory register, perpetual, periodic. Perpetual means on continuous basis. Periodic means after a particular period. Now the answer in case of FIFO would remain same. Lekin the answer in case of LIFO is going to change. Then what do you mean by LIFO? Liquidation. Company is using the LIFO method. It's a rising price scenario and the company stops its production in a particular year. As a result of which gross profit margin in this particular year will inflate. But this inflated margins is an unsustainable one. Eventually from next year onwards margin has to reduce. Then what do you mean by LIFO reserve? Any company using LIFO method has to disclose a LIFO reserve. What do you mean by LIFO reserve? What should be added to the LIFO inventory so that it should be converted to FIFO? This is the meaning of LIFO reserve. Now you want to convert LIFO financial statements into FIFO. In totality, 4 steps. First, let's study the balance sheet. Balance sheet talks from the totality point of view. 3 things. Your inventory value will increase by closing LIFO reserve. Okay, that means you're increasing your assets. Increasing your assets means reducing your expenses. In totality, your profits will increase by closing LIFO reserve. Now this increase has to be divided between government and equity. So you are going to pay higher taxes to the government now, reduce the cash by this amount, and the balance is going to increase your equity part. Now let's talk the P&L. In the P&L, your COGS will reduce by closing LIFO reserve and will increase by opening LIFO reserve. Then maybe your taxes, now let us assume it's have let's assume that your COGS is going to reduce by 20. That means your profit for this particular year increased by 20. It has to be divided between government and equity holder. So this was the way in which LIFO is converted to FIFO. Now, inventory valuation, cost or under IFRS, cost or NRV, whichever is lower, based upon prudence. If NRV is coming out to be answer, that's known as impairment. Now, you're going to reduce your assets. You're going to increase COGS by impairment charges. Now, what is going to be the impact? Inventory will reduce, profit will reduce, our equity will reduce. As a result, inventory days reduce, ROE reduce, ROA reduce, debt equity increases, debt upon asset increases. Does reversal allowed? Yes, maximum to the tune of losses booked earlier. This is in case of IFRS. US GAAP, FIFO weighted average. FIFO weighted average cost or NRV, whichever is lower, but no subsequent recoveries is allowed. But if you are using a LIFO method, cost or replacement, where whichever is lower, where replacement cannot be greater than NRV, cannot be less than NRV minus profit, normal profit margin, and no subsequent write-ups are allowed under US GAAP. So impact we have discussed, disclosure requirements, method you're using, bifurcation, then any reversal, then any sort of impairment, reversal, costs you have to disclose, what are the circumstances that led to the reversal, and then the amount of inventory pledged as collateral. Is it good to have inventory? If finished goods inventory is increasing, that means you're unable to liquidate the goods. The demand is reducing. If RM, the raw material quantities is increasing, that means there are going to be some future demand and higher earnings. Then again, high inventory days, inefficient management. Lower inventory days, lower sales growth. That means you are not keeping sufficient inventory. Lower inventory and high sales growth. That means yes, you are an efficient player. Then always comparison has to be apple to apple. And if you want to change from one method to another, it has to be retrospective, with one exception that if you're going to follow the LIFO method, then it is going to be applied prospectively. So with this, we have revised everything. Now, some exceptions to the above rules, and then we are good to proceed with the questions part. Now, we discussed that a concept of impairment. Now, impairment is inventory will be shown at cost or NRV, whichever is lower. Now, this is based upon prudence. Okay, but there's some exception under IFRS and US GAAP both. That means it won't be applying to these companies. Now, exception. If the company is in the manufacturing of agriculture products, forest products, and mineral products, then in this particular scenario, the formula is you are always going to show inventory at NRV. So you just need to remember the important exception. Companies engage in agriculture product, that means some dairy product, forest product, wood, minerals such as gold, silver. So if you're engaged in these businesses, then you're allowed to show your inventory at NRV. Okay. So this was the only exception. And now let's proceed with the practice problem part. So I request please pause, try to solve yourself, and then only you're going to watch the video. Question number 3. Carrying inventory value above its historical cost would be permitted under. Now it is permitted under if the inventory was held by a producer of agriculture product. So this was the exception. Question 3, answer is A. Now question 5. Which inventory method results in lowest inventory turnover? Now question 5th. lowest inventory turnover ratio. Now lowest inventory turnover ratio means higher inventory balances. Now under which method you're getting higher inventory balance? So we have solved question 4 already. So under that, perpetual LIFO, under perpetual LIFO method, inventory value was 14,500. Okay. Periodic LIFO has an inventory value of 16,000. Periodic LIFO has an answer 16,000. And perpetual FIFO has an answer equal to 13,600. Now you have to find out where the inventory balance is highest. So this is in case of periodic LIFO. Answer is A. Next, if inventory costs are increasing from period to period, a LIFO liquidation will result in. So LIFO liquidation in that particular year will result in increase in your gross profit, but that increase is an unsustainable one. Answer is A. 10th, a company prepares its financial statement in accordance with IFRS. Inventory was purchased for 1 million and later marked down to 5,50,000. Now, one of the books, however, was later discovered to be rare collectible item and inventory is now worth 3 million. Inventory value most likely reported on the balance sheet. Now, you have to consider the principle of prudence. Question number 10th. So, you are having one inventory which you purchase for 10 lakh. And then you return down to 5,50,000. That means what is the impairment charges you have booked earlier? Now earlier you have booked 4,50,000 as impairment charges. Now this book is having a value of 30 lakh. Now the point is, reversal is allowed? Yes, reversal is allowed. Reversal is allowed maximum to the tune of losses booked earlier. Now, reversal would be allowed maximum to the tune of 4,50,000. So again, I'm going to add back 4,50,000. So now, inventory value is going to be 10 lakh. Answer is B. 11th. You purchase inventory and later wrote it down. Impairment. And the current net realizable value is higher than the value when written down. Now, if inventory balance will most likely be, so under IFRS, reversal of impairment charges are allowed? Yes. So now, if inventory balance will most likely be higher if it complies with IFRS. Under US GAAP, reversal is not there. Under IFRS, yes, the reversal is there. Now the current value is greater than. The written down value. Same in this case. Now reversal is allowed. Yes, reversal is allowed. And inventory balance are going to be higher if it complies with IFRS. 12th, a written down of the inventory to NRV will have a positive effect on. Okay. So now if there is an if you're charging an impairment, 12th. So if you're charging an impairment, it's going to reduce your assets. So inventory will reduce. Positive, negative, negative. Inventory reduce. COGS increase. EAT reduce. Equity reduce. So in your balance sheet, equity is reducing, balance sheet is reducing. So have a positive impact over balance sheet. Incorrect. have a positive impact on income statement. Incorrect. Your profits are reducing, but have a positive impact on inventory turnover ratio. Now, how inventory turnover ratio? Why inventory turnover ratio? Now, inventory reduce. So, inventory days will also reduce, and inventory days will reduce. Now, the formula is 365 upon inventory turnover ratio. Now, which ratio is going to increase? Now, inventory turnover ratio will increase. So, what is the formula for inventory turnover ratio? COGS upon inventory. COGS is increasing, inventory is reducing. As a result, this ratio will increase. Answer is C. Now, 15th, 16th, double star. So they are a bit confusing. Now, Z uses FIFO, N uses LIFO method. So there are two companies. Z uses FIFO, N uses LIFO method. Okay. Compared to cost of replacing the inventory. Compared to cost of replacing the inventory. This means that compared to recent cost. Compared to recent cost prevailing in the market. Okay. Compared to the cost of replacing the inventory means cost of recent cost. During the period of rising prices, COGS reported by rising prices. Rising prices. This is FIFO. This is LIFO. Now, first component would be COGS. This would be inventory. Inventory and COGS. Okay. Now, can I say that FIFO inventory represent current cost or the recent cost, and LIFO COGS represent the current cost, so time period. Okay. So now, keeping in mind the time, inventory would be of recent period and COGS would be of recent period. Okay. Now, compared to the recent cost during the period of rising prices, COGS. Now, COGS reported by N, option 1. COGS reported by Z is going to be too low compared to the recent cost. COGS reported by N compared to the recent cost is going to be too high. So option is either option is A or option is C. Now you have to decide answer is A or C. So it's a rising price scenario. Simple. So if a rising price scenario, Z COGS lower and N COGS higher. No doubt in that. But compared to recent cost. So this would be equal to recent cost. Enough, it is going to be equal to recent cost. Now compared to recent cost, Z COGS is going to be too low or N COGS is going to be too high. So this is nothing but equivalent to recent cost. That means my correct answer is Z COGS is going to be too low. So correct answer is A. Now, there is one line written here. FIFO. Under FIFO, the balance sheet inventory represents the recent cost. So, the inventory represents the recent cost. And under LIFO, the cost of goods sold represents the recent cost. So this is nothing but equivalent to recent cost. So Z COGS is going to be too low. Now I want to take one more example. 2 units at 2 rupees per unit. 3 units at 3 rupees per unit and 4 units at a rate 4 rupee per unit. So 4, 9, 16, you have spent 29. There are going to be 9 units. And now you have sold 7. So if you sold 7 under FIFO, COGS, inventory. So you have sold 7, then answer should be 4, 9 and 8. 12, 21 and 8. And under LIFO, answer should be 16, 9 and 4. So this is going to be 25. Okay. The same case. Now compared to recent cost. Your recent cost is 4 rupee per unit. Okay. Now compared to recent cost. FIFO COGS. So COGS is 21 rupee per unit divided by 7 units. It is going to be 3 rupees per unit. So COGS. And here the COGS is 25 rupees divided by 7 equal to 3.57. Now compared to 4. Is it too low? Sorry. Yeah. So compared to recent cost, is it too low or is it too high? So my correct answer is that is going to be too low. So correct answer is Z's COGS too low. You have to compare with recent cost. So compared with recent cost, COGS is going to be lower. Compared with the recent cost, this is nothing but equivalent to, somewhere close to recent cost. So answer is A. Now again 16, same. Z uses FIFO, N uses LIFO. Compared to cost of replacing the inventory, that means compared to recent cost. During the period of rising prices, inventory balance reported by. Now again same. Now inventory balance under Z is going to be high. Inventory value for N is going to be low. But now you are going to compare with recent cost. So compared with recent cost, is it going to be too low or this inventory is going to be too high? So compared with the recent cost, N inventory is going to be too low. So this inventory would be anyways close to the recent cost. Now this inventory is going to be too low. So answer is B. Now next 18th. Compared to weighted average cost method during the period in which prices are rising, current ratio for a company using the FIFO method would be. Okay. Now solution 18. Now it's written weighted, but you have to read like LIFO. So LIFO or weighted average. Okay. And this is FIFO. Okay. Now it's a rising price scenario. So rising price scenario, this is going to be your COGS. This is going to be your inventory. So under FIFO, inventory is higher during the period of rising price. Inventory is higher, that means assets are higher, that means current ratio is higher. Current asset is higher, so current ratio is higher. Okay. Now, compared to using the weighted average, during the period of rising, the current ratio for a company using FIFO, would most likely be higher. Now any day under weighted average, inventory balance has to be lower than FIFO. And if inventory balance is lower, that means your current ratio is going to be low. So my answer is B. Again, you are using FIFO. Now, if you are using FIFO, your inventory balance is going to be highest. Now, if inventory balance is going to be highest, your current ratio is going to be higher. Any day, inventory value for weighted average has to be less than this value. Now, in the last example, you got an inventory of 8 under FIFO. Okay. Hadn't been I'm using weighted average, my inventory is going to be 29 divided by 9 into 2. 29 divided by 9 into 2. So it is going to be 6.44. So my inventory value is higher. Inventory value higher means my current ratio is going to be higher. So friends, important, whenever you're finding these kinds of questions, I strongly recommend that first try to solve with the help of graphs. If you're unable to solve with the help of graphs, then assume some arbitrary numbers, put in the values, and then you will get the correct answer. So my answer for 18th is B. Now 19th. Z wrote down the inventory in 2017 and reversed the write down in 2018. Now compare to the ratios that would have been calculated if written down had never happened. Z reported 2017 dash. Okay, now what is happening? Solution 19. Now in 2017, there is some impairment charges on account of which you have reduced your inventory's value. So inventory reduce. Now if in 2017 there were no impairment, then your inventory balance is going to be higher. Okay, now let's read it again. Compared to the ratios that would be calculated if written down never occurred. Z's reported 2017. Okay, now you have to make comparison. These are impairment charges on account of which inventory reduces. So if inventory reduces, current ratio will reduce, where current ratio is equal to current asset upon current liability, and one of the component of current asset is inventory. So current ratio will reduce. A is incorrect. Now inventory will reduce, expenses will increase, as a result profit will reduce. So gross profit margin was too high. Incorrect. Gross profit margin too low. So it has to be too low. It's written too high. And third point is inventory turnover was too high. Now inventory turnover. Inventory days reduce. Inventory days reduce. As a result, inventory turnover ratio would increase. So my correct answer is C. Now in 2017, impairment occurred. As a result, you reduce your inventory. Your current ratio will reduce. Your profits will reduce. But one ratio is going to increase. That ratio is going to be inventory turnover ratio. Now 20. Z write down its inventory in 2017, reverse the write down in 18. Compared to the results would have been if write down had never occurred. Z's reported 2018. Okay, so 20. Now what is happening in 20? So in 18, there is a reversal. Okay. Now once there is a reversal, you are going to increase your inventory back to the same level. So inventory balance will increase. back to the same level. Your COGS will reduce and profits will increase. But maximum your inventory value can increase to the previous year value. Okay, now let us assume that you have an inventory worth 1 lakh impaired to 6 lakh. That means you have a written down to 6 lakh. That means impairment charges of 4. Now again you want to reverse. So maximum that inventory can reach. No, sorry, I skipped. There's an inventory of 1 lakh. You written down to 40,000. So impairment charges of 60. And now again there's a reversal. So maximum reversal would be to the tune, again that inventory value will increase to 1 lakh. Now my point is important. Now A or C, profits are overstated or year-end inventory balance overstated. So can inventory be overstated? Can it breach the level of 1 lakh? No. Maximum reversal would be to the tune of 60,000. So it cannot breach that level. So inventory balance overstated, incorrect. But one thing is going to be overstated, that is going to be the profit for that particular year. So what happened in 2018? Reversal. You are going to reduce your COGS, your profits will increase. So as a result, profits for that particular year is going to be overstated. But inventory cannot be overstated. Maximum inventory can reach that level. So overstatement word is incorrect. Okay friends. Now I'm not proceeding further. So the remaining questions I'm going to solve in the next part. Okay, thank you. Now friends, in this part I'm going to solve all the remaining questions, and I'm going to discuss one concept, that is with respect to specific identification. Okay, so by mistake I have skipped this one. So with the help of one of the practice problem, I'm going to discuss this as well. Okay, so again this going to be is an optional one. Okay, only if you're unable to solve any of that question, you have to directly jump to that particular part. Okay, so I'm starting with 21st. Compared to a company that uses FIFO method during the periods of rising prices, a company that uses LIFO will most likely appear. Okay, now answer is not going to be A. So either they're talking about profitability or efficiency. Now solution 21. So either efficiency or profitability. If COGS is lower, that means you are going to be more profitable, and if your inventory days is lower, that means you are efficient. So COGS lower, more profitable. Inventory days lower, that means you are more efficient. Now it's a scenario of rising prices and we are using LIFO method. Rising price, LIFO method. Here this particular component will be transferred to your COGS and this particular component will be transferred to your inventory balance. My COGS is higher, so profitability is going to be lower. My inventory is lower, that means lower inventory days. It signifies that I'm going to be more efficient. So having lower inventory days is a better thing. So ratios will signify the efficiency part. Having lower inventory days signify that you're more efficient. Answer is B. 22nd. A company uses LIFO method during years in which inventory unit costs are generally rising and in which company purchases more inventory than it sells. So 22nd. scenario of rising prices. You're using LIFO method, and now question specifically says you purchases more purchases than unit sold. So if your purchases is more, this purchases is going to be at a higher price. This component is transferred to your COGS. Now you have to comment. Your gross profit will most likely be lower, higher, or remains the same. Rising price scenario, you purchases more, you are using LIFO method. So this particular component will be transferred to my COGS. Your COGS is higher. If COGS is higher, my profitability is going to remain lower. Answer is A. 23rd. Compared to LIFO method, during the periods of rising prices, a company using LIFO will most likely report higher. 23rd. Periods of rising prices, your company is using LIFO method. COGS are going to be higher. Inventory is going to be lower. Now, higher COGS signifies lower profit. A is incorrect. Then cost of sales is nothing but cost of goods sold. You are going to report higher. You are going to report higher cost of sales. Answer is B. 24th. A company uses US GAAP whereas J uses IFRS. It is least likely that. Okay. So now under US GAAP, solution 24, under US GAAP, it was not allowed that write-ups are not allowed. Okay. So now let's go through all the options. Reversal of written down. Okay, J has reversed, that is allowed. J and C both have uses FIFO method. So C is possible, B is possible. But option A is not possible. Why not possible? Because under US GAAP, reversals of impairment is not allowed. So my correct answer is, it is least likely that the company using US GAAP have a reversal of impairment. Answer is A. 25th. A company uses US GAAP, B IFRS. Which of the most likely to be disclosed on the financial statements of both the companies? Okay. Now to answer this, remember, under IFRS, LIFO method is prohibited. Okay. So now, any material income resulting from liquidation of LIFO, incorrect, because LIFO is prohibited under IFRS. Disclosure is not going to be there. And go through C. The circumstances that led to the reversal of written down. This is, which are the following? So see, the circumstances that it led to the reversal of written down. So under US GAAP, there is no reversal. So C is not going to be there in case of a company using US GAAP. A cannot be there in case of a company using IFRS. So which particular disclosure would be in case of both the companies? The amount of inventories recognized as expense during the period. That means in your P&L, you have to specifically specify what is your COGS. So this disclosure is going to be there in case of both a company using IFRS and US GAAP. 26. Which of the following is more signal that companies expect demand for its product to increase? It is going to be in only one case, when your raw material and WIP is increasing. If finished goods is increasing, that means demand for your product is declining. Okay, now A, B, C. Finished goods inventory growth rate higher, that means demand for your product is reducing. So 26th A is incorrect. Then higher unit volumes of WIP and raw material. Yes, so it signifies that the demand for your product is increasing, or you are anticipating some bulk orders. So answer is B. Then 27th, again the options are efficiency or profitability. Okay, so if your gross profit margins are improving, so profitability, and if your inventory days increasing, reducing, that will be over your efficiency. Now 27th, compared with a company that uses FIFO method during the period of rising prices, your company uses LIFO. So I'm using a LIFO method. Rising price, LIFO method. This component is COGS. This component is inventory. So I think it is similar one. So COGS are going to be higher, profitability lower. Inventory days are going to be lower. Lower inventory means lower inventory days. That means you are better efficiently managing your inventories. Answer is B. Then 28th, in the period of declining inventory cost, declining price scenario, and which of the following will result in higher debt to equity ratio? 28. So hint, answer is not going to be weighted average. Why? Because weighted average would always be fall between LIFO and FIFO. So FIFO, scenario of declining prices, LIFO, declining prices, COGS, inventory, COGS. Okay, so let's start with FIFO. Now your COGS are higher. Your COGS are higher means profits lower, and lower profits means lower equity. Lower profits means lower equity. Debt is constant. Now debt upon equity, since equity is lower, that means debt to equity is going to be higher in case of company using FIFO method. So which company will most likely result in higher debt equity? Answer is B. So answer has to be between A and B. Either it's going to be FIFO or LIFO. Okay, weighted average would not be an answer. So in my case, answer is FIFO. Now LIFO, COGS is lower. COGS is lower means profits are higher. Profits higher will means eventually equity will increase, because these profits will belong to equity holder. Equity higher, debt constant. Now equity higher will eventually reduce debt equity ratio. So answer is B. 29th, you have to compute total cost. Point to be noted, we are going to include only the product cost and going to exclude the period cost. Okay, so you purchase 1 million units at 20.20. Now you receive some discounts. So discounts are going to reduce the price. So you receive some discounts minus import and some sales tax add up. Transportation, insurance. This is, I'm talking about transportation means freight inward. Okay, so freight inward 325. Then storage of finished goods. Storage of finished goods. Now storage of finished goods is not a product cost, it's a period cost. Ignore this. Warehouse administration expenses, admin expenses. We are going to ignore the admin expenses. So from my point of view, only first three components are important. So let's solve question number 29. Only relevant is going to be product cost. So you purchase 1 million unit, each costing 20.20. So my answer is 1 million multiplied by 20.20. Now I want an answer in terms of thousands. Okay, So whatever the answer is, divide by 1000. So 20,200 in terms of thousands. So how I computed thousands? Divide by 1000 simply. Then you receive some discounts, so minus that. Then there is a some import excess, add up. Transportation 325. Now these are only the relevant cost. Add up. Minus 404 plus 2970 plus 325. Answer is 23091. Note: ignored period cost such as storage, cost of finished goods, and admin expenses. So this will directly be transferred to your profit and loss account as other operating expenses. 30th. So my answer is B. 30th. The method. Now there is one method that we forget to discuss is specific identification. Now what do you mean by specific identification? Now let's assume that there is a painter and he has designed some paintings. Painting 1, painting 2, painting 3. Now these are the inventory from the point of view of a painter, and each inventory is unique in itself. Now let's assume that this having some X selling price, Y selling price, Z selling price, and it's unique in itself. Now in this particular case, where there's no mass production, okay, then we are going to use specific identification. Now let's assume that for this designing this painting, he incurred a cost of 100 rupee. I'm just using hypothetical numbers. 200 rupees and 300 rupees. Now this painting is sold during the period, and this one is still in the inventory. So my inventory cost is going to be 600. Specific identification. Whenever they are going to be sold, they will be transferred from your inventory to your COGS. Okay, so specific identification. This method is used only in those cases where we are not dealing with mass production, we are dealing with tailor-made products, okay, or high-end products. Then the better method is going to be specific identification, or where each item is unique in itself. Okay. Now 30th. The method used by a high-end customized motorbike, that means tailor-made as per your requirements, to value the inventory in the matching of physical flow of a particular item sold. That means specific identification. Now which method you are going to use? That is going to be specific identification. So where we use specific identification? Number 1, the product is unique. That is tailor-made as per the requirements of the customers. Second, the quantities. Now typically here you won't find mass quantities since the product is tailor-made. So few quantities during the year the company manufacture. So this is a hint that you have to use the specific identification method. Okay. 31st, a company uses LIFO, reports a LIFO reserve which is 20,000 lower than the prior period. If the company had used FIFO, financial statements would most likely report a. Now first, if you are translating LIFO to FIFO, so you have to increase your inventory by LIFO reserve, by closing LIFO reserve, that is 85,000. So your inventory balance has to be higher. Now my answer is B or C. 31st. Now to convert your balance sheet you have to add 85,000 to your inventory balance. That means at any given day, my inventory balance is going to be higher. Okay, now what would be the impact over your COGS part? So you're going to reduce your COGS for the period by 85,000, and which is 20,000. Now the opening LIFO reserve, you have to add the opening LIFO reserve, which is 20,000. Now year-end LIFO reserve of 85,000, which is 20,000 lower than the prior period. That means in prior period I was having a LIFO reserve of 85,000 plus 20, 1,05,000. So this is going to be the impact over the COGS. So nutshell, you are going to reduce nutshell. Now let us assume that this is X. So you will reduce, or nutshell, in net, you will increase your COGS by 20,000. Now COGS increased by 20. So if COGS are increased by 20, so my answer is B. Both a higher COGS and a higher inventory balance. So my inventory balance will increase by 85,000 and my COGS will increase by 20,000. So answer is B. 32. The following information for a company was taken from its financial statements. Okay. Now 2013-14. Inventories were reported on LIFO method. The LIFO reserve was 867,547 at the end of 2014 and 13. During 2014, company liquidated certain inventories that had been carried at lower cost in prior period. So this is nothing but LIFO liquidation. And the effect of liquidation was to decrease COGS by 263. No liquidation occurred in 2013. After adjusting the impact of LIFO liquidation, what would be change in your gross margins? Okay, so what happened? Solution 32. So first you have to compute your gross margin for 2013. Net sales 8895, COGS 7901. That means gross profit is equal to 8895 minus 7901, 994, and your gross profit margin in percentage terms is equal to 11.17%. Now 2014, what happened? So your sales is 11159, but you liquidated more. Okay, so when you liquidated more than you manufactured, what happened? Your COGS reduced by 263. But this is a one-time event, okay, as a result of which your gross margins has inflated. Now I want to make an adjustment for this particular impact. So you have reduced your COGS by 263 because of LIFO liquidation. So now I'm going to increase COGS to have a reversal of this impact. Now I'm going to increase COGS by 263. Now my revised gross profits would be for 2014 11159 minus 9898 minus 263, that is 998. Revised margins is 8.94. Now compare to 2013, after the adjustments, your margin in 2014 is going to be, so your margin is lower by how much? Lower by 2.23%. So my answer is C. So you have to make an adjustments. So here your COGS has reduced on account of LIFO liquidation. So reversal, add up 263 your COGS and compute the revised gross profit margins. Answer is C. Next, 33. Okay. So friends, for 33, please put a note that it is talking about some deferred tax liability. So as of now, I'm unable to solve this, but this we are going to cover post income taxes. So there's going to be one more reading based upon income taxes. Post that, you will be in a position to solve 33 as well. Okay. So as of now, I'm skipping 33. I'm moving to the next one, 34. Now, during the period of rising cost, company decides that it changes inventory method from FIFO to weighted average. Under weighted average, which of the following will most likely be higher? Okay, now 34th. So FIFO method, scenario of period of rising prices, COGS and inventory. So if I'm using FIFO, my COGS are going to be lowest and my inventory is going to be highest among all the three methods. Okay, so if I compare FIFO, LIFO and weighted average, COGS in FIFO is going to be lowest and inventory in FIFO is going to be highest. That means under weighted average, if I use weighted average, COGS in comparison, COGS value in comparison to FIFO is going to be higher and inventory is going to be lower. Now let's take some simple example. 2 at the rate 2, 3 at the rate 3. In totality, there are 5 units for which I have spent 13 rupee. Now I say I sold 2 units. So if you sold 2 units, then using FIFO, COGS is going to be 4, inventory is going to be 9, but under weighted, your COGS inventory, your COGS is going to be 13 divided by 5 multiplied by 2, that is 5.2, and inventory 13 divided by 5 multiplied by 3, that is 7.8. Now your COGS is going to be higher and your inventory is going to be lower. Now, so if my inventory is lower than my current ratio, so current ratio is current asset upon current liability, and one of the current asset is inventory. So your inventory is lower. So inventory is lower, current ratio is going to be lower. A is incorrect. B, inventory days. Inventory lower, that means inventory days are going to be lower. So B is incorrect. Now C, COGS higher. COGS higher means profits lower. Profit lower means equity lower. Equity reduce, debt constant. As a result, debt equity ratio will increase. So which is going to be higher than under FIFO? That is going to be C. Next, 35th, under US GAAP, which of following is least likely to be a disclosure? Okay. Now remember, under US GAAP, reversals of impairment is not allowed. So the amount of reversal of any written down of inventories is not going to be there. C. 36th, in the notes to the company's financial statement, the note detailing with the inventory indicates the following. Inventories are stated at cost, stated at the lower of cost or market, with cost determined using LIFO. Now important, no LIFO liquidation occurred from 2012 to 14. Now what is the meaning of these statements? 36. You are using LIFO method. No liquidation occurred given in the question. No LIFO liquidation occurred. And now the statement concerning LIFO liquidation was most likely means that for the stated period. Now what is happening for the stated period from 2012 to 14? Okay. Now hint is no liquidation occurred. No liquidation occurred means company manufacturing. So what do you mean liquidation? So liquidation means company selling more than produce or manufacture. So here company manufactured more and sold less. So this is one of the conclusion that we can draw. Okay. It's a rising price scenario. Okay. Now A, B, C units manufactured or purchase equal or exceeded unit sales for each year. Can we draw this conclusion? Yes. So specifically it is given that no liquidation occurred. So no liquidation occurred means company manufactured more and sold less. So my answer is A. Okay. Yeah. Moving to the next one. 37 we have done. 38. Because with a problem in the production process, a manufacturer produced a batch of defected goods with a cost 18,000. The sales value of this batch in the current scenario is 6,000. Okay. Now 38. So you manufacture one defective product where you incurred a cost of 18,000, and in the current scenario it can be sold for 6. So incurred a cost, and now you may get, if you sold this, you may get 6,000. Okay. With 3,000 of additional processing, this batch could be sold for 11,000. Okay. Now if you make some additional processing, this is current scenario, current condition, and with additional processing need to spend 3,000 and you will get 11,000. Okay, so that means collectively if you spend 3,000 then you may get 5,000 extra. So will the manufacturer or the producer will do the additional processing? So if incur 3,000 rupees extra, you will get 5,000 rupees extra. Okay, so now with additional processing you have to incur this 3,000 extra, but this 3,000 extra will eventually increase your selling price by 5,000. So it makes sense that you do the additional processing. Okay, so now this is irrelevant. So if you do the additional processing, 3,000, you are going to get 11. The value of unsold inventory on the balance sheet using IFRS is going to be, so under IFRS, inventory will be shown at cost or NRV, whichever is lower. So cost incurred is 18,000, or now I can sell this for 11. But to sell this for 11, I have to spend 3,000 extra. That means net how much I'm going to get extra, how much I'm going to get by selling of this particular product additional, that is 11 minus 3, whichever is lower. Now 18,000 or 8,000, whichever is lower. So inventory will be shown at 8,000. So this amount is not spent yet. Okay, hadn't been it spent, then it will be added to my cost part. So I have not spent this particular amount yet. So now how much I'm going to get by selling of this product additionally? 8,000 or 10,000 or 18,000, whichever is lower. So my answer is 8,000. 39th, least likely to be included which of the following? Okay, now important. Which method you are using? FIFO, LIFO, weighted average, you have to disclose. Amount of inventory pledged as security for taking up the loans has to be disclosed. Now, what disclosure is not required? So this is a mandatory disclosure. Amount of inventories pledged as security, a mandatory disclosure. But yes, A is not a disclosure requirement. Types of inventory. Now in your inventory, what you are having? Types of inventories. This is need not to be disclosed. Okay. Now 40. Cost, total cost. Again, you have to consider the product cost. You have to ignore the period cost. So raw material included. Storage of finished cans excluded. Wasted aluminium material from abnormal production errors excluded. Transportation in, freight in included. Tax related duties included. Administration overhead, admin expenses excluded. Trade discounts to be included, because of these discounts your purchase cost will reduce. So this is going to be considered. Now what should be the total cost? 1,50,000 plus 640 minus plus 340 minus 520. Answer is 150,460. Answer is B. Point to be noted, because of trade discounts, your purchase price will reduce. 1,50,000 plus 640 plus 340 minus 520. Answer is 150,460. 41. Now point to be noted, though dates are given, but these dates are irrelevant. Now why irrelevant? It's specifically given that you are using a periodic inventory. Now what is the meaning of periodic inventory system? You are going to update your inventory register after a particular period. Okay, so these dates are anyways not irrelevant. 41. So you have a opening inventory 1 ton and price per ton is going to be 600. Okay, then you purchase additional 5 ton for 650 rate. Then additionally there is a purchase of 3 ton at the rate 680. So collectively during the period you have purchased, now you are having 9 tons of inventory. Out of this 9 tons you have sold collectively 6 tons. So out of 9 you have sold 6 tons. Now you have to find out COGS by using all the 3 methods. Okay, so number 1, I'm going to start with FIFO. So as per FIFO, I have sold 6. So that 6 is going to have a cost of 1 multiplied by 600, 5 multiplied by 650. Then weighted average, and finally LIFO. So as per LIFO, answer should be 3 into 680 and 3 into 650. So solve this This is going to be 600. 650 multiplied by 5, 3250. This is 3850. Then 680 multiplied by 3, 2040. 350 multiplied by 3, 1950. Summation is 3990. Okay, now I'm not solving for weighted because anyways weighted answer has to be between 3850 and 3990. So let's check the option first. So options are number 1, 5890 using weighted average. This option is incorrect. It has to be between these two values. So A, incorrect. B, 4080 using LIFO, incorrect. And last one is 3850 using FIFO. So answer is C. Next, 42. Company is using FIFO method. Now it's a perpetual. Perpetual means now these events are important. Okay. If the company use a perpetual system versus a periodic, gross profit margins would most likely be now important. You're using a FIFO method. So under FIFO, whether it's a perpetual or periodic, your answer is going to remain the same. Okay, so what will be the impact over your gross profit margins? So my gross profit margins is going to remain same. So I need not to solve. Okay, so be it be perpetual or periodic, under FIFO, answer is going to remain the same. Inventory value COGS. So that means your gross profit is going to be same if you're using a FIFO method. Next, 43. In the period of rising prices, which inventory method will most likely result in highest inventory turnover ratio? So B is not an answer, either A or C. 43rd. Which will result in highest inventory turnover ratio? So highest inventory turnover ratio means lowest inventory days or lowest inventory. Now which one have the lowest inventory? Rising price scenario. COGS, inventory, this is going to be FIFO. Inventory, COGS, lowest inventory. So lowest inventory would be in case of LIFO method A. 44th. If the company is using IFRS instead of US GAAP, its COGS is most likely. Okay. Now we are going to value the inventory at cost or NRV, whichever is lower. Whether it's a US GAAP or it's a IFRS, it's going to remain the same. Okay. Only the difference was in case of LIFO. But LIFO does not exist. The LIFO does not exist in case of IFRS. Now, if the company is using IFRS instead of US GAAP, this means, okay. Now, anyways, it's specifically given that the company is using FIFO method. Now, under FIFO, be it be IFRS or US GAAP, how you're going to value the inventory, cost or NRV, whichever is lower. My cost is 4.3. My NRV is 4.1. So I'm going to value the inventory under both these scenarios at 4.1. So if the company is using IFRS instead of US GAAP, its COGS will most likely be A, B, C. So my answer is going to remain same. Answer is C. 45th. Now you are concerned about the liquidity. Now liquidity means, now let us assume that a company is having inventory worth, now let's assume that company is having a huge inventory. Okay, and now you're concerned about liquidity. Liquidity means whether company will be able to liquidate this or not. So now first look at the components. Raw material, WIP, and then finished goods. If 90% of the inventory is in the form of finished goods, then yes, it's a concern. Yes, why it's a concern? Because if your finished goods are if your finished goods are piling up, that means eventually you may not be in a position to liquidate this. The demand for your product is declining. So if finished goods are keep on increasing, that means yes, it's a concern with respect to your liquidity. Okay, now I'm concerned with liquidity. So which component should I look into? Now, amount of inventory recognized as expense. This is COGS. It will not tell anything about liquidity. Cost formula or inventory method, FIFO, LIFO. And final one is breakdown between WIP and finished goods. So if finished goods are increasing, that means tomorrow, yes, there could be a problem with respect to liquidity. On the other hand, if major component of your inventory is in the form of RM or WIP, let's assume 95%, then yes, it is not a concern, because eventually once goods will be manufactured and you will be able, increasing raw materials demand for your product is increasing, so liquidity is not a problem. So if I'm concerned with liquidity only, then which component I should look into? That is the breakdown of inventory. Okay, now 46th double star. Okay, now my opening reserve is 4,20,000. My closing reserve is 4,50,000. Now, company, if you use FIFO instead of LIFO, you have to compute your net income. 46th, important, double star. Now, COGS as per FIFO is going to be COGS as per LIFO minus closing LIFO reserve plus opening LIFO reserve. Now COGS as per LIFO is not given, so let's assume this is X minus 4,50,000 plus 4,20,000. So in simple COGS under FIFO is lower by 30,000 in comparison to COGS by LIFO method. So your COGS under FIFO is lower. That means your gross profits are going to be higher by 30,000. Your EBT is going to be higher by 30,000. And now you're given with a tax rate of 30%. So this increase of 30,000 has to be divided between two persons, one belonging to equity, one belonging to government. So your taxes will increase by 9,000 and your EAT will increase by 21,000. So the net income would most likely be, your net income would most likely be 21,000 higher. Okay. Now which of the following method matches the actual historical cost to their physical flow? Actually matches the historical cost. Now that is only possible in case of one method, that is going to be specific identification. Now under specific identification, if I am having 3 paintings in my inventory, so all of them have this specific cost. I'm not using a single formula for all of them. So if this painting cost me 100, 200, 300. Now if tomorrow this painting is sold, then I'm having in my inventory as 300. So specifically I'm identifying. Now which of the following best matches the historical cost of the inventory sold to their physical flow? So under specific method, when this particular inventory is sold, then this is going to be transferred to your COGS. So this is the best match to the actual historical cost. That's only possible in one case, that is going to be specific identification. Next, 48th, company uses LIFO but most of the other companies using FIFO. To best compare the companies with competitors, which of the following adjustment are required to ending inventory? So in the ending inventory, I want to convert this to FIFO. You have to add closing LIFO reserve. So my answer is A. Now 49th. Based upon the following conclusion, so some selected information is provided, and now you have to comment whether option A, B, C is correct. Now A, company faces a strong possibility of future write-downs. So future write-downs possibility would only be there if finished good inventory is increasing. Now last year your inventory was 296, increased to 410. So A could be correct. Okay, now C, management anticipates a strong increase in product demand. So if you're anticipating a strong demand, an increase in demand, then ideally your raw material or your WIP should increase. So WIP is reducing from 141 to 125. So sorry, RM is reducing from 141 to 125. WIP is reducing from 240 to 230. So C is incorrect answer. Okay. Then there is one more word, valuation allowance. Now what is the meaning of this valuation allowance? So this valuation allowance is nothing but an impairment that in the past impairment had happened. Okay. So earlier in 2013 there is an impairment of 118. And then in totality in 2014, there is an impairment of 133. So impairment has occurred in the past. So now prices of supplies increase sufficiently. That means the price for your product is increasing. So if the price for your product is increasing, then valuation allowance would be appearing here? No. So important. Which one is the correct answer? C is saying anticipates a strong demand in the product. If this is the case, then the raw material and WIP inventory should increase. So C is incorrect. Prices of supplies increase significantly. Then valuation allowance should not be there. There should not be any sort of impairment in 2014. But yes, there is an impairment. So B is incorrect. Now the possibilities of future write-downs. This only be in case where the finished good inventory is increasing. So in this case, my inventory is increasing from 296 to 410. So correct answer is A. Next, 50th. Again, product period cost. So you have to identify only the product cost. Fixed overhead, production overhead, yes. Raw material, yes. Labor, yes. Freight inward, yes. Warehousing cost for finished good, you have to ignore this. 3 plus 6, 9, 10, 14. Answer is A. Next, using periodic system and weighted average, you have to find out the ending inventory. 51. So first purchase is at 1000, where the rate is 22.5 per unit. Then again you purchase 800 at the rate 25 per unit, and last is 400 unit at the rate 25.50 per unit. You have sold 1700. So in totality this is going to be manufactured or purchased 2200 units, sold 1700. That means your inventory is 500. You have to find out the value of this 500 inventory using weighted average method. So let's sum up. 22500, 25 multiplied by 800, 20,000, and 25.5 multiplied by 400. 10,200. Summation. Answer is 52,700 divided by 2,200. So my per unit cost is 23.95. So my inventory value is 11977. So answer is A. 52. Okay. Now during first 2 years of operation, so this is the data that you are having. You purchase 80,000 at 10, then you have sold 75,000. Print selling price is anyways irrelevant. And then you purchase 65,000 at 8 and sold 55,000. In year 2, your inventory turnover ratio is 3.67 using year-end inventory. So not to use average, you have to use year-end inventory. And now you have to find out which method you were using, FIFO, LIFO or weighted average. So 52. So first I purchase 80,000. Now let's solve it using FIFO. So I purchase 80,000 at the rate 10 per unit. Sold 75. So this is purchase, sold 75. Now you are left with 5,000 unit at the rate 10 per unit. So this is my opening value for year 2. So this value is going to remain same whether you are using FIFO, LIFO or weighted average. Okay. Now this is the opening value inventory. And again you purchases 65,000 at the rate 8 rupee per unit. Collectively you are having 70,000 unit, out of which you have sold 55. Now sold 55. So this is important. You have sold 55 in such a way that inventory turnover ratio is coming out to be 3.67 using year-end inventory. Now this is the answer. You have to identify which method you are using, FIFO, weighted average or LIFO. So now first assuming that it's a FIFO one. So if it is a FIFO, then equal to, the formula for this is equal to COGS upon closing inventory. And if I'm using FIFO method, then my COGS should be, you have sold 55. So that 5,000 is going to be from first lot and remaining 50,000 would be from second lot. And eventually I'm left with 15,000 unit. This 15,000 unit would be from the last lot. So 15,000 multiplied by 8. Solve this. If you're getting 3.67 as your answer, then yes, the company is using FIFO method. So 50,000 plus 4 lakh divided by 1,20,000. So 4,50,000 divided by 120, 3.75 not equal to 3.67. So that means answer is not FIFO. Now assume that it's LIFO. Inventory turnover ratio is equal to COGS upon closing inventory equal to, you have sold 55,000. I'm using LIFO method. Now assume that 55,000 would be from this lot. So 55 multiplied by 8. Divided by 15,000 I'm left with. So 10,000 at the rate 8 plus 5,000 at the rate 10. 5,50,000 into 8. This is 4,40,000 divided by 50 plus 80, 1,30,000. 3.38 not equal to 3.67. Okay, so now we can prove that need not to solve the third one. Answer is weighted average, but let's solve it that as well. Okay, so in examination we not to proceed. Okay, so your answer is weighted average. Now let's prove me that with weighted average I'm getting this answer. Inventory turnover COGS upon closing inventory. Okay, now what is my weighted average cost is coming out? 50,000, then 65,000 multiplied by 8, 5,20,000. Submission is 5,70,000. So what is your per unit cost? 570 divided by 70,000. 8.1428. This is your weighted average cost. Okay, so equal to, you have sold 55,000 multiplied by 8.1428. you're left with 15,000 multiplied by 8.1428. if I solve, answer is 3.67. So using which method the company was computing the inventory? That is going to be weighted average method. Answer is C. Next, 53. A company prepares in accordance with IFRS financial statements, wrote down inventory by 20,000 at the end of year 1. So impairment charges 20,000. In year 2, the prices increase and the same inventory was worth 30,000 more than its value. So now there's going to be a reversal, but reversal would be maximum to the tune of, keeping in mind the principle of prudence, would be maximum to the tune of 20,000. So your COGS will reduce by, in year 2 you are going to reduce your COGS by 20,000. This 20,000 is known as the reversal of impairment, and under IFRS, yes, it is allowed to reverse the impairment charges. 54th. A company prepares its ending inventory using the prices of most recent purchase. So under which method inventory represent the recent cost? So under under FIFO, whatever has been purchased first, that has been liquidated first. That means whatever the inventory, that inventory represent the recent purchases. So ending inventory represents the recent purchases. This is under FIFO. Hadn't been written COGS represent the recent purchases, then that is going to be LIFO. So my answer is FIFO. Answer is A. Then one reason that LIFO is widely used in US. Now why US company use the LIFO method? So by default there are going to be some inflation in the country. That means in majority of the cases it's going to be a rising price scenario. Okay, so now if it is a rising price scenario, LIFO, this will be your inventory, this will be your COGS. So that means your COGS is going to be higher. If COGS is higher, your gross profits will be lower, your EBT will be lower, and eventually taxes to be paid to the government is going to be lower. That means under US using a LIFO method is beneficial. Why? Because eventually this is our assumption that it's a rising price scenario, and by default it is going to be in economy. Okay, so it's a rising price scenario, and now the costs which are going to be transferred to your income statement, they are going to be higher. Which results in lower profit. Lower profits eventually results in lower taxation. So it is going to reduce my tax liability. This is one of the reasons why we follow LIFO in US GAAP. Now we follow LIFO in US. Now my point is, your taxes are going to be lower. Okay, now options. Results in higher profits, incorrect. Is available under both US GAAP, IFRS, incorrect. Results in higher operating cash flows. Now how it will result in more cash flows in the hand of the company? You are paying lower taxes. Lower taxes means eventually you are getting higher cash flows. You are generating higher cash flows from this particular business. So this is the reason that why in US most company prepared in accordance with LIFO method. Okay. Now 56th, a retailer prepare its financial statement in accordance with IFRS with 100 chairs inventory with a retail price each. So I'm least bothered with the retail price. Okay, for which supplier has paid a average 200 rupees a chair. 56. $100 office chairs you have purchased at a price $200 a chair. Demand for chair has been quite low for a while, and in response the supplier has lowered the selling price to 160. Okay, you purchase at 200 and now because of the lower demand your selling price is 160. However, the retailer estimates that it can sell the chair for 180 each if it offers free shipping to its customer, where the shipping cost is going to be 10. Okay, now there are two scenarios, either to sell for 160 or to sell for 170 net NRV. Selling price 180 minus selling cost 10 rupee, that means net you can sell at 170. Now you are having two options. In order to maximize, a prudent businessman will always sell at. So a prudent businessman would always sell at this particular value. Now you have to find out the carrying value of these 100 chairs in the balance sheet. Okay, so it's going to be cost or NRV. Now NRV means maximum value that you can get for your product, whichever is lower. My cost is 200 or 170. Now keeping in mind that you are a rational businessman, then you will sell at 170, whichever is lower. So 170 is lower. So the carrying value of your inventory should be 170 per chair. In totality, you are having 100 chairs. Answer is C. Okay, so what is the meaning of NRV? NRV means maximum realizable value for your product. 160 or 170. That is 170. Now 200 or 170, whichever is lower. So 170 is lower. 30 rupees is going to be impairment charges per chair for this particular company. So my answer is C. Next, double star. 3 companies in the same industries are identical. Okay. However, how they account for inventory. One uses FIFO, another uses LIFO, and the third one uses weighted average. Although the industry experienced increasing prices, okay, a recent technological breakthrough has substantially reduced the values of companies' inventories, which will face, and each company will face inventory written down. Which of the reporting method will most likely lead to smallest write down? Okay, so answer is going to be FIFO or LIFO. Weighted average is not the answer. Okay, rising price scenario 57. Rising price scenario. Now first let's compute for FIFO. This is going to be COGS, this is going to be inventory. Now using FIFO, your inventory value is highest. Using LIFO, your inventory value is lowest. And now there has been a decline in the demand. There's some technological breakthrough, because of which there is a possibility of write downs, where the write down would be smallest. Now let's assume that here the inventory value is 500, here the inventory value is 100, and now we have to write down the inventories to 70 rupees or 260 or 230 rupees. So in case of LIFO, write down is 70, here the write down is 470. So where the write down is going to be minimal. So write down is going to be minimal in case of LIFO. Okay, 58th we have already covered, 59th already covered. So friends, with this we have covered this reading. Okay, now which concept is the most important one? That is rising price scenario, declining price scenario. What will happen in each of the three inventory methods? Highly testable one, important. Second, if I want to convert from FIFO to LIFO, then from LIFO to FIFO, then what are going to be the changes in the balance sheet and your P&L? So these two concepts I think are highly testable. Okay, and now before proceeding to the next reading, because if I have this FRA, there's lot many content to remember. Okay, so what is the best approach? Now before proceeding to the next reading, thoroughly revised, okay, and complete your hand notes. So you are going to be extensively dependent upon your hand notes. Okay, so that should be properly completed. Your notes should be completed in a proper manner. Okay, and again I think that revision of these 59 questions is required. Thoroughly revise before proceeding to the next part. Okay, thank you. Hello friends, today we are going to start with reading long-lived assets. In this reading, we will learn how to record assets which are having a life of more than one period. Okay, now for example, today a Ola driver buys a car and he anticipates that the life of the car is 3 years. That means with the help of this car, he is going to generate a revenue for upcoming 3 years. Now based upon matching concept. I understand that today you are incurring a cost of, for example, 6 lakh rupees. And with the help of the 6 lakh rupees, you are going to generate revenue for upcoming 3 years. Now based upon matching, you have to match your expenses with respect to your revenue. That means in this particular case, first I'm going to create an asset of 6 lakh rupees, and this asset will eventually transfer to profit and loss account in the form of depreciation, and the amount of depreciation that I'm going to charge, that will be spread over 3 years based upon matching concept. Now what is the meaning of assets? Assets are the resources because of which there are going to be some economic benefits to the company, or in simple words, because of which there are going to be cash inflow in the future. Now this car is going to generate revenue for 3 years. It will transfer to P&L over the period of 3 years in the form of depreciation based upon matching. Now again we recall, expenses are either expenses or they are asset, and eventually one day asset is an expense, and eventually one day asset has to be transferred to P&L in the form of, in this case it has to be transferred to P&L in the form of depreciation. Okay, So this was the broad overview with respect to this particular chapter. Now my point is, suppose today I buy a air conditioner for my office. Now AC has a life of more than one period. So technically I should capitalize this. Okay. Now when I purchase this particular air conditioner, I pay purchase cost. Then there are some freight charges. Then installation charges. And further I purchase a stabilizer as well. So in totality I incurred 4 expenses. Now which expense we are going to capitalize? Capitalize means which expense we are going to create an asset first. So now all those expenses which are incurred to get the asset ready for use, that means without incurring those expenses we cannot use our asset. Now my point is, without incurring freight, is asset ready to use? Can you use the asset? No. Until unless it is not installed, how I can use this asset? No. Installation charges you have to pay. Stabilizer you have to pay. Why stabilizer? Because it extends the life of your air conditioner. Now all those expense which makes the asset ready for use, you have to capitalize. In my case, I'm going to capitalize purchase cost, freight, installation, testing charges, and any expense that extends the life of our asset. However, following expense do not qualify for capitalization. Now, what are those 2 expenses? Now, those 2 expenses are: number 1, normal repair maintenance. Now, for example, every season you are going to get this air condition service. So that service cost will not be capitalized. It will directly be transferred to your profit and loss account. So normal repair maintenance. And second one is staff training charges. Now my point is, let us assume you purchase a car and you don't know how to drive. Now you are learning the car, and suppose you have paid 5,000. Now my point is, this 5,000 has been paid to get the asset ready for use. Is it incurring for the purpose of asset? Answer is no. You are incurring this expense so that you are able to use the asset. So the following 2 expenses will not be capitalized, they will directly be transferred to your profit and loss account. Number 1, that is going to be raw material, that is going to be repair maintenance, and second is going to be staff training expenses. Rest all the expense which are incurred to get the asset ready for use, I'm going to capitalize it. So again, let's go through. Expenses incurred to get the asset ready for use. Following expenses need to be capitalized: purchase, freight, installation, testing, expenses that extends the life of an asset. Following expenses do not qualify for capitalization: repair and maintenance and staff training charges. Now my point is, suppose I purchase a car. Car value is, example, car value is 12,000. Salvage value is 2,000 and life of car is 5 years. Now what is the meaning of salvage? Now salvage means the scrap value which management will get at the end of the life of the vehicle. Now at the end, after 5 years, you are anticipating you will get a scrap value of 2,000. Now my first point. Today you are incurring 12,000. Salvage value is 2,000. So effectively, what is the expenditure? Effectively, the expenditure is 10,000 rupees. And this 10,000 now eventually be transferred to profit and loss account in the form of depreciation. Now we will learn that there are going to be 3 methods to charge depreciation. but a double start point. Though there are three methods of charging depreciation. Now, irrespective of whichever method you use, collectively the amount that is going to be transferred to profit and loss account over the period cannot exceed 10,000. Now, my first method. My first method is straight line method, SLM. Now, as per SLM method, depreciation per year is equal to cost minus salvage value divided by life. Now my cost is 12,000, salvage value is 2,000, and life is 5 years. Expense of 10,000 that belong to 5 years. So every year I'm going to charge a depreciation of 2,000 per year. So this was first method. And if I prepare the graph for this graphical representation, this is time period and amount of depreciation. So if I plot, this is going to be a horizontal line, time 1, time 2, time 5, and so on. Now my second method is declining or double declining balance method. Abbreviation is DDB. Now my formula is depreciation is equal to 2 upon life multiplied by remaining book value of asset. Okay, now in this case you are going to compute amount of depreciation for each year separately. Okay, but a double start point. Collectively the amount that is going to be transferred to your profit and loss account, collectively it cannot exceed 10,000. And in this formula nowhere I'm using salvage value. Okay, so now let's find out how to find out depreciation. Now year depreciation remaining book value. Now year 1, 2 upon life. In my case life is 5 years, that means 2 upon 5 multiply by purchase the car for 12,000. 2 upon 5 multiply by 12,000. Answer is 4,800. Now what is the remaining book value? 12,000 minus 4,800, that is 7,200. Now depreciation for year 2, 2 upon total life, that is 2 by 5. Now 2 by 5 of remaining book value, that is 7,200. Answer is 2,880. Now remaining book value 7,200 minus 2,880. Answer is 4,320. Now depreciation for year 3, 2 upon 5 multiplied by 4,320, that is 1,728. My remaining book value is 2592. Now fourth, 2 upon 5 multiplied by 2592. Answer is 1036.8, and now remaining book value is 1555.2. Now you have to stop here. Now my point is, you have find out the amount of depreciation for each of 4 years, year 1, year 2, year 3, year 4. Now first question arises, so why you have stopped there? There is one more year. In totality the life is 5. Why you not proceeding further first? Now note, the moment remaining book value is less than salvage value, the moment remaining book value, in my case remaining book value is 1555.2, is less than salvage value. Salvage value was 2000, is less than salvage value, you have to stop charging depreciation. That means beyond this particular point depreciation will not be charged first. So in my case, where this is point, the point is at time 4. Now my second point is, collectively how much depreciation you have charged till year 4. If remaining book value is 1555.2, then how much amount of depreciation you have charged? So point number 2, collectively till year 4 we have charged the depreciation of 12,000 was the original cost, and now remaining book value is 1555.2. That means how much amount you have charged collectively till year 4? That is 10,444.8. Now if you sum up 4800 plus 2880 plus 1728 plus 1036.8, that value is 10,444.8. Now my point is, total amount of depreciation charged is greater than original cost minus salvage value. Original cost minus salvage value, that is 10,000. Hence adjustment is required to ensure that total depreciation is not, total depreciation charged to profit and loss account is not greater than 10,000. Now you have to make some adjustments. Okay, now that adjustment is, I want remaining book value to be equal to 2000 and total depreciation charge to be equal to 10,000. Now you have to make adjustments. Now the summation is coming out to be 10,444.8. Now I want to make this amount to be equal to 10,000. Now how much should be deducted from year 4 so that summation is 10,000? Now in year 4, depreciation instead of 1036.8, it should be 592, and now remaining book value is going to be 2000. That means now important, in declining balance method we are not specifically using salvage value, but the moment remaining book value breaches the salvage value, it is below the salvage value, you have to stop charging the depreciation. And now you have to make some adjustment in such a way that total amount transferred to profit and loss account does not exceed 10,000. In my case, summation was coming out to be 10,444.8. So what adjustment I made? In the 4th year depreciation amount, I deducted that balance and added to remaining book value. So my final answer is for year 4, that is 592, and collectively I'm transferring how much amount? Collectively I'm transferring 10,000 as depreciation to my profit and loss account. So now if I simplify, so year 1, 2, 3, 4 depreciation, so it was 592, and for year 1, 2, 3 values are 1728, 48, okay, 4800, 4800, 2880, 17, 2880 and 1728. Now if you make the summation, that summation is 10,000. 4800 plus 2880 plus 1728 plus 592, summation is 10. Now I want to prepare a graph and I want to compare SLM versus declining balance. So in case of SLM, the amount of depreciation each year, that is a constant value, but in case of declining balance, the amount of depreciation is continuously declining. But point to be noted, be it be SLM method or DDB method, collectively the amount that has been transferred to profit and loss account is going to be same, and that value is nothing but equal to original cost minus salvage value, which is your actual expenditure. So now it is management discretion. You're allowed to use SLM method, you're allowed to use double declining balance method. Whichever method you use, you're completely allowed. But collectively the amount that has to be transferred to profit and loss account, that is equal to 10,000. Okay. Now another important point. So these are the values as per DDB, and answer as per SLM was 2000, 2000, 2000, 2000, and for year 5 2000. Now you have to make some comparison. Amount of depreciation in initial years as per DDB. So amount of depreciation in initial years as per DDB. So amount of depreciation in initial years as per DDB is greater than SLM. Okay. And the amount of depreciation in later years in comparison to SLM. So the amount of depreciation under DDB in later years is lesser in comparison to SLM method. So important point. Now so we have covered two methods to charge depreciation. One is SLM, one is DDB. In case of SLM, the constant amount of depreciation is going to be charged every year. In case of DDB, you have to separately calculate for each year, where formula is 2 upon total life multiplied by remaining book value. In the formula, I'm not specifically using salvage value, but the moment remaining book value is less than salvage, you have to stop charging depreciation. Manual adjustment is required so that total amount of depreciation is equal to original cost minus salvage value. Or in simple words, total amount of depreciation is equal to 10,000. Okay, allowed to use any method. Collectively, the amount is going to be constant. Now question arises, so this is a bit complicated, and can we solve the same answers? Can we solve this with the help of calculator? So answer is yes. Now again, my question is, your original cost 12,000, salvage value 2,000, life 5 years. Now you have to find out the amount of depreciation using DDB for each year using calculator. So for year 1, amount is different, 2, 3, 4 and 5. So now how we are going to solve this using calculator? Now you have to press second depreciation. That is, you have to press in your BA2 plus calculator second 4. So the second 4 is nothing but second depreciation. The moment I press second depreciation, your calculator will display SL. Okay, so now what is the meaning of SLs? We are least bothered with that. I want that calculator should display DDB. Okay, so now how to get DDB? Keep on pressing second enter until you get DB. Now second enter. The moment you press second enter, now it is DB. DB stands for declining balance. Okay. Now DB formula is X upon life multiplied by remaining book value. Now in my case it was declining double balance. So instead of X we put 2 upon life into remaining book value. Same wise in question they can provide you with any factor. In this case it was double. Now question says you have to find out the amount of depreciation using triple declining balance. Now in case of triple declining balance, my formula would be 3 upon life multiplied by remaining book value. Okay, so whatever the factor is given, you have to use this. Now in this case, my factor is 2, so 200. Enter. So first it should display DB 200. Enter. 200 means 2 upon life. Enter, down arrow. Now the moment you press down arrow, what is the life? In my case life is 5. Enter, down arrow. 5. Enter, down arrow. Now from which month depreciation will start? So by default it is always going to be 1. Enter, down arrow. So what is the meaning of this? From which month or from which year you want to start the depreciation? So we want to start the depreciation from first year itself. Okay. Enter, down arrow. Now CST. CST means cost of asset. In my case, cost of asset is 12,000. Enter, down arrow. Then salvage value. Salvage value is 2,000. Enter, down arrow. now year 1. Now it will show year 1. That means now whatever value it is displaying, that is for year 1. Down arrow, depreciation is 4800. Depreciation is 4800. Again down arrow, that is the remaining book value. Remaining book value is 7200. Again down arrow, remaining depreciable value. Now 7200 is the remaining book value, but how much additional depreciation you can charge? That is 5200. Again press down arrow. So this was for year 1. Now I want to compute for year 2. So press 2, enter down arrow. So now for year 2, depreciation is 2880. Remaining book value is 4320 and remaining depreciable value is 2320. Again down arrow. Now I want to compute for year 3. Enter down arrow. Depreciation is 1728. Remaining book value is 2592. Remaining depreciable value is 592. Now I want to compute for year 4. Depreciation 592. That means calculator itself is doing this manual calculation. Depreciation is 592. Remaining book value is 2000. Remaining depreciable value is 0. Now I want to compute for year 5th. Enter down arrow. Depreciation is 0. Remaining book value is 2000 and remaining depreciable value is 0. So now in this way, using your calculator, you can find out the answer as well. Okay, so now what are the steps? You have to press second 4, that is second depreciation. Now it will display SL. I want it should display DB. So you have to keep on pressing second enter until DB is displayed. The moment DB is there, 200 enter down arrow. Live 5 enter down arrow. From which month you want to start or from which year you want to start depreciation, that is year 1. Now what is the cost? 12,000. Salvage value 2,000. Enter down arrow. Now you will keep on pressing year 1, 2, 3. You will get all these answers. So now it's completely allowed whether you want to use calculator or manually calculated. So answer for year 4th should be 592 and collectively the amount that is going to be transferred to profit and loss account, that should be 10,000. Now I'm moving to my third method of depreciation. Unit of production method. So now same question, cost is 12,000, salvage value is 2,000, life is 5 years. So what is the total depreciation that you should charge? Total depreciation is going to be 10,000. Okay, but now I have provided you that how much your car is going to run in terms of kilometer. So for example, in year 1, you are going to run 100 kilometer, year 2, 200 kilometer, year 3, 300 kilometer, and in year 4, it is going to be 400 kilometer, and in year 5, it is going to be, your car is going to run 0 kilometers. So now, what is the total running over this period? That is 100, 203, 600 and 1000. Now in totality your car will have a running equal to 1000 kilometer. Total cost is 10,000. That 10,000 belongs to 1000 kilometer. So now my point is cost per kilometer. So how to find out cost per kilometer? Your depreciation per unit, that is original cost minus salvage value divided by total unit produced. 12,000 minus 2,000 divided by 1,000. Now per kilometer cost is coming out to be 10 rupee. Now what is going to be depreciation for each year? So depreciation for year 1 is 1,000, for year 2 is 2,000, year 3 is 3,000, year 4 4,000, year 5 0. And collectively how much amount is transferred to profit and loss account? That is 10,000. Now there are three methods. Management, it's your discretion which method you want to follow. But point to be noted, keeping in mind the principle of consistency, consistent, once a method is adopted, you have to apply this method for future period as well. If you want to change from one method to another, then retrospective amendments are required. Okay, so now let's revise what we have covered. Number one, what do you mean by long-lived assets? These are the assets which has a life of more than one period. Now because of which there will be an economic benefit for more than one period, they will eventually transfer to profit and loss account in the form of depreciation. Which expenses you can capitalize? Now you can capitalize purchase cost, freight, installation, testing charges, expenses that extends the life of an asset. These are completely allowed to capitalize. But which expense will be directly transferred to profit and loss account? One, staff training expenses, and second, repair maintenance. Now there are how many methods to charge depreciation? In totality, there are three methods. SLM, where the amount of depreciation each year is going to be constant, so a horizontal line. Double declining balance, where the amount of depreciation in the initial year is higher and in the later years is lower, so curve is going to be downward sloping. And third one is unit of production method. It depends upon how much unit you are going to produce. So we cannot prepare a graph for this. That will depend upon your production. But point to be noted, whichever method you use, collectively the amount that is going to transfer to profit and loss account, that is going to be 10,000. Okay, now I'm proceeding further. Now there is one more method to charge depreciation, that is component depreciation. Now first of all, this concept exists under IFRS only. Okay, so this concept is under IFRS only. Now what is the meaning of component depreciation? So let's take an example. Now suppose there is an aircraft. The aircraft cost is 50 lakh rupees and salvage value is 5 lakh. Okay, and total life is equal to 30 years. Okay, so there's an aircraft costing 50 lakh, salvage value 5 lakh and life 30 years. Now company has to replace the interior of aircraft at the end of every 15th year. The company has to replace the interior of aircraft at the end of every 15th year. Cost of interiors is equal to 3 lakh rupees. You have to find out amount of depreciation using component method and non-component method. Okay, so now let's understand. You purchase a aircraft 50 lakh rupees, salvage value 5, life 30 years. That means in totality initially you have an expense of 45 lakh, which eventually expense is 45. But now at the end of 15th year, you have to replace the interior, which will cost you additional 3 lakh rupees. You have to find out the amount of depreciation using component method. So now solution. Now under component method, you will get a single amount, you will get an equal amount of depreciation for each year. Okay, so now let's understand how much expense you are incurring. So initially you are incurring a cost of 50 lakh, plus at the end of 15th year you will have to incur, you have to replace the interiors. Okay, so this is the total life. Total life is 30 years, and at the end of 15th year you have to replace interiors. Now my point is, when you're going to replace the interiors, you will incur a cost of 3 lakh, and this cost you are going to incur how many times? So total life of the vehicle, total life of the aircraft is 30. Now when you purchase, already there are interiors, and now at the end of 15th year you have to replace those interiors. So how many times in totality you are going to replace? So maximum 1 time. Okay, now when at the end of 15th year you are going to replace, how much you have to pay? You will pay an additional cost of 3 lakh. Okay, now salvage value is 5 lakh. So how much depreciation I'm going to charge using SLM? So now as per SLM method, using component method. So as per SLM, using component method, amount of depreciation is equal to 53 lakh minus 5 lakh divided by 30 years. So answer is 48 divided by 30. So every year I'm going to charge a depreciation of 1,60,000 every year. So this is the answer using component. Now what is the meaning of component method? Tell me what is going to be, management, tell us what is going to be your total expenditure during the life of the asset. In my case, total expenditure including the replacement of the component, that is going to be 53. Salvage value is 5. Now what is your expense? In totality my expense is 48 lakh. This 48 lakh belongs to 30 years. This 48 lakh belongs to 30 years. Now my per year expense is equal to 1,60,000. So this is the answer using component. Now let us assume that you don't want to use component. That means you are using non-component method. Okay, so now non-component means now you are incurring 2 different expenses. One, you purchase aircraft. That aircraft has a cost of 50 lakh, salvage value 5 lakh, life 30 years. So what will be the amount of depreciation? As per SLM, amount of depreciation is amount of depreciation is 1,50,000 per year. But this depreciation you will charge from, this depreciation you are going to charge from year 1 to year 30, 1,50,000. And now you are going to replace one component. That component is interior. Cost of 3 lakh rupees. Cost of 3 lakh. Salvage value 0. Life 15 years. So this interior will be replaced at the end of 15th year. Okay, so now using SLM, Depreciation on interiors, 3 minus 0, 15. So this is 3 lakh divided by 15. So this amount is 20,000 per year. But this amount you are going to charge from year 16th to year 30. So if I sum up 1 to 30, you are going to charge 1,50,000. From year 16 to 30, you are going to charge 20,000. Further summarizing, 1 to 15, you are going to charge 1,50,000. 16 to 30, you are going to charge 1,70,000. That means for 15 years you are going to charge 1,50,000. For 15 years you are going to charge 170. What is the total amount that has been transferred? Total amount of depreciation is 1,50,000 multiplied by 15 plus 1,70,000 multiplied by 15. If I make a summation, so summation is going to be summation is going to be 48 lakh. What was happening under this is under non-component. Under component method, my amount each year is going to be constant, and that amount is 1,50,000 every year. If I multiply by 30, again answer is 48 lakh. Now this is again the management discretion. So now under IFRS, you have an option to charge depreciation as per the component method. Now what is the meaning of component? So during the entire life of the asset, if you're going to replace any components, add up the cost. So in my case, I'm going to incur an additional expense of 3 lakh. So 50 at the time of purchasing the vehicle and 3 to replace the component. In totality 53. Salvage value is 5. So 53 minus 5, 48 my expense. 48 divided by 30. Every year expense is 1,60,000 using component. So in case of component, uniform amount over the life of the asset. Now you want to use non-component. Non-component means I'm going to charge the amount on the component separately. So over the aircraft, my answer is 1,50,000 for year 1 to 30. Over interiors, I'm going to charge an additional depreciation from 16 to 30, that is 20,000. If I summarize, 1 to 30, 1,50,000, 16 to 30, 20,000. Or in another words, 1 to 15, 1,50,000, 16 to 30, I'm going to charge 1,70,000. But under both these scenarios, your amount that is transferred to profit and loss account is 48 lakh. Okay, so now I'm giving you one more example. Try to solve yourself. Okay, example. You purchase a car. The car value is 10,000 with a life of 6 years. Salvage value 4,000. Okay. You have to replace the tires at the end of third year, which costing equal to 2,000. You have to find out the amount using component method and non-component method. Okay. So class, please pause the video, try to answer yourself, and then you're going to resume. Okay. So again I repeat, car has a cost of 10,000, life 6 years, salvage value 4. but you have to replace the tires at the end of third year, which cost you 2,000. You have to find out the amount using component method and non-component method. Solution. Component method. So today I'm buying a car of 10,000, plus there will be an additional expense of 2,000. How much I'm going to incur this expense? 2,000 only one time. Okay, life of the car is 6. At the end of third year I'm going to increase. So how much replacement is required? Only once. My car is already fitted with the tires. Only one time replacement is required, that is at the end of third year. Okay, so this is the total cost. Salvage value is 4,000. Life is 6 years. So I'm going to charge a depreciation of 12 minus 4k divided by 6. So amount is 133.3 per year. Now non-component, you want to divide this into two parts. Car you purchase for 10k, so over car depreciation is 10 minus 4 divided by 6, that is 1,000 per year. This amount you are going to charge from year 1 to 6. You will replace the tire at the end of third year. So tire will cost you additional 2,000. So answer is 667 per year. This amount you are going to charge from 4th to 6th. Summarizing, 1 to 3 you will charge 1,000. 4 to 6 you will charge 1,667. Collectively you are charging how much? 3,000. So collectively you are charging 1,000 multiplied by 3 plus 1,667 multiplied by 3 equal to 8,000 non-component. And if you want to find out the answer using component method, answer is 1,333 multiplied by 6, that is 8,000. So you are allowed to use whichever method you want, component, non-component. Collectively the amount is going to be 8,000. Under component, year 1 to year 6 you are going to transfer 1,333. Under non-component, 1 to 3,000, 4 to 6, 1,667. Eventually the answer is 8. So friends, this was the component method. Now I'm proceeding further. Now my point is, again I want to repeat matching concept. So financial statements would be prepared, income statement is going to be prepared based upon matching. Now what was the meaning of matching? Match your expenses. Match your expenses with respect to your revenue. Okay, match your expenses with respect to your revenue. Now let us assume that there is a company, Oberoi, and they are constructing one hotel. Okay, so typically for construction of hotel they may require 3 years of time. So during this period, during this period, hotel is under construction. Okay, and suppose that at this particular point, at time 0, you borrow money from bank at 10% rate of interest. So at time 0 you are borrowing the money. Okay, so over this period you will pay interest to the bank. Okay, and post 3 years hotel will be operational. So this is my operational period and this is my under construction period. Now my point is very simple. During the period when hotel is under construction, during that period, if you're paying any sort of interest, that interest, you have two options. That interest to be transferred to profit and loss account or to be capitalized. To be transferred to profit and loss account or to be capitalized. Same wise, whatever the interest you are going to pay during operational period, that should be transferred to income statement or capitalized and eventually transferred to profit and loss in the form of depreciation. Okay. Match your expenses with respect to your revenue. Okay. So during operational period, you are earning the revenues. So if you're earning the revenue, during that period, whatever expense you are incurring, that has to be transferred to profit and loss account. Logical. That means during operational period, whatever interest I'm going to pay, that interest should be transferred to my profit and loss account. Correct? But next, my point is, during construction period, you are incurring an expense transferred to P&L or to be capitalized. Now my point is, during construction period, are you earning any sort of revenues? So under construction, when the hotel is under construction, what is the revenue that you are earning? Now you are earning zero revenue. So you are not earning anything, but you are incurring expenses. Now that expense has to be, based upon matching, has to be capitalized and eventually transferred to profit and loss account in the form of depreciation. Now, for example, you are constructing an hotel and during the construction period, you have paid an interest of 10 crore. Now this 10 crore will be added to the hotel cost. You will create an asset, that is hotel. Now, for example, you are buying furnitures, you are incurring a lift, you are incurring other expenses. So the total amount which you are incurring on the hotel, one more component will be added. That component is interest. The entire hotel cost will include interest cost as well. And now the hotel cost will transfer to profit and loss account in the form of depreciation. Based upon which concept? Based upon matching. Again, I repeat, there is a hotel and company is currently the hotel is under construction. So this is the construction period. And this is the period during which hotel will be operational. So whatever the interest you are paying during the operational period, no doubt that should be transferred to profit and loss account. But whatever the interest you are paying during the construction period, you are not earning any revenue. If you are not earning any revenue, simply you cannot transfer this expense to your P&L. Sir, I am paying this expense. No doubt you are paying. Cash will go out. No doubt about that. But this expense will not be transferred to income statement. It will transfer to, you will going to capitalize it. And eventually it will transfer to profit and loss account in the form of depreciation. Based upon which concept? Based upon matching concept. So again I repeat. Now, expenses are either expenses or they are asset. And one day asset will eventually transfer to profit and loss account. And in this case, it will transfer to profit and loss account in the form of depreciation. Now, how accounting will work? Now, suppose you have to pay interest of 10 lakh rupees to the bank. Cash will reduce by 10 lakh. But now, instead of transferring this to P&L, you won't be transferring this to P&L. You're going to create an asset, that is hotel, 10 lakh rupees, And once the hotel is operational, then this value will keep on reducing. This value will keep on transferring to income statement in the form of depreciation. Now, my next point. Same, let us assume that there is a company DLF, and DLF is constructing a residential building, and during the construction they incurred interest. So during the construction period they incur the interest cost. Can it be transferred to P&L? Answer is no. Okay, but this building which they are constructing, that is for the purpose of sale. So they will construct one building and eventually they will sell to some third party. So now from DLF point of view, this is nothing but inventory. Now you will keep on capitalizing the interest. That interest will capitalize to the inventory component, and whenever this asset is sold from the balance sheet, inventory will be removed and it will be clubbed in COGS. Now that means you can incur interest for two items, one for your fixed asset, one for your inventory. If you are incurring for your fixed asset, it will be eventually clubbed in the depreciation component, and but if it is for your inventory, it will club into your COGS component. Okay, so now with this we have covered two LOS. Let's go through the notes. When an asset is expected to provide benefits only for the current period, it is transferred to profit and loss account. If it is expected to provide benefits for multiple periods, it is capitalized and then transferred to profit and loss account. You are allowed to capitalize all those expense which makes the asset ready for use, including installation, freight, taxes. Following two will be directly transferred to income statement: training cost and repair maintenance. Now this is a double stop point. When a firm constructs an asset for own use, that means in case of hotel, or for resale, the interest during the construction period is capitalized, okay, and eventually transferred to P&L in the form of depreciation. Capitalized interest is not reported in the income statement as interest. Once construction is capitalized, interest is allocated to the income statement through depreciation if asset is held for use, that means in case of hotel, or COGS if asset is held for sale in case of DLF. Then there are three methods to charge depreciation: straight line, declining balance, and unit of production method. In all the above three methods, depreciation ends once residual values has been reached. IFRS requires component depreciation as well, where whatever the amount you are going to incur in totality, you are going to charge depreciation on that amount. Okay, again IFRS allows component depreciation as well. So with this we have covered LOS 1 and LOS 3. Now friends, my next LOS is how the choice of depreciation method will affect profitability. Okay, so here we are going to make a distinguish between double declining balance and SLM method. So in SLM you are going to charge same amount of depreciation over the period. In case of declining balance, the amount of depreciation will keep on reducing, but collectively over the period same amount is transferred to profit and loss account. Now my point is, suppose my company is using a DDB method. So amount of depreciation charged in initial years. So amount of depreciation charged in initial years is going to be higher. That means my profitability in initial years is going to be lower. Okay, so this was with respect to initial years, but in later years the amount of depreciation will reduce, and thus profitability in later years will improvise. Our profitability in later years is going to be higher as compared to SLM method, and based upon profitability there is a ratio, return on equity and return on asset. So where the formula is EAT upon equity, EAT upon total asset. So it is a ratio P&L upon balance sheet, P&L upon balance sheet. Always you have to take average. And now let us assume that during the period company has earned a profit of 20. So if EAT is 20, then what will be equity? Now equity has two parts. Equity share capital, that is the amount that you have contributed as shareholder. So let us assume that this amount is 100. And reserves and surplus. Reserves and surplus means the profits which you have reinvested. Now in totality company earned a EAT of 20, assuming that dividend is 0. So you have reinvested 20 rupees in the business. So reserves and surplus means profits which are reinvested. Now in totality equity is 120. Now ROE is going to be 20 upon 120. Okay. Now my point is using DDP method, the amount of depreciation is going to be higher. That means profitability in initial years is going to be lower. So if I want to compare with the previous example that we have done, so now here my depreciation is, in the initial period my depreciation is 4800 as per DDP and 2000 as per SLM. That means how much depreciation is more? 2800. Now my point is in initial years, if I'm using DDP method, my profit is going to be lower by 2800. Okay, so let's make this figure to be 2000. Okay, now I'm saying that my profits would be lower by 2800. So it will also reduce your equity as well. So which component will be reduced? Reserves and surplus. So now your equity will reduce by, your profit will reduce by 2800, your equity will reduce by 2800. Now my point is, what is the impact going to be over the ratio? Numerator, denominator both are reducing by 2800. What will be the impact? Now one question, one answer. Ratio will remain constant. Okay, ratio will remain constant. So earlier the ratio was 20,000 divided by 1,20,000. So earlier my ROE was 16.67%. Now if I reduce 2800 both from numerator, denominator, the revised ratio is going to be, revised ratio is coming out to be 14.67%. Now my point is why ROE is reducing with the decrease in the profits, though numerator and denominator both are reducing by the same absolute value. Now important. Why the ratio is declining? Because numerator reduced by 2800. In percentage terms, numerator has reduced by 2800 divided by 20,000. In percentage terms, your numerator has reduced by 14% and your denominator has reduced by 2800 divided by 1,20,000. Your denominator has reduced by 2.33% only. Since in percentage term numerator is reducing more, because of which your ratio will decline. Now another important point to explain this point. Suppose I scored 80 marks out of 100 in mathematics. Okay, but one question was out of syllabus, for which I have already been awarded marks. Now assume that you want to find out my revised percentage. So minus 10. Earlier my percentage was 80, but now my revised percentage will reduce. Now my revised percentage is going to be 70 upon 90, that is 77.78%. Now why my percentage is reducing though numerator denominator both reduced by 10? Because numerator reduced by 12.5%, but denominator reduced only by 10%, as a result of which ratio is declining. Now my point is, when you are using DDB method in initial years, your profits are lower. So if your profits are lower, then in initial years your ROA and ROE both will be lower. So simple point to remember, they go in line with profits. So if profits are reducing, ROE, ROA will reduce. However, in the later years, profits are higher. ROE, ROA under DDP method are going to be higher in comparison to SLM. So again, a quick comparison. So now in early years of asset life, accelerated depreciation, that is DDP method, will result in higher depreciation expense, lower net income, and lower ROE, ROA compared to SLM. So this we talk about early years. But in the later years, your amount of depreciation will reduce, your net income will increase. As a result, ROE, ROA are going to be higher. Now, keeping in mind the principle of consistent. Now, suppose I'm using SLM method. So these are principles, okay? Accounting principle. Now let us assume that I'm using SLM method. So for the upcoming years, you would be only using SLM method only. And now if you want to shift to unit of production method or DDB method, then it has to be retrospective amendments. So the effect has to be retrospective. Retrospective means you have to change the prior period's financial statements as well. It has to be a retrospective effect. However, if I talk about, for example, there is a car and car has a cost of 20,000 with a salvage value of 4,000 and life equal to 4 years. Okay, and you're using SLM method. But now at the end of second year, you want to change your assumptions. Earlier, the salvage value was 4,000. Now you want to change salvage value to 1,600, or you want to change salvage value to 5,000. Now this change is change in estimates. So if you want to change your estimates, it has to be prospectively. So point to be noted. If you want to change from one principle to another, a retrospective effect. But if you want to change your estimates, that estimates are going to be prospectively. So now one example. Suppose there is a car having a cost of 20,000, salvage value 4, life 4 years. So as per SLM method, what is the amount of depreciation? So as per SLM method, the amount of depreciation is 16,000 upon 4 equal to 4,000 per year. Now at the end of second year, at the beginning of third year, management change the estimates of salvage value of car to 1600. Okay, now my point is how much depreciation you have charged for 2 years. So year 1 you have charged a depreciation of 4,000. Year 2 you have charged a depreciation of 4,000. You purchase the machinery for 20. 4,000 has already been transferred to your profit and loss account. Now what is the remaining book value at the end of year 2? So remaining book value at the end of year 1 is 16 and now it is 12. Now revised depreciation is equal to, now how much you are going to depreciate, that is 12,000 minus 1600. How much life is left? Now in totality 2 years are left. So 12,000 minus 1600 divide by 2, answer is 5,200 amount of depreciation each year. So what depreciation we are charging? In year 1 we are going to charge a depreciation of 4,000. Year 2 we are going to charge a depreciation of 4,000. Year 3 we are going to charge depreciation of 5,200. Year 4 we are going to charge depreciation of 5,200. So now if you add up, the answer is 18,400. Your salvage value was 16, your cost was 20,000, and eventually how much is transferred to P&L? That is 18,400. So important point, if you want to change your principles, SLM to DDP, DDP to SLM, or vice versa, in this case there has to be a retrospective effect. You have to change your prior period financial statements. But if you want to change your estimates, for example, now I want to change the life or I want to change the salvage value, so this has to be prospectively. Now in my case I'm going to change the assumption in year 3rd. So till year 2 you have charged a depreciation of 4,000. Now remaining value is 12,000. As per management estimate, salvage value is 16. So 12,000 minus 1600, this will be depreciated over 2 years. So with this, we have covered 3 LOS. So a quick revision. LOS 1. So LOS 1 talks about that we are going to capitalize those assets which are having an economic life of more than 1 period. Now which expenses you are going to capitalize? Purchase cost, freight, insurance, testing charges, and the expenses that extends the life of an asset. However, 2 expenses will never be capitalized, they will directly transfer to your profit and loss account. So those 2 expenses were, number 1, your repair maintenance, and number 2 was the training expenses. Then with respect to interest, now if you are paying an interest during the construction period, you are not earning any revenue from this hotel. So whatever the expense is going to be, since you are not earning revenue, you are going to capitalize it. Important point. Okay. And now if it is held for use, you're going to use this machinery, it will be transferred to P&L in the form of depreciation. And if it is held for sale, that means it is your inventory held for sale, then it will transfer to your COGS whenever the asset is sold. So this was LOS 1. LOS 2, in totality there are how many methods to charge depreciation? 3. Number 1, SLM. As per SLM method, the amount of depreciation is going to be constant every year. Double declining balance, in this case you have to compute amount of depreciation separately for each year, but point to be noted, be it be SLM method or DDB method, cumulative amount transferred to balance sheet is going to be constant, that is original cost minus salvage value. Third method is unit of production method. Unit of production method says as and when we are producing the goods. Okay, so first we are going to compute, as per unitary method we are going to compute cost per unit, and whatever units that you have produced in that particular year we are going to multiply by that. So these are the 3 methods. Point to be noted, irrespective whichever method you are using, amount of depreciation is going to be, cumulative amount of depreciation transferred to P&L is going to be original cost minus salvage value. Okay, now my point is component depreciation. This is a concept under IFRS. Now whatever the expense going to be in totality. Now for example, you are going to replace the interior of your aircraft. You are going to spend 3 lakh rupees. So whatever your total expense during the life, add up minus salvage value, divide by life. So this is known as component method. That's totally up to your management. You want to use component method or non-component method. Eventually cumulative answers are going to be same under all the methods, under both the methods. Now my point is I'm using DDB. So what would be impact over my financial statements if you're using DDB versus SLM? Amount of depreciation in initial years is going to be lower. Amount of depreciation in initial years is going to be higher. Profits are going to be lower, as a result of which ROE, ROA lower. Okay. In the later years, the amount of depreciation is going to be lower. Profits are going to be higher, as a result of which ROE, ROA higher. Then if I want to change from SLM to DDB and vice versa, retrospective, if you want to change your estimates, your assumptions, salvage value, live, that is going to be prospective. Okay, so this was covered in LOS 1, LOS 1, LOS 3 and LOS 4. Now I'm moving to LOS 2. Now in LOS 2 we have discussed about expensing versus capitalization. So again, what is going to be impact over your financial statements? Actually, point to be noted, I'm going to ignore all the points with respect to cash flows. So the points with respect to cash flow will be covered in a single chapter, that is going to be cash flow statements. Okay, so I'm ignoring all the points with respect to cash flow. Now let us assume that today you purchase a car for 6 lakh rupees, salvage value 0 and life is 3 years. Now there are 2 ways to transfer this to profit and loss account. Alternative 1, directly transfer this 6 lakh to your profit and loss account. This will be termed as directly expensing. Now if you directly transfer the 6 lakhs to P&L account, what will happen? Now you are not creating any asset. You are not creating any asset. And in year 1, you are going to charge a expense of 6 lakh. And in year 2, expense is going to be 0, 0. Okay. How much asset you are creating? You are not bifurcating this expense. So asset of 0, 0, 0. And directly you are transferring this expense to your P&L account. So this is an expense. And the moment you will transfer this expense, your equity, so first your profits will reduce by 6 lakh, 0, 0, as a result of which your ROE in the year 1 itself will reduce by 6 lakh. Okay, so number 1, expensing. If I directly charge an expense of 6 lakh, because of which what will happen, my profitability will reduce, and eventually my ROE will reduce by 6 lakh and I'm not creating any asset. Now alternative 2, based upon matching. Now based upon matching, charge a depreciation of 2 lakh each year. 2 lakh, 2 lakh, 2 lakh. Okay, as a result of which your profitability will reduce by 2 lakh each year. Okay, create a asset. At time 0, asset is of 6 lakh, out of which 2 lakh has been transferred. So how much asset is left? 4 lakh, 2 lakh, and eventually 0. What will be impact over ROE? In totality impact. So first year ROE will reduce by 2 lakh. In second year it will again reduce by 2 lakh. And in third year again it will reduce by 2 lakh. Okay, so this is the case. Now I am the company which is using option 2. I create an asset first, capitalize it, and then transfer to my P&L account. Okay, so my first point. Now my first point is my focus is over first year. So amount of expense in first year. I'm the company which is using alternative 2. I'm doing the capitalization and then transferring to P&L account in the form of depreciation. So my expense in year 1 in comparison to direct expensing it. So my amount of expense in year 1 are going to be lower. Okay. So number 1, in year 1, amount of expense lower. I'm using alternative 2. But what about rest of the years? In rest of the years, the amount of expense are going to be. In rest of the years, the amount of expense are going to be. In rest of the years, the amount of expense is going to be higher. So based upon this, you have to make a comment upon ROE, ROA. Now comment ROE, ROA. Now amount of expense is lower. That means amount of profits higher. As a result, ROE and ROA higher. Amount of expense higher in the rest of the years. That means profits are going to be lower. If profits are going to be lower, ROE and ROA lower. So this was the first impact. Second is, now you have to compare asset. I'm creating asset of 6 which eventually reduced to 4, 2 and 0. Here I'm not creating any asset. So in option 2, value of assets are higher or lower. In option 2, throughout value of assets are higher. In one case it is 0, 0, 0. In second case it is 4, 2, 0. So value of assets is higher. In option 1, you reduce equity 2 lakh, 2 lakh, 2 lakh every year. Whereas in option 1, you directly reduce equity in year 1, 6 lakh rupees. Now my point is equity. So in option number 2, equity is higher or lower throughout. Now what will happen? Here in the first year, you reduce equity by 2 lakh. In second year, again you reduce equity by 2 lakh. That means by the end of year 2, collectively how much equity is reduced? 4. And then in the third year, collectively equity has reduced by 6. But in option number 1, in year 1 itself, you have reduced the equity by 6 lakh. That means if you want to compare, assets will be higher, equity will be higher in option number 2. Now you have to comment upon debt upon equity debt upon asset. Now debt upon equity, debt upon assets are going to be lower if we capitalize instead of directly expensing it. Again, I repeat. Now let's go through with the help of the notes. Now, compared to expensing, capitalization results in lower expense and higher profits in the period of acquisition, higher expense and lower net income in each of remaining of the asset's life. Now you are going to charge depreciation, and in option number 1 there's going to be zero expense, as a result of which lower expenses, higher net income in the period of acquisition. However, in rest of the years, higher expenses and lower net income. Now this will result in higher ROE ROA in the initial period and lower ROE ROA in subsequent periods. Then compare your assets. Here asset is 420. Here the asset value is 000. So higher assets in option number 2. Same wise, here at year 1 you have reduced equity by 6 lakh. Now for example, your total equity was 100. So 100 reduced by 6, 94, 94, 94. But in option number 2 you reduce every year by 2. Suppose earlier equity was 100, 98, 96, 94. Now my point is, equity here in option number 2 in comparison to option number 1, equity is higher. Now if asset is higher, equity is higher, what will be the impact over debt to equity, debt to asset? These are going to be lower. So this you have to remember. Again, I repeat. Now there are two options. One, to transfer directly to your P&L. Second, create asset, that is capitalize. Create an asset and over the period transfer to profit and loss account in the form of depreciation. Now if you are doing this particular treatment, then what will happen? In the period of acquisition, you are going to transfer less expense, so lower expenses, higher profits in year 1, as a result of which higher ROE in year 1. In rest of the years, you are going to transfer depreciation every year, so expenses are high, profits are low, as a result ROE, ROA are going to be lower. Now in this case, option number 2, you are creating an asset 6,420. But in option number 1, you are not creating any asset, 0000. That means higher assets. And in option number 2, you are reducing equity every year by 222. In option number 1, in year 1 itself, you are going to reduce equity by 6. Now my point is, higher asset, higher equity. As a result, debt to equity ratio, debt to asset ratio is going to be lower. Okay, so this is the impact. So with this, we have covered LOS 1, LOS 2, LOS 3, LOS 4. Now before proceeding to next LOS, let's practice some problems on LOS 1 to LOS 4. So my first is question number 1. Company recently purchased and installed a new machinery. The company incurred following cost. Okay, you have to find out the total cost of the machine to be capitalized. Okay, purchase price, yes. Freight, yes. Installation, yes. Testing charges, yes. But you are going to ignore staff training cost. Why? Because this is not incurred to make asset ready for use. So what is the amount, total cost of machinery that is going to be capitalized? That is 12,980 plus 1200 plus 700 plus 100. So answer is 14,980. Question number 2. Which cost will be directly transferred to your profit and loss account? Delivery charges? No. That means freight? No. Installation? No. Yes. Training required to use the property and equipment. That means training expenses will directly be transferred to your profit and loss account. Third, when constructing an asset for sale, borrowing cost will be transferred to. So borrowing, this is the asset for sale. You are not making an asset for use, but it is for sale. Example of DLF. So the related borrowing cost will be capitalized as a part of inventory. So in question number 3, if it is written held for sale, then will be considered as a part of inventory. Held for use, then it is going to be your fixed asset. Okay, so answer is B. Proceeding further, question number 4. Question number 4 important. Now what is happening in this particular case? So question number 4. Okay, so now the asset is under construction and you have borrowed the money. So if asset is under construction, you have borrowed the money, then we are going to capitalize it. It is very clear. But now my point is, suppose in totality you have borrowed 100 rupees. On this borrowing of 100 rupees, you have to pay 10 rupees to the lender, to the bank. But you have earned some interest on this 100 as well. For example, you got the fund from the bank at time 0, but you invested in your project, let us assume at the end of year 1. So you put this money in the bank, you earn some interest on this money as well. Okay, so now the question is, you have to pay, let us assume 10 rupees as interest to bank, and you earned a 1 rupee of interest income. Now what is the amount that is going to be capitalized? Now point to be noted, net amount, net interest expense is going to be capitalized. So what is going to be capitalized? Which is going out of your pocket. From my pocket, effectively 9 rupees is going. So 9 rupee will only be capitalized. So now let's solve question number 4. Company borrows capital from a local bank to finance the construction of its manufacturing plant. Borrowing rate 1 January 2009, you have borrowed 500 million and rate of interest is 14%. The tenure of the loan is 3 years. Payment method, annual payment of interest only. Principal is due at the end of term loan. Okay, so what happened here? Question number 4. You borrowed 500 million here, and this is borrowed at the rate of 14%. So from the point of view of bank, it is an outflow. Bank will earn an interest of 14%, that is 500 multiplied by 14, 70, 70, 70, and eventually you will pay the money at the end of 3rd year. So this is from the point of view, this timeline is from the point of view of banker. Okay, the construction of the plant takes 2 years, during which the company has earned 10 million by temporarily investing the loan proceeds. Okay, so in this period, during this period, construction was going on. So this is the construction period. So in this construction period, how much interest due, how much interest you have paid? That is 140, but you have earned 10 million as interest by investing the loan proceeds. So effectively, how much is the interest? Effectively, you have paid 130 million to the banker. Now my point is, which of the following amount of interest is going to be capitalized in the balance sheet. So you have to pay 140, you have earned 10. So net how much we are going to capitalize? That is 130. So answer is A. Next, question number 9. All else equal in the financial year when long-lived asset is purchased. So now I'm not going to comment anything with respect to cash flows. Okay. Now depreciation expense increase. Net income is reduced by the amount of purchases. Now if you're purchasing a long-lived asset, it will eventually transfer to P&L in the form of depreciation. So C is incorrect. Net income is not reduced by the amount of purchases, it will reduce by the amount of depreciation. Depreciation expense increases. Correct answer is A. Next, question number 10, double star. So now question number 10 is it's a bit technical. Okay, so let's solve together. Company X and Z have same beginning of the year book value of equity and the tax rate. The companies have identical transactions throughout the year and report all transactions similarly except for one. Both companies acquired a printer for 3 lakh pound with a life of 3 years and salvage value of 0. Okay, question number 10. So there are two companies, X and Y. Everything is identical except for one transaction. They purchase one printer which has a costing of 3 lakh, life of 3 years and salvage value of 0. Okay. Company X capitalizes the printer and depreciates on SLM. So now company X is charging the depreciation on SLM basis, whereas Z expense the printer. Now expense the printer means it has directly transferred 3 lakh to profit and loss account. The following are the year-end information for company X. So this is for company X year-end. Ending shareholder equity this much, tax rate itna, dividends 0, and net income 7,50,000. Based upon this information, you have to compute ROE using year-end equity. So specifically given using year-end equity. Okay. So now everything is same except for the accounting treatment with respect to printer. Company X capitalize and charge a depreciation on SLM basis, whereas company Z directly transfer to P&L account. You have to compute ROE of Z based upon year-end equity. Okay. Now you have been provided with net income of X. Okay. So now net income of X, that is EAT of X, is 7,50,000. Now EBT minus tax at 25%. So this is going to be EAT. Now let us assume that your EBT is 100. 25 is going to be tax. 75 is going to be EAT. That means whatever this EAT is nothing if tax rate is 25%. If you have earned, so make it this 1. So if it is 1, EBT is 1, then this is going to be 0.25 and EAT is going to be 0.75. Now this 7,50,000 is only representing 0.75. So what is your EBT? Now my EBT is going to be 7,50,000, that is 0.75 only, divided by 0.75. So how much my total profits before taxation? So that is going to be 10 lakh. On this 10 lakh, you have paid a tax of 2,50,000, and now you are left with 7,50,000. So what is given in the question? In the question it is given that EAT is 7,50,000. Now I want to create my income statement for company X. So 7,50,000. This is 75% profits only. Now if you have earned 1 rupee, tax rate is 25%. So 25% belongs to government, 75% belongs to equity. So this 7,50,000 is nothing but 75% only. So what is the 100% profits? That means profit before tax. So profit before tax is this value divided by this. Same wise, let us assume that today you go to the market, you purchase 500 gram paneer or 0.5 kilo paneer for rupees 100. Now my point is, what is the value of 1 kilo paneer? So 1 kilo paneer using the unitary method is going to be 100 divided by 0.5, that is equal to 200. Same wise in this question, 0.75 profits is equal to 7,50,000. Then what are going to be total profits before taxation? Total profits using unitary method is going to be 10 lakh. Out of this 10 lakh, 2,50,000 belongs to the government and 7,50,000 belongs to equity holder. So point number 1. Now assuming that there is no interest, so interest 0, then what is your EBIT? EBIT is going to be 10 lakh. And now company X charges are depreciation. So depreciation amount is 3 lakh divided by 3. So depreciation is 1 lakh. That means EBITDA in case of company X is going to be 11 lakh. So EBITDA of company X is 11, depreciation is 1, because of which EBIT is going to be 10 lakh, EBT 10 lakh, 2,50,000 has been paid to the government. We are left with 7,50,000. Now these transactions are exactly same for company Z as well. That means company Z EAT is 11 lakh. But now he has directly charged the 100% depreciation on this particular asset. That means how much depreciation Z has charged? He has charged a depreciation of 3 lakh. I'm left with 8 lakh. Interest 0, 8 lakh. Now what is going to be the net profits? 8 lakh is the total one. 25% belongs to the government, that is 2 lakh. I'm left with 6 lakh. So the profit in case of Z is going to be 6 lakh. Now shareholder equity in case of X. So shareholder equity has two parts. One, reserves and surplus. Second is equity share capital. This is the money that you have contributed, physically contributed. This is the profits that you have reinvested. Now it is given that ending shareholder equity is equal to 1 million. So it is equal to 10 million. Now ending shareholder equity is equal to 10 million. Now this 10 million has two parts. One, profits that are reinvested. So that is 7,50,000. And opening value of equity is going to be 10 million minus 7,50,000. So that is going to be 9,250,000. Now you have to find out revise shareholder equity in case of Z. Now in case of Z, shareholder equity will have two parts. Equity share capital, that is 9,250,000. Reserves and surplus, that is 6 lakh. Now in case of Z, revised shareholder equity is 98,50,000. You have to compute ROE. ROE is EAT upon equity. Your profits are 6 lakh. Your equity is 98,50,000. So ROE is equal to 6.09%. Answer is B. So again, a quick revision. So there are two companies, company X and Y. Everything is similar except with respect to accounting treatment for a printer. So what company X does? Company X has charged a depreciation of 1 lakh. You have been provided with net income of 7,50,000. 25% is the tax rate. That means your EBT was 10. 1 lakh you have charged a depreciation. That means EBITDA of X is 11 lakh. So this profit belongs to Z as well because everything is identical. But now what Z does, Z has directly transferred the printer to P&L account. So you charge an expense of 3 lakh. So if you charge an expense of 3, his profits are 8. If I divide on the basis of 25-75% ratio, 2 lakh belongs to the government and eventually equity and the profit belongs to the equity is 6 lakh. Now my point is they have been provided with year-end equity. Year-end equity means equity share capital plus profits which are deinvested. Now the summation is 10 million. In that 10 million, one portion is this and remaining is your opening equity. So opening equity is 92,50,000 and 7,50,000 is the profits that you have reinvested during the period. Now in case of Z, revised shareholder equity is going to be 92,50,000 plus 6 lakh, that is 98,50,000, and revised ROE is going to be 6.09%. So this is one of the question where student struggles. Okay, so mark it as star. That means star means either it is an important or a difficult one. Okay, so question number 10, answer is B. I'm moving to 11th now. There are two alternatives to charge depreciation. Unit of production method. Now compare unit of production method with SLM. Net income, if the company uses SLM, the net income in year 1 will most likely. Okay. Now solution 11. So if you are using SLM, so how much depreciation you are going to charge? 5 years, 1 divided by 5. That means every year you are going to charge a depreciation of 20%. If asset value is 100, then we are going to charge depreciation equal to 20. But in case of unit of production method, how much depreciation you are going to charge in year 1? In totality, you are going to manufacture 10,500 unit. In year 1, you have manufactured 2,000. So how much depreciation you are going to charge in year 1? 2 divided by, so this is 19.04% depreciation you are going to charge. So in SLM, the amount of depreciation is, using SLM, the amount of depreciation is higher. If amount of depreciation is higher, net income is going to be lower. So answer in case of 11th is A. Now again I repeat how I find out these answers. Now let us assume that the machinery value is 100. So if machinery value is 100, under SLM you are going to charge 20 as depreciation. If value is 100, so in this particular case you will charge a depreciation of 19.04. Now since you are charging higher depreciation, your profits are going to be lower if you are using SLM method. So answer is For question number 11, answer is A. Next, question number 12. A company purchases a equipment for 1500, is expected to have a useful life of 5 years with zero salvage value. Residual value, salvage value, one of the same thing. In the first year of use, unit of production are expected to be 15% of the total lifetime production and is expected to generate a 1500 of revenue and incur 500 of cash expense. The depreciation method, which will have the lowest operating profit on the equipment in the first year, is okay. So question number 12. Now there are three methods: DDP. In the option it is given DDP, unit of production method, and SLM. So if you are using SLM, then what is going to be the depreciation every year? You purchase the machinery for 1500, salvage value 0, life 5 years. So as per SLM, answer is 1500 minus 0 divided by 5. So depreciation is 300 every year. Okay. Now as per unit of production method, what is going to be the depreciation? Now in the first year, you're going to manufacture, in totality, you're going to manufacture 15% of the total production. Life is, you purchase the machinery for 1500. So depreciation for year 1 is going to be 15%. That is, depreciation is 1500 multiplied by 0.15. Answer is 225. And now you have to find out the depreciation using DDP. So using DDP, depreciation is 2 upon life, that is 5, multiplied by, for year 1, multiplied by the value for which you have purchased the machinery, 1500, 600. Now my point is where the amount of depreciation is highest. So amount of depreciation is highest in case of DDP. That means operating profits would be lower. Operating profits would be lower in case of DDP method. So answer is C. Which depreciation method will yield the lowest operating profit where the depreciation amount is highest? That is DDP method. Okay. Now 13th. Company is selecting a depreciation method for a new machinery. The machinery has an expected useful life of 6 years. Production is expected to be relatively low and to increase over a period of time. The method chosen for tax reporting must be the same as the method for financial reporting. If you want to minimize tax payment, that means you want to show higher expenses in your P&L. So if company wants to minimize tax payment in the first year of the life, which of the method it shall use? So question number 13. Now when your tax payments will minimize? When you are having a lower profits. And when you will have a lower profits? When depreciation is higher. So under which method depreciation is going to be highest? Now SLM versus DDP versus unit of production method. So depreciation highest, SLM is anyways out in the first year. Now DDP versus unit of production method. It is specifically given that production is expected to be low initially. That means you are not going to manufacture much. So production is low. So this expense is also going to be lower. So under which method depreciation is going to be highest? That is as per the DDP. Answer is C. Now question number 15. Company is computing the depreciation. Okay. The equipment was acquired on 1st January 2009. So this is the cost, estimated residual value, 8 years life, total production capacity 8 lakh units. First year it is going to produce 135,000 and in next of 7 years it is going to produce 95,000. So now if company uses SLM method, the amount of depreciation is going to be, so amount of depreciation is going to be 12 lakh minus 2 lakh, that is 10 lakh. 10 lakh divided by 8. So 10 lakh divided by 8, answer is 1,25,000. Second, question number 15. If company uses unit of production method, then the amount of depreciation related to the manufacturing equipment is closest to. Now in totality, your production capacity is 8 lakh. In year 1, you are going to manufacture 1,35,000. So first, what is your cost per unit? 10 lakh divided by 8 lakh multiplied by 1,35,000. So your answer is 168,750. So 15th answer is B. 16th, which of the following amortization? So amortization is charged over intangibles. Intangible means copyright, patent. So this we have to cover, but more or less the amount of the so over fixed assets like plant and machinery we charge depreciation. Over intangibles, copyright, patent, trademark, we charge amortization. Rest there is no difference. So only difference with respect to wordings. Okay. So which of the following amortization method most likely evenly distribute the cost of intangibles over useful life? So evenly distribute means under which method the amount of amortization is going to be constant for each year. That is going to be straight line. Now question number 17. Which of the following will show a lower amount of amortization in the first year after acquisition? Lower amount of depreciation, that means in the first year of acquisition. Now a shorter life will lead to more depreciation. Higher amortization rate will lead to more depreciation. Higher residual value. So if residual value is higher, the amount of depreciation is going to be lower. Class, I'm using amortization and depreciation interchangeably. That is perfectly allowed. Nothing, only technical difference is amortization is charged over intangibles and depreciation is charged over fixed assets only. So what is the meaning of intangibles? This we have to cover eventually. Okay. So interchangeably I'm using amortization and depreciation. Next, 18th. A company purchases an equipment for 2 lakh with a life of 5, salvage value 0. It uses DDB method for 2 years and then shifts to SLM method. So though this is not allowed, this is an hypothetical question. Okay. So for the first 2 years, you are going to charge DDB and then you shift to SLM method. Compared with annual depreciation under DDB, the resulting annual depreciation expense in year 4 is, so question number 18. Now you purchase a machinery for 2 lakh with a life of 5, salvage value 0, and you uses DDB method for 2 years. Okay. So DDB year 1, the amount of depreciation and remaining book value. So 2 upon 5 multiplied by 2 lakh. So this is going to be 80,000. I'm left with 1,20,000. Year 2, that is 48,000. Remaining book value is 72,000. Okay. Now year 3, that is 28,800. left with 43,200. Year 4, 17,280. I'm left with 25,920. So these are the answers as per DDB. Now what question is saying? It uses DDB method for depreciation for 2 years. Okay, for 2 years you charge using DDB, and now you are shifting to SLM method at the beginning of year 3. So now as per SLM, your answer should be, now your remaining life is 3 years, salvage value is 0, and 72,000 is yet to be depreciated. So amount of depreciation every year is 24,000. Okay. Now compared with annual depreciation expense under DDB, the resultant annual depreciation in year 4 is, so now as per SLM, annual depreciation is 24,000. You have to compare this amount with year 4 depreciation as per DDB. Now this answer 24,000 is greater or lower. So this answer is, the answer under the SLM method is, going to be greater. Compared with annual depreciation under DDB, the resultant annual depreciation under SLM is going to be greater. So 24,000 versus 17,280. Okay, so this is going to be greater. Now I'm proceeding further. Question number 22. A company is comparing straight line and DDB for a license acquired for 6 lakh. The difference between year 4 ending net book value using the two methods is closest to. So 22. Now you're using SLM method. If you use SLM method, so amount of depreciation every year is going to be 6 lakh minus 0 upon 6, that is 1 lakh every year. So now what is going to be the remaining book value at the end of year 4? So by the end of year 4, you have charged a depreciation of 4 lakh. So what is the remaining book value? Net book value at the end of year 4, at the end of 4th year, is going to be 2 lakh. How come 2 lakh? So already 4 lakh has been charged to your P&L. Okay, now what is left? That is 2 lakh. Now you have to find out remaining book value as per DDB at the end of 4th year. So now we are going to solve this with the help of calculator. Okay. So now second depreciation, second clear work. So we are going to use DB method. DB, enter, down arrow. Now what is the life? Life is 6. Enter, down arrow. We are going to start depreciation from first year. Enter, down arrow. Now cost of asset. Cost of asset is 6 lakh. Enter, down arrow. Salvage value is 0. Enter, down arrow. Now for which year you want to compute? We want to compute for the 4th year. Press 4. Enter, down arrow. So depreciation is 59,000 to 59. Down arrow. Remaining book value is 118,518. Now question is asking the difference between the year 4 ending net book values using the two methods. So what is the difference between these two values? Now 2 lakh minus 2 lakh. The difference between the two is 81,481. Answer is Answer is A. Next is class 50th. All else equal, which of the following depreciation method most likely to result in higher profit margins in the later years? So now, as per DDB, the amount of depreciation is highest initially and lower in the later years. So in the later years, which method will going to show the highest profit margins, or under which method the depreciation is going to be lowest? That is going to be declining balance. 51. A company acquires a asset for 1 lakh with 4 year, 0 salvage. The planned production is 100, 200, 400, 300. Under unit of production method, what is the depreciation for year 4? Now 51. In totality, what is depreciable? That is 1 lakh rupee. Per unit cost 100, 200, 3, 4, 7, that is 1000 units. And in year 4 you have manufactured 300. So my answer is 30,000. Answer is A. Next, 53. The following information is available. Purchase price itna, life itna, residual value 5 lakh. If company is using DDB method, the amount of depreciation for year 3. So again, with the help of calculator, second depreciation, second clear work, DB, enter down arrow. Life is going to be 10, enter down arrow. Depreciation is going to start from first year, enter down arrow. Cost of asset is 1.5 million, enter down arrow. Salvage value is 5 lakh, enter down arrow. Now you want to compute the amount of depreciation for year 3. 3, enter down arrow. So depreciation is 1,92,000. Answer is B. Next, you have to solve 57. So 57 is similar. Okay, so again using calculator, second depreciation, second clear work, you have to use declining balance, enter down arrow. Life is 5, enter down arrow. Depreciation is going to start from first year. Cost is 1.8 million, enter down arrow. Salvage value is 5 lakh, enter down arrow. Now you want to compute for year 3. 3, enter down arrow. Answer is 1,48,000. So 57, answer is C. 60th. A company is purchasing a customer list that will provide economic benefits for next 5 years. Company chooses to use an accelerated amortization method, that is DDB. The choice will most likely result in an amortized expense that will be, now the amount of amortization is going to be highest in year 1. Answer is B. So with this, friends, we have covered LOS 1, LOS 2, LOS 3, LOS 4 and solve practice problem on that one. Okay, so which problems we have covered? 60, 57, 53, 51, 50, 22, 18, 17, 16, 15, 14, 13, 12, 11, 10, 9, 4, 3, 2, 1. Okay, so it's very important that before proceeding to the next part, you have to thoroughly revise LOS 1, 2, 3, 4, solve this practice problem and then proceed to the next part. Thank you. So friends, we have covered LOS 1, LOS 2, 3 and 4. Now I'm proceeding to LOS 9, that is on impairment. So impairment is based upon principle of prudence. Okay, now suppose I'm having a car, I'm an Ola driver and I'm having a car. Okay, and in my books the value of car is 4 lakh rupees. So assuming that I purchased the car for 6 lakh, having a life of 6 years with a salvage value of 0, and now After 2 years, the remaining book value of the car is 4 lakh rupees. Okay. Now, this car, suppose, met with an accident. Okay. And now I don't anticipate that it will be able to generate the sufficient revenues. Okay. Now in your books the value is 4 lakh. So with the help of this asset, are you able to generate economic benefits of 4 lakh? If answer is yes, then there is no need for impairment. But now you think that in the future, whatever the revenues are going to be, that revenue is less than 4 lakh, then yes, there is a requirement for impairment. Now again, what is the meaning of impairment? Meaning of impairment is, that means if the carrying value of the asset is more, then the inflow to the business, then you have to reduce the asset value. Same wise, let us assume that there is a company, and this company has a plant, has a factory which manufactured CDs, and now the demand for CDs are continuously declining. Now people have shifted to pen drives, hard drives. Okay, now the demand for CDs are continuously declining. Assume that this plant and machinery is having a value of 5 crore, and now management anticipate that in the future we will not be in a position to recover. In totality, there would be an inflow of 5. Now that is a hint that you have to charge impairment. Now impairment are based upon the concept of prudence. So now, what do you mean by assets? Assets are economic resource. These are economic resource. These are resources. Because of which there would be economic benefits to the company in future. Now I want that economic benefit to be at least equal to the carrying value. If it is not equal to the carrying value, then yes, we are going to reduce the asset values, and this concept is known as impairment, similar to what we have covered in inventories. Okay, but now here the treatment under IFRS and US GAAP differs. So first I want to discuss about IFRS. So it is very important, specifically the IFRS one. So impairment under IFRS. Now when there is a need for impairment, if carrying value means purchase price minus accumulated depreciation. So if carrying value of asset is greater than recoverable amount, there is a requirement for impairment. Where recoverable amount is NRV, net realizable value, equal to fair value of car, fair value of asset, minus any selling cost. So for example, you have a car, the car has a fair value of 5 lakh rupees, but you are going to pay a brokerage of 20,000. So what is net realizable value? Net how much you are getting? So net I am getting 4,80,000. So where recoverable amount is NRV or value in use. Now what is the meaning of value in use? Discounted, where the meaning of value in use is equal to discounted future cash flows. Discounted future cash flows, that means PV of PV of future cash flows that asset will generate, whichever is greater. So now if carrying value is greater than recoverable amount, that means you have to impair an asset where recoverable amount is NRV, that means net how much you're getting, or value in use, that means with the help of that asset how much cash flow the company will earn. PV of future cash flow that asset will generate, whichever is greater. Now let us assume that my car carrying value is 6 lakh rupees, or my car carrying value is 4 lakh. If I go to the market and sell this car, fair value is 2 lakh rupees. Cost of sale, that means brokerage that I have to pay, that is 40,000. So net NRV is equal to 1,60,000. Value in use, that means with the help of this car I'm going to generate cash flows that have a PV equal to 1,80,000. You have to find out whether there's a requirement for impairment. Yes. If yes, then what is going to be the impairment charges? So now number one, first you have to compute recoverable amount. So recoverable amount is equal to NRV, that is 1,60,000, or value in use, that is 1,80,000, whichever is greater. So in my case, recoverable amount is equal to 1,80,000. Now if carrying value is greater than recoverable amount, that is 2 lakh greater than 1,80,000. With the help of this asset, maximum you're going to earn 1,80,000. So now you are showing this asset at 2 lakh. So will there be requirement for impairment? Answer is yes. Asset will impair. And now in our balance sheet we will show the asset for 1,80,000. We will show the asset at 1,80,000. We have reduced the asset value by 20,000. Now this 20,000 is known as impairment charges. This 20,000 will clubbed in your income statement in the depreciation. So your depreciation will increase by 20,000, your asset value will reduce by 20,000, and in the depreciation we are going to head an item. This is going to be clubbed in depreciation as impairment charges, as a result of which equity will reduce by 20,000, and finally as a result of which EAT will reduce by 20,000, and eventually equity will reduce by 20,000. So now again, what is impact? You have to reduce your asset by 20,000. So if you're going to reduce your asset by 20,000, that means you're going to increase your expense. Which expense you're going to increase? That is depreciation. Depreciation will be increased by 20,000 on account of impairment charges. The moment 20,000 impairment charges increases, your profit will reduce. Eventually equity will reduce by 20,000. So now if I want to tally my balance sheet, what is going to be impact? So now in this case, first asset will impair, and if asset will impair, what are the impairment charges? Impairment charges is 20,000. So now accounting treatment in the balance sheet, asset value will reduce by 20,000, equity will reduce by 20,000, and in the P&L your expense, that is depreciation, will increase by 20,000 on account of impairment charges. This is going to be an accounting treatment. Now my point is, whenever there is an impairment, now investors or the analyst take it as a positive or a negative news. Now there's a company that is Tata Motors, and a few years back, and I think around 1 year back, Tata Motors has charged an impairment of 50,000 crore on their financial statements on the plant, on which plant, that is Jaguar. So the demand for Jaguar, that was continuously declining, specifically in China, because of which they have to charge an impairment of 50,000 crore over their Jaguar plant. Now analysts and the investors takes impairment very seriously. If impairment charges are there, that means the demand for your product is declining, or in simple words, it signifies that, for example, the value is 100 rupees of an asset and there's an impairment. That impairment signifies that you are unable to recover 100. For example, you are only able to recover 80 rupees. Now since you are not able to recover fully 100, so you have to reduce your asset value by 20 rupees. This 20 will club into your income statement under depreciation as impairment charges, and eventually equity will reduce. So this is going to be impact of impairment. Now my next point is, does impairment charges reverse as well? So now, for example, Tata Motors charges impairment charges of 20,000 into their financial statements, but now again the demand for Jaguar is improving, in specifically in China. So yes, under IFRS, reversal of impairment charges, if scenario changes, reversal of impairment charges is permitted, is allowed. But how much impairment you have charged? Maximum you have charged 20,000. So reversal would be limited to 20,000 only. So yes, reversal of impairment charges is permitted under IFRS if scenario changes. So now LOS 9, which talks about impairment. Step number one, if carrying value is greater than recoverable amount, then yes, the asset will impair. Step number 2, impairment charges. Impairment charges is equal to carrying value minus recoverable amount. Now impact over financial statements. Step 3, impact on financial statements. Asset will reduce by impairment charges. Depreciation will increase by impairment charges. EAT will reduce by impairment charges, and eventually equity will reduce by impairment charges. Now where recoverable amount is equal to NRV or value in use, whichever is greater. And last step is, does reversal of impairment charges permitted? The answer is yes, maximum to the tune of impairment charges that has been booked into your income statement. Okay, so this was the LOS with respect to impairments. Now let's solve one question on this. Question number, okay, let's go through the notes first. Okay, 9. Under IFRS, an asset is impaired if carrying value exceeds recoverable amount. Recoverable amount is greater fair value minus selling cost or value in use, that is PV of expected cash flows. If asset is impaired, asset is written down to recoverable amount. Loss recoveries are permitted, okay, subject to maximum. The loss is subject to the maximum that the impairment charges booked into your financial statements. Now you have to solve question number Now question number 24. An analyst is studying the impairment of the manufacturing plant of a company. He follows IFRS, fair value, cost to sell. That means your NRV is 16 million, value in use is 14.5 million, and net carrying value is 19.1 million. You have to find out impairment loss. 24th. Now my carrying value is 19.10 million. Recoverable amount, that is NRV. NRV is 16 million, or value in use, whichever is greater. Now value in use is 14.5 million, whichever is greater, that is 16 million. Now if 19.1 is greater than 16, so there is need for impairment. Yes. And what are going to be impairment charges? Impairment charges is equal to 19.1 minus 16 equal to 3.1 million. So my answer is B. Next, 25th. Under IFRS, an impairment loss is, what do you mean by impairment loss? What do you mean by impairment charges? So it is carrying value over the asset. So you have compared carrying value with recoverable amount. So impairment charges is excess of carrying amount over the asset recoverable amount. So for 24th answer is B. For 25th answer is B. Now I'm moving to the treatment under US GAAP. Now we have to learn impairment under US GAAP. So now under US GAAP, impairment. So now steps will differ. If carrying value is greater than undiscounted future cash flows. So if carrying value is greater than undiscounted future cash flows, there is a requirement for impairment. Step number 1. Step number 2. What is going to be the impairment charges? Now impairment charges is equal to carrying value minus fair value. So point to be noted. Now under US GAAP, first they are comparing carrying value with undiscounted cash flows. So if carrying value is greater than undiscounted cash flows, yes, there is a requirement. So if this step is satisfied, then only you are moving to step number 2. And in step number 2, my impairment charges is equal to carrying value minus fair value. And point to be noted, how it differs from IFRS. So under IFRS, if carrying value is greater than recoverable amount, then there's an impairment. Okay. And what is going to be impairment charges? That is carrying value minus recoverable amount. But here it is comparing carrying value with undiscounted cash flows, and impairment charges is computed with the help of fair value. So point to be noted, under IFRS it is carrying value minus recoverable amount, but under US GAAP it is carrying value minus fair value. Okay, so this is the difference. And where recoverable amount is equal to greater of following: NRV, where the meaning of NRV is fair value minus estimated selling cost, or value in use, where the meaning of value in use is PV of future cash flows. Now point to be noted, under US GAAP, first we are comparing it with undiscounted cash flows, and if this condition is satisfied, then impairment charges will be computed by comparing carrying value with fair value. So now this point you have to mark up. Okay, so this is the rule. Now let's understand with the help of an example. Now, example. You're using US GAAP. Carrying value of asset is 1 lakh. Then it is given undiscounted future cash flows value, that is 70,000. Fair value of the asset is 40,000. Estimated selling cost is 2,000. Discounted cash flows is equal to 45,000. Okay, now you have to compute the impairment charges under both US GAAP and IFRS. Okay, so let's solve first using IFRS. If carrying value, that is 1 lakh, is greater than recoverable amount. Now what is recoverable amount? That is NRV. Meaning of NRV is fair value minus estimated selling cost, that is 38,000, or value in use, that is PV of discounted cash flows, 45,000, whichever is greater. So my recoverable amount is 45,000. There is a requirement for impairment, and what is going to be the impairment charges? Impairment charges is equal to 1 lakh minus 45,000, that is 55k. So this is the answer as per IFRS. Now US GAAP. If carrying value is greater than undiscounted future cash flows, that is 1 lakh greater than 70,000. Yes, there's a requirement for impairment. Now while computing impairment charges, you have to compare carrying value with fair value, that is 1 lakh minus 40,000. Impairment charges is equal to 60k. So now answer under US GAAP and IFRS will differ, so you have to remember both the points. Now next, under IFRS, reversal of impairment charges is allowed, but under US GAAP does not permit the reversal of impairment charges. So these are the point of difference between US GAAP and IFRS. You have to remember both. Okay, now my point is, what will be the impact of impairment over your ratios? Okay, so now whenever you're going to charge impairment, your asset value will reduce, your expenses increases, your profitability will reduce. As a result, equity will reduce. So this is the impact of impairment. Now my point is, if this is the impact of impairment, what would be the impact over ratio debt upon asset, debt upon equity? Your equity is reducing, your asset is reducing, debt is constant. So both these ratios will increase. My debt upon asset, because denominator has reduced, my debt upon asset, debt upon equity will increase. What is going to be impact over ROE and ROA? Your profits has reduced. Now if your profits has reduced, ROE, ROA will reduce. So impact of impairment, what is going to be the impact? So now first let's understand the impairment charges under US GAAP. If asset is impaired, if carrying value is greater than undiscounted cash flow, If impaired asset is written down to fair value, subsequent recoveries are not allowed. And the impact over your ratios. Impairment charges will reduce net income, asset equity, which results in lower ROE, ROA, and higher debt to equity and debt to asset ratios for a company. So this is going to be the impact of impairment charges. Okay, so friends, with this we have covered LOS 9, which talks about impairment. Now there is one more concept, that is revaluation. LOS 8. Now LOS 9 is mandatory for every company, but now the concept is revaluation. First, this concept exists under IFRS only, and rarely companies use revaluation method. Okay, so the earlier method is known as cost, this is known as revaluation method. Now what is the meaning of revaluation? Under revaluation, companies are allowed to show their fixed assets and intangible assets at fair value. Now you are completely allowed to show your fixed assets, intangible assets at your fair value. Now for example, I purchase one property, this property value is 10 crore. Okay, so this is the property which belongs to a hotel. The value is 10 crore, we purchase this for 10 crore and we will be charging depreciation. Now suddenly if the property of this value appreciates, now you are allowed to show this at fair value. What is the meaning of revaluation? Companies are allowed to show their fixed assets and intangible assets at their fair value. Now we have to understand the impact. Now for example, we have one plant and machinery, and we purchase this plant and machinery for 10 lakh rupees with a life of 10 years. Salvage value 0. So what is going to be depreciation every year if I'm using SLN? So depreciation as per SLN is 1 lakh every year. So by the end of year 1, carrying value is going to be 9 lakh, end of year 2, 8 lakh, and so on. Now company is using a revaluation model. Now revaluation model is, now company, what is the fair value of this machinery at the end of year 1? Now let us assume that the fair value of machinery is equal to 7 lakh. If equal to 7 lakh, now you will show plant and machinery at 7 lakh at the end of year 1. Okay, and how much value is extra? So carrying value was 9, fair value is 7. So how much carrying value is extra? 2 lakh. So you have reduced the asset value by 2 lakh. Now this 2 lakh will be routed through, because it is a loss, this 2 lakh will be routed through profit and loss account. Again, this 2 lakh will be clubbed in your depreciation, okay, on account of revaluation. As a result of this, equity will reduce, and fine, as a result of which EAT reduce, and eventually equity will reduce. Okay, so my point is, again I repeat, I purchased one machinery for 10 lakh having a carrying value of 9, fair value of 7. Now company wants to show this at fair value. That means you want to show this at 7 lakh. Now if you want to show this plant and machinery at 7 lakh, you have to reduce asset value by 2 lakh. This 2 lakh will be clubbed in the depreciation in your income statement on account of revaluation, as a result of which your profits will reduce, and eventually equity will reduce by 2 lakh. Similar to impairment. Okay, similar to impairment. But now let us assume that at the end of year 1, value is 10 9.5 lakh. Now you want to increase the value. Now if you want to increase the value, again in my balance sheet I will show the asset. In my balance sheet I will show the asset at 9.5. But if you want to increase the value of asset, now ideally you should reduce your expenses, as a result of which equity will, as a result EAT will increase and eventually equity will increase. Now point to be noted, if it is a case of upward revaluation, now upward revaluation will not be routed through profit and loss account. Now if we are not going to route through profit and loss account, then how the balance sheet will tally? So within equity we will write one more item, that is revaluation reserve, and that revaluation reserve is equal to 0.5. Now instead of routing this through income statement, now if you route through income statement, what will happen? Your expenses will reduce, as a result EAT will increase and equity will increase. This is against the principle of prudence. Okay, now your main business is not to earn income on this plant and machinery, so it is against the principle of prudence. So if there is an upward revaluation, this upward revaluation will not be routed through profit and loss account, but directly an adjustment is going to be made into equity. So again I repeat, I purchase a machinery which having a carrying value of 9 lakh. Fair value is any value less than 9 lakh, for example 7 lakh. Now you will show the asset, you will reduce the asset value by 2 lakh, increase your depreciation expense by 2 lakh, as a result EAT will reduce by 2 lakh and eventually equity will reduce. So this is the example of downward revaluation similar to impairment. But if the asset value is 9.5, now you will increase the asset value by 0.5. But in this case, this gain will not be routed through profit and loss account. We are not going to route this through profit and loss account. We are going to make direct adjustment into the equity. There will be a word, that is revaluation reserve, and that revaluation reserve is equal to 0.5. So in this way we are going to tally our balance sheet. Now important, if fair value of the asset reduces, it will be routed through profit and loss account. You have to increase your depreciation, eventually EAT will reduce, equity will reduce. But if it is an upward revaluation will never be routed through profit and loss account. Increase the asset value one side, to tally the balance sheet, equity will increase by revaluation reserve. So this is the model, revaluation model. Now let's go through the notes first, and then we'll understand the impact over ratios. Under IFRS, firms have the option to show their assets at fair value. Now, this practice is rarely used by the IFRS reporting firms. US GAAP does not permit revaluation. The impact of revaluation on the income statement depends whether the revaluation resulted in a gain or loss. If it is a loss, the initial loss will be reported in the income statement, and if initial revaluation is a gain, that initial gain would bypass the income statement, that means will not be routed through income statement and will be reported as a revaluation surplus. Okay, so this is what we have discussed. Now my point is, suppose I purchase a machinery with a carrying value of 9 lakh and now the value reduces to 7. So how much revaluation loss you are going to charge to your profit and loss? So you are going to charge a loss of loss on account of revaluation, that is equal to 2 lakh. Okay, and now suppose the next year value is 8 lakh. So now value was 7. In second year value increases to 1 lakh. Now my point is, this 1 lakh will be routed through P&L, yes or no? Already you have charged a loss of 2 lakh. This is nothing but a reversal. Now my point is, will it be routed through P&L? Answer is yes. So it will be routed through P&L maximum to the tune of losses booked. Now if tomorrow, if any subsequent gain would there, that subsequent gain would be recognized in the income statement only to the tune of previously losses booked. Revaluation gain beyond this point would surpass the income statement. Now, for example, tomorrow if the plant and machinery value increases to 9.5, now in this case 2 lakh will be routed through income statement, and additional 0.5 will be directly adjusted into equity as revaluation reserve. So now let's conclude and then understand the impact over ratios. Revaluation model. First, you have the option. This option is there only in case of IFRS. Now company, you have the option to show your assets at fair value. Okay, fair value. Now my point is, suppose carrying value is 9 and now fair value at the end of year 1 is 3 lakh. So you are going to book a loss of 6. This 6 will be routed through P&L account. Now you have, at the end of year 1, you have shown the asset at 6 lakh and loss of 6 lakh routed through profit and loss account. Now my point is, this is year 1. Year 2, if tomorrow fair value increases to 5 lakh, so 2 lakh reversal. 2 lakh reversal will be with the help of income statement. Why? Because you have booked a loss of 6. So recoveries are permitted to the tune of 6. Asset will be shown at 5. This gain of 2 will be routed through income statement. Now year 3, value increases to 9.5. So 2 lakh routed through P&L, and now in this case in totality the gain is 4.5. 2 already you have reversed. Now this 4.5 has two parts. 4 will be routed through income statement and 0.5 will directly be adjusted into revaluation reserve. So your asset will be shown at 9.5. With the help of P&L, 4 lakh would be routed and 0.5 will directly be adjusted into the revaluation, directly into the equity as revaluation reserve. Based upon which principle? Based upon prudence. Same wise, if carrying value is 9 and now the fair value is 9.5, so this additional 0.5 will directly be adjusted into equity as revaluation reserve. Okay, so this is the option under IFRS. Now let's solve one question, then understand the impact over ratios. Question number Question number 23. Company follows IFRS, decided to use revaluation model, and it purchased the machinery for 2.5 million Mexican pesos at the beginning of the fiscal year ended 31st March 2010. As of 31st March 2010, it has a fair value of 3 million. It will be routed through. So you have purchased for 2.5, fair value is 3. So this additional gain will be routed through P&L. Answer is no. it will not be routed through profit and loss account. It will directly be adjusted into equity as revaluation reserve. So correct answer is B. Okay, now let's understand the impact over ratios. Now first, if it is a downward revaluation, so downward revaluation is nothing but will have the same impact as of impairment. So what was the impact of impairment? Asset value will reduce. Equity value will reduce. Your profits reduce. Now impact ROE, ROA reduce. Debt equity, debt asset will increase. So this was the impact similar to impairment. Now what will happen in case of upward revaluation? Now this your students typically gives an incorrect answer. Okay, so watch carefully. Upward revaluation. Now in case of upward revaluation, asset value will increase. Equity will increase by revaluation reserve. What will be the impact over profits? Profits, no impact, because it is not routed through profit and loss account. Now let's discuss the impact over ratios. ROE, ROA will increase or will reduce. Profits are constant, denominator has increased. Profits are constant, denominator has increased. ROE, ROA will reduce. Debt upon asset, debt upon equity. Equity has increased, asset has increased. So debt upon equity, debt upon asset will reduce, no doubt. So this is the reversal of impairment. Under impairment, this will increase, and under upward revaluation, this will reduce. So vice versa. But point to be noted, be it be upward revaluation, downward revaluation, or impairment charges, under all these scenario, ROE, ROA will reduce. Now why ROE, ROA will reduce? Because the gains are not routed through profit and loss account. Your profits are constant, denominator has increased, as a result of which ROE, ROA will reduce. So now let's prepare a final summary. So now I'm going to club impairment and revaluation so that we have a thorough understanding of both the LOS. Number one, impairment. Impairment is based upon the principle of prudence. And now this is a mandatory provision, IFRS. If carrying value greater than recoverable amount, impairment. What would be the impairment charges? Impairment charges is equal to CV minus RA, and reversal permitted, where recoverable amount is equal to NRV, value in use, whichever is greater. Impact on the ratios. So ROE, ROA will reduce. Debt upon equity, debt upon asset will increase. So this was IFRS. This was IFRS impact of impairment. Now US GAAP. US GAAP compares with if carrying value is greater than undiscounted cash flows, there's a requirement for impairment. Impairment charges is equal to carrying value minus fair value. Reversal not permitted. impact is going to be same as IFRS. ROE will reduce, debt equity, debt asset will increase. Now, revaluation. First of all, this concept is under IFRS and it is an option which company do not opt for. Then there can be upward revaluation, downward revaluation. Now, if there is a downward revaluation, it is similar to impairment charges. Any reversal will be routed through P&L, maximum to the tune of losses booked. Above that will be routed through revaluation reserve. Now, what would be the impact over ratios? ROE, ROA will reduce, debt upon equity, debt upon asset will increase. Upward revaluation, that means fair value has increased. So no doubt asset value will increase, equity will increase, but this gain is not going to route it through P&L. So direct adjustment into equity by the name revaluation reserve. Impact over ratios. Impact over ratios. ROE, ROA will reduce, debt upon equity, debt upon asset will reduce. So point to be noted, ROE, ROA will reduce whether it is an impairment, upward revaluation or downward revaluation. Debt equity, debt asset will increase in case of impairment and downward, but in case of upward revaluation it will reduce. Okay, so this was your LOS. This was your LOS 9, 8, 9, 8 and 11. Okay, now I'm proceeding to my next LOS, that is LOS 10. Now when this asset will be removed from your balance sheet. Okay, so when asset will eventually remove from your balance sheet. So number one, when asset is sold. Okay, so when asset is sold, it will be removed from your balance sheet. Or asset is abandoned, then it is removed from your balance sheet. Or finally, if asset is exchanged for another asset, now you have to compute gain or losses. Okay, so now LOS 10. LOS 10 deals with computation of gain or losses from sale of plant and machinery. Now suppose today I purchase a car for 6 lakh, salvage value 0, life 6 years, and I'm using SLN method. So year 1, 2, 3, 4, 5, 6, I'm going to charge depreciation of 1 lakh, 1 lakh, 1 lakh, 1 lakh, 1 lakh, 1 lakh, and carrying value of asset is 5, 4, 3, 2, 1, 0. Okay, now my point is, let us assume at the end of 3rd year I sell this machinery for 2 lakh rupees, or I sell this machinery for 2.5 lakh. You have to compute my gain or loss. Now, what is the carrying value of machinery? Carrying value means post deducting the depreciation, accumulated depreciation. So carrying value of the machinery is original cost minus accumulated depreciation. So my original cost was 6 lakh. In totality, I have charged a depreciation of 3 lakh minus 3. I'm left with 3 lakh as carrying value. Now, what is your sale proceeds? my sales proceeds is equal to 2.5 lakh. Now in your books, asset is having a value of 3. You have sold this for 2.5 lakh. What is the profit or loss? So profit or loss is equal to sale proceeds minus carrying value. 2.5 lakh minus 3 lakh. Answer is negative 50,000. Negative 50,000 means you have incurred a loss of 50,000. Same wise, let us assume the carrying value is 3 lakh, and now I exchange this car within another car, and where the fair value of old car is equal to 4 lakh. So now, for example, I'm having one car Ciaz and I'm exchanging it for Honda City. So the moment I give my Ciaz old car, they have reduced the prices of Honda City by 4 lakh. So what is the fair value of my old car? That is 4. Now again you have to compute gain or loss on sale of Ciaz. So my profit is equal to, again, fair value of your old car. This fair value of old car is nothing but sale proceeds minus carrying value, 4 minus 3, that is going to be 1 lakh. So now if it is exchange, a gain or loss is computed by comparing the carrying value of Ciaz with fair value of Ciaz. So now the fair value of my car is 4 lakh rupees. So by exchanging it with Honda City, how much I have gained? I have gained a profit of 1 lakh rupees. So let's solve one example on this. Question number 26. So you purchase the vehicle for 1 lakh rupee. Salvage value is 10,000 using SLM method of depreciation, and life is 9 years. Okay, solution 26. So first you have to compute depreciation every year. Depreciation as per SLM is equal to 1 lakh minus 10,000 divided by 9. So depreciation is 10,000 per year. Now you purchase this machinery on 1st January 2007 and you sell this on 31st December 2009. That means you are selling this machinery after 3 years. So if you are selling this machinery after 3 years, how much accumulated depreciation you have charged? Per year depreciation is 10,000. So accumulated depreciation for 3 years is equal to 30,000. What is the carrying value of car now? You purchase for 1 lakh, 30,000 has been depreciated. So carrying value of car is 70,000. You're selling this car for 85. So what is your gain or loss? So gain or loss is equal to proceeds, that is 85,000 minus 70,000. So by selling this car for 85, I made a profit of 15,000. Answer is B. Now 27th. If a company sells intangible asset with a historical cost of 12, accumulated depreciation of 2. So cost is 12, accumulated depreciation is 2. So what is the carrying value? Question number 27. So carrying value is equal to 12 minus 2 equal to 10. and company reported a loss of 3.2, you have to find out sale proceeds. So gain is equal to sale proceeds minus carrying value. Now gain is negative 3.2, sale proceeds minus 10. So your sales proceeds is 10 minus 3.2 equal to 6.8. So by this selling this car, how much you have get? That is 6.8 million. So answer for 26 is B and 27th is A. Okay. Now I'm proceeding further to my next LOS. So till now we talked about the tangibles assets, fixed assets. Now I want to talk about intangibles 1. Now what do you mean by intangibles? Now for example, there's a company Hero Motocorp. Okay, and now they don't have a technical know-how how to manufacture a bike. So they enter into an agreement with Honda. Okay, and now they buy some sort of rights to use their technology, for which they pay lump sum, let us assume 100 crore, and this 100 crore has a life of 5 years. So using their technology, now Hero can manufacture the bikes, for which Hero has paid 100 crore, and that 100 crore is valid for 5 years. Now when you are paying for the rights, intangible means assets that we cannot touch. For example, we are paying a fees for patent, copyright, trademark, license, then spectrum fees in case of telecom. All these are nothing but intangibles. Now Reliance Jio is acquiring 5G spectrum rights for, let us assume, 100 crore. This right is valid for 5 years. So all these are nothing but intangibles. And over intangibles, what we charge, that is going to be an amortization. So now depreciation is charged over tangible assets, and amortization is charged over intangible assets. But the method of depreciation and amortization is exactly the same. Only difference is with respect to the naming convention. Now there is one tangible asset over which we have zero depreciation. Now that tangible asset which we never depreciate, the reason is it has an infinite life, and that asset is land. Same wise, one intangible asset that we never amortize is because it is having an infinite, and that asset is goodwill. Now question arises, so what do you mean by goodwill? Okay, now let us assume that today there's a company A, and this company A acquires B, and when they acquired, they paid 100 crore to B. Okay, now there is a purchase price allocation agreement. Now this purchase price allocation agreement specifies if you are paying a price of 100 crore to B, then this price pertains to, now for example this is Airtel, and Airtel is acquiring Vodafone for 100 crore. Now Airtel, please specify you are paying 100 crore to Vodafone, against this which assets you have purchased. Now for example, Vodafone is having some spectrum rights which has a value of 50 crore, they have some land property which has a value of 20 crore, and they have some other assets which has a value of 10 crore. Now the question is, if I make the summation of this identifiable, tangible and intangible assets, the value is 80. But why you have paid 100 crore to Vodafone? Or in simple language, let us assume that there's a person, there's a company, Bikaner, and now Bikaner wants to take over Haldiram. So will Haldiram will sell at the price of whatever the property it is having or the planting machinery? No. Haldiram will always sell at a higher value. Now my point is, why Haldiram you are demanding 100 crore, or why Bikaner you are paying 100 crore to Haldiram? Now that differential 20 crore is being paid because of goodwill. So assets which are unidentifiable, why you have paid, we don't know the reason. That unidentifiable asset is known as goodwill. And point to be noted, this is a purchase goodwill. So it will appear in the books of Bikaner and it will never amortize. It will never amortize because goodwill has a life of infinity. But point to be noted, they are due tested for impairment. That means they are due tested for impairment. This we will discuss in level 2. But from the point of view of level 1, goodwill is an intangible asset which we never amortize because it has a infinite life. And point to be noted, all those assets, if in the equation hypothetically it is given that life is infinite. If life is infinite, then whether it's a tangible or intangible, we are not going to charge any sort of depreciation and amortization. In practical life, only two examples exist with respect to tangible, that is land, and with respect to intangible, that is goodwill. Okay, so now let's go through the notes first. So what do you mean by goodwill? So the cost of purchase finite intangible asset is amortized over its useful life. Again, the amortization methods would remain the same: unit of production method, DDB and SLM. Okay. Infinite intangible assets are not amortized but tested for impairment. Example is goodwill. And then this particular part, the acquisition method is used to account for assets acquired in business combination. The purchase price, that is 100 crore, is allocated to fair value of identifiable assets of the acquired firm. Any excess of the purchase price above the fair value, in my case to 20 crore, that is nothing but recorded as goodwill. Goodwill is nothing but an unidentifiable asset that cannot be separated from business itself. Now you have paid 100 crore. This 100 crore, 50 crore belongs for spectrum rights, 20 for land and property, 10 for other assets. But why you have paid extra? Why you have paid 20 extra? This 20 which is we are unable to identify, that is on account of goodwill. So goodwill will never be amortized, it will always be tested for impairment. Next, now there are two kinds of expenses. One, research, and second one is development. So one, research, second, development. Now let us assume all the pharma companies are researching on a vaccine for COVID. So they are under the research phase. Now what is the meaning of research? Research means technical viability is not proven yet. Still they are researching. That means trial and error is going on. They are not confident enough that whether this medicine will cure COVID. Okay, so research phase. So what is the meaning of research? The meaning of research is cost incurred with the objective of discovery of new technical knowledge and understanding. But that is not proven yet. Okay, so technical viability is not proven. we are still incurring the cost. Now, second one is the development phase. When development will start? Once, so there's a company, let us assume Pfizer. Now Pfizer is developing the vaccine for COVID. Now what do you mean by development phase? Development phase means now trials are over, we have tested, and yes, this medicine cured COVID. Now company is entering into the development phase. Development phase means now technical viability has been proven, and now technical viability is proven, and now they are going to start with manufacturing of this medicine. Now they are going to install plant and machinery and going to start with the production of this medicine. Now my point is research. In the research phase, technical viability is not proven yet. So trial and error is going on. Chances of failure are high. Two options: capitalize or expense. Keeping in mind the principle of prudence. Technical viability of this medicine is not proven. You are paying salaries to your scientists. During this particular phase, whatever the expense you are incurring from the point of view of pharma company, we shall capitalize it or expense it, keeping in mind the principle of prudence. So if technical viability is not proven, so you should charge all this expense incurred during the research phase to your profit and loss account. But now my point is, once the technical viability is proven and now you're going to start with the commercial production of the medicine. During this phase, whatever the expense you're going to incur, for example, now you're installing new plant and machinery, you're purchasing new land, all this expense we are going to capitalize, and eventually we will charge the depreciation over the useful life. So this was the treatment under IFRS. Again I repeat, you are researching upon some medicine. Researching, technical viability is not proven, expense it. Now development phase. Now commercial viability of this particular intangible is proven. If the commercial viability of this medicine is proven, now you're going to capitalize this and will charge and will amortize over the useful life. So once go through the notes. Under IFRS, cost incurred with the objective of discovery of new scientific and technical knowledge are expense, but development cost incurred to translate research into a plan or design of new product or process will be capitalized. Okay, but under US GAAP, whether the amount is on research or development, both will be expense. Only exception is with respect to development of softwares. So development of softwares, all the expense will be capitalized. Rest all research and development will be transferred to your income statement. Now for example, Microsoft is developing a new software, that is MS Office. Now it is under the development phase. So this, all the expense which you are going to incur for this particular software, that will be capitalized. But other than whether it's a research or development, all this expense will be transferred to your profit and loss account. So under US GAAP, both research development are expense, except in case of software created for sales to other. So in this particular case, we are going to capitalize it. So this is one more point of difference between IFRS US GAAP. Rest, the methods of amortization are going to be same, and same wise they are going to impact your financial statements. So LOS 6 and 7 I'm not repeating again. So with this we have covered LOS 5, 6 and 7. Now let's solve some questions. Question number 5th. After reading the financial statements and footnote of a company that follows IFRS, now following are the intangible: patent 40 years, copyright, infinite life, and goodwill. Which of the following is correct? Is an identifiable asset with a finite useful life? So only one is having a finite life, that is patent. Goodwill have a infinite life, and copyright, it is given that it has no expiry. Again, the life is infinite. So copyright is having an infinite life, goodwill infinite life, patent is having a finite life. Intangibles with a finite life mostly differ from intangibles with infinite life with respect to accounting treatment for. So those who are having a finite life will be amortized, and those who are having an infinite life will always be shown at their historical cost. We are not going to charge any amortization. So with respect to accounting treatment for amortization. So question number 5, answer is B. Question number 6, answer is C. 7th, cost incurred for intangibles are generally transferred to profit and loss account when they are incurred. So when you are incurring that expense during that particular period, we are going to transfer this to profit and loss account. 8, under US GAAP, when asset is acquired in a business combination, goodwill most likely arises from. So goodwill is an asset that is neither tangible nor intangible nor identifiable intangible asset. So what do you mean by goodwill? Goodwill is an unidentifiable intangible asset. So answer is C. So friends, with this we have covered LOS 1, 2, 3, 4, 5, 6, 7, 8, 10 and 11. Okay, so please revise these concepts before proceeding to the next part. Okay, thank you. So now friends, I'm left with only 3 LOS. Okay, so from exam point of view, these 3 LOS are not important. Okay, so we have already covered the important part. Okay, so now in this video I'm going to cover the remaining 3 LOS. We'll be solving some practice problem on this, and eventually in the last part I'm going to cover the remaining practice problem. Okay, so now the reading is almost over. We have covered all the important parts. Okay, now LOS 13. So now in LOS 13, suppose that I purchase a car for 6 lakh, salvage value is 0 and life is 6 years using SLM method of depreciation. So what is going to be depreciation every year? That is 1 lakh every year. Now we are going to learn 3 new words. One is gross block, second is accumulated depreciation, and now the final is net block. Year 1, 2, 3, 4, 5, 6. So gross block means for how much you have purchased the car. So we have purchased the car for 6 lakh. 6 lakh, 6 lakh, 6 lakh, 6, 6, 6. And what is your accumulated depreciation? By the end of year 1, you charge a depreciation of 1 lakh. Then cumulatively by the end of year 2, 2 lakh, 3 lakh, 4 lakh, 5 lakh and 6 lakh. Now what is the remaining book value? That is 5 lakh, 4, 3, 2, 1 and eventually asset turn into 0. Now my point is, based upon this particular table, you have to make some comments about the life of the asset. My first question is, my focus is over year 3rd, okay, or my focus is over year 4th, okay. So now gross block is 6 lakh, accumulated depreciation is 4 lakh and net block is 2. My first question is, based upon this, what is the total life of an asset? Now total life of an asset is equal to gross block. And how much depreciation you are charging every year? So depreciation every year, my gross block is 6 lakh. Every year you are charging a depreciation of 1 lakh. So what is the total life of the asset? So total life of the asset is 6 years. Second, how much is the remaining life of the asset? So remaining life of the asset, we are going to use a formula, net block divided by depreciation per year. My net block is 2 lakh divided by 1 lakh per year. Answer is 2 years. So what is the remaining life? So we compute remaining life with the help of net block. And how old the asset is. So how old the asset is, this we are going to compute with the help of accumulated depreciation upon depreciation per year. So accumulated is 4 lakh, 1 lakh per year. So how old the asset is, that is going to be 4 years. Total life is computed with the help of net block. Remaining life is computed with the help of net block. Total life is computed with the help of gross block. Remaining life is computed with the help of net block. And how much you have used the asset, that is computed with the help of accumulated depreciation. So now once go through the notes. Average age accumulated upon annual depreciation, total useful life, purchase cost upon annual depreciation, remaining life, that is net block upon annual depreciation. Now question is why this analysis is important. Now my point is, suppose we are doing a valuation of JK Tyre. Now in a company like JK Tyre, you have to keep on investing into your plant and machinery. So now there can be two kinds of expenditures. One, expansion, and one, modernization, or one, replacement. Now let us assume that the life of my machinery is 20 years based upon historical data. So with the help of this, we are going to make some forecast when company is going to incur new new capital expenditure. This is important from the computation of cash flows. So eventually in the future you have to learn valuations. Valuations means you have to make forecast about the future. How much cash flows company is going to generate in the future. To generate the cash flows, while computing the cash flows, one of the important factor is to forecast capex that company is going to incur. Now in this case, company will incur a capex. If I'm standing on year 4, company will incur a capex after the second year. Okay, so based upon this, we have a question number 42. So following is the details. So 2012, 13, 14, this is your gross block, and then accumulated depreciation. At the end of 2014, what is the remaining life? So remaining life is going to be computed with the help of net block. Okay, so 42. Now remaining life is equal to net block upon depreciation every year. Net block is 2125. Now my point is, how much depreciation you are charging every year. Now look very carefully. Accumulated depreciation every year is increasing by 125. So per year you are charging a depreciation of 125. So what is the remaining life of an asset? So remaining life is, answer is 17. So 42, answer is A. Now I'm moving to my next LOS. My next LOS deals with investment property. So now what is the meaning of investment property? First, this concept exists only under IFRS. Investment property. Now, investment property means it is the property which is held. The main purpose of this concept is under IFRS. And investment property means a property where your objective is to earn rental income. Main objective is to earn rental income or capital appreciation. Capital appreciation or both. That means this property you are not using in your business. This is basically for the purpose of earning rents, capital appreciation or both. Now, for example, there is a company JK Tyre, and JK Tyre has a land. Over this they have their factory, and this factory basically manufactures tires. Now my point is it equal to investment property from the point of view of JK? Answer is no. So this is the property which is not you're using in your business. This is the property which is basically held for the purpose of investment, where the purpose is to earn rental income, capital appreciation or both. That means this property is non-operating asset. What is the meaning of non-operating? You are not using it in your business. Now IFRS allows that this investment property you can show with two models, one cost and one fair value model. Under cost model, you're going to show this at amortized cost. Now what is the meaning of amortized cost? Whatever the value, whatever the purchase price, you're going to charge depreciation, and it will always be shown at amortized cost. Or you have an option to show this investment property at its fair value, since it is held for the purpose of sale. So you can show this property, it is the option, you can show this property at fair value. Now my point is, suppose I purchase this building for 1 crore. Now by the end of year 1, the market value is 2 crore or market value is 50 lakh. Now whether the value is increasing or decreasing, every gain in this particular scenario, I'm ignoring the principle of prudence. This is the only scenario where I ignore the principle of prudence. Now whether there is a gain or loss, in case of investment property, if we are using fair value, then it will be routed through profit and loss account. So this is the only case where I'm going to defeat the principle of prudence. Whether there's a gain or whether there is a loss, everything will be routed through profit and loss account. So this is an option under IFRS. Now, if we are using a cost model, then disclosing useful life, a disclosure of useful life is mandatory. That you have to disclose what is the useful life of a asset. So you should disclose this. And if you are using a fair model, then disclosure requirements are: number 1, how you find out the method, how you find out the fair value of property. This disclosure is required. And second, reconciliation statement is required. Now reconciliation means at the starting of the year, let us assume the opening value was 1 crore. And now you're showing this value at 2 crore. So definitely there's a gain of 1 crore. This 1 crore of gain is routed through P&L. So this reconciliation statement you have to prepare. So point to be noted, if you're using cost model, disclosing the life, disclosing which method of depreciation you're charging, this is a mandatory disclosure. And if you're using a fair value model, then how that value is computed and reconciliation statement is required. Now my point is, now the second part is a bit confusing and not important. Okay, so let's try to understand. Now in the business, there are going to be 3 assets. one investment property, one inventory, and last one is fixed asset, operating fixed asset. Operating assets. Now my point is, out of the three, which one are held for the purpose of sell? Which company wants to sell and earn revenue? One investment property is held for the purpose of sell. So my objective is to earn rental income or capital appreciation. And inventories are also held for the purpose of sell. But fixed assets are not meant for the purpose of sell. These are purchased so that they should be used in the production of the goods. So they are not held for the purpose of sell. Okay. Now my point is, suppose you are having an investment property. You are having an investment property. That means there is a property over which there is a building. And now you want to convert this investment property into inventory or operating fixed asset. Okay, so this property is meant for the purpose of sale. On the date of transfer, let us assume that your cost was, so let us assume your cost is 1 crore and fair value is 1.5 crore. So now investment property, when converted to inventory or operating fixed asset, we will assume that you are selling investment property for 1.5 crore. Okay, so cost is 1 crore. That means in the income statement we are going to book a profit of 50 lakh. That means what is going to be the relevant value? The relevant value is going to be fair value. We will assume that we have sold the investment property for 1.5 crore. Cost is 1. That means we will book a profit of 50 lakh. And now let us assume that we converted this to operating fixed asset. Now operating fixed asset will have a value of 1.5 crore, and over this 1.5 crore we are going to charge depreciation. So now assuming that I'm using a fair value model, okay, and I want to convert my investment property into inventory or operating fixed asset. So there was the land, now land and building. Now I want to use this land and building for my own factory purposes, for my own commercial purposes. I want to convert this. So whatever the fair value is on the date of transfer, that is relevant. Now you will show operating fixed asset at this value, will charge a depreciation over this value, okay, and you will book a gain of 50 lakh. So it is very much relevant. Why? Because it was held for the purpose of sale, and now we are assuming that you are selling this asset and relevant value is 1.5. 50 lakh would be your profits. Okay, so let's go through the notes first. Now you want to transfer investment property to owner occupied, that means to operating fixed asset or inventory. Fair value on the date of transfer will be considered at cost under the new classification. So it will be the new cost of inventory or new cost of operating fixed asset, and you're going to book a profit of 50 lakh into your income statement. Same wise, let us assume that I want to convert inventory into investment property. Now for example, DLF is constructing one building and this was for the purpose of sell. Okay, main purpose was to sell. But now DLF thinks that I'm going to earn the rental income and I want to help for the purpose of capital appreciation. So what is the meaning of capital appreciation? That means immediately I don't want to sell. After some point of time, I'm going to sell this property. So main income is going to be rental income. Now, if you want to convert inventory, the property which was meant for sale, to investment property, that means now the objective is to earn rental. Again, we will assume that the property is sold for 1.5 crore and 50 lakh would be transferred to your income statement, similar to investment property. Now, if inventory transferred to investment property, that means inventory converted to investment property, recognize gain or loss if fair value is different from carrying amount. So now my cost is 1 crore, fair value is 1.5. I assume that I'm selling the inventory for 1.5 crore, will book the sales of 1.5 crore, will book the profit of 50 lakh, and now investment property will be shown in the financial statement at 1.5 crore. Now again, every year you're going to show this investment property at fair value. Now third, now suppose you're having one building and you're using this building for the purpose of manufacturing of goods. That means it is an operating fixed asset. And now you think that I want to convert this to investment property. So let's shut down the factory here and let's move to some new location. And now this property will basically be held for the purpose of rental income. Now my point is, your carrying value was 1 crore. Fair value is 1.5 crore. Now the new value of investment property is going to be 1.5 crore. But now my point is, will 50 lakh of gain will be routed through profit and loss account, yes or no? In this particular case, since your main business is not to sell operating fixed asset, this 50 lakh rupees gain will not be routed through profit and loss account. It will be treated as revaluation. So now investment property will be shown at 1.5, and correspondingly to tally the balance sheet, in the equity side we are going to add a reserve, that is revaluation reserve. So again I repeat this concept from exam point of view, not an important one. First, what do you mean by investment property? Where main objective is to earn rent and to sell at some future date to book some capital appreciation, or both. Now under IFRS you are having two options: cost model, fair value model. Now under cost model you have to disclose useful life and depreciation method, and you are going to depreciate this asset over the useful life. So these two disclosures are required. Now if you're using a fair value model, now investment property at the end of every year will be shown at fair value. Now whatever the gain or loss, that gain and loss will be routed through profit and loss account. So here I am defeating the principle of prudence. Whether there is a gain or loss, that gain or loss will be routed through profit and loss account. Two disclosures are necessary. One, how the fair value is determined, and second, reconciliation statement is required. Okay, now my point is, let us assume that now there are three assets: investment property, inventory, and operating fixed asset. So this is meant for the purpose of sale. This is meant for the purpose of sale. So when you convert this to inventory or operating fixed asset, fair value is relevant, and whatever the gain or loss is, that gain or loss will be routed through profit and loss account. Again, inventory is for the purpose of sale. If you want to convert this to investment property, again relevant value is fair value. Gain and loss will be routed through profit and loss account. But now, if you transferring operating fixed asset into investment property, this is not for the purpose of sale. First of all, relevant value is fair value. But now let us assume that there is a gain. Your carrying value was 1 crore, fair value is 1.5 crore. So in this particular case, gains will not be routed through P&L account. Gains will directly be adjusted into equity. If there is a loss, that loss will definitely be routed through P&L. But if there is a gain, that gain will directly be adjusted into equity. So now important, if owner occupied transfers to investment property, treat as revaluation. Now you are going to treat like a revaluation, and whatever the gains are, that gains would directly be adjusted into equity component. Now let's solve questions on this. Now, question number 33. Which of the following characteristics is most likely to differentiate investment property from operating assets? So on this you are going to earn rental income. 34. If the company uses fair value model to value investment property, changes in the fair value of the asset are least likely to affect. So now whatever the gains are, that gains will be routed through profit and loss account. Okay, so it's going to affect your net income and operating income, but it will not affect your OCI, other comprehensive income. Now question arises, what do you mean by OCI? So this we are going to cover in under income statements. There's a reading income statement. There we elaboratively understand what do you mean by OCI. But point to be noted, whether there's a gain or loss, that will be routed through P&L. That means it's going to impact your net income, EBIT, but what is not going to be impacted, that is OCI. 35th, investment property is most likely for the purpose of. Now student may mark option B as well. Now important, in case of investment property, the main objective is to earn rentals, and after some years you are going to book the capital appreciation. That means there the asset is not held for immediate resale. Yes, eventually you have to resell, eventually you have to book capital appreciation, but main purpose is to earn for some period rentals, and then there's a capital appreciation, then you're going to sell this property. Now which asset is held for resale only? That is inventories. And which assets will be used in the production of goods and services? That is going to be operating fixed assets. So investment property is most likely to earn rental income. 36. A company is most likely to use a fair value model for some investment property and a cost model from some property. Answer is incorrect. Consistent model has to be used. If you are using fair model, then for all the investment property, suppose you are having 5 properties, for all the 5 properties you are going to use the fair model, or if you want to use the cost, then for all the properties you are going to use the cost model only. Consistent. Second, a company is most likely to change from the fair value model when transactions on comparable property become less frequent. There is no such requirement under IFRS. So A is incorrect, B is incorrect. Now C, change from fair value model when the company transfers investment property to operating fixed assets. Now if you transfer your investment property to operating fixed asset, now in this particular case you are going to charge depreciation. Now you are not going to use fair value model. Now you have to change from fair value model to cost model, and on this operating fixed asset, now onwards you are going to charge the depreciation. So answer is C. 37. Under the revaluation model and the fair model for investment property, which one is correct? A, B, C. So now let's go with B. Net income is affected by all the changes in the fair value. Answer is incorrect. Now revaluation model. Under revaluation model, suppose you are having an operating fixed asset. If there is a gain, that gain will directly be adjusted into revaluation reserve. If there is a loss, that loss will be routed through P&L. In case of investment property, gain or loss, that will be routed through P&L. Net income is affected for all the changes. Answer is incorrect. under revaluation model, if there is a gain, that will be directly adjusted into equity without touching the net income. B is incorrect. C, net income is never affected. Again, C is incorrect. Now which one is the correct answer? That is option A. Fair value of the asset must be reliably computed. So answer is A. 37. Answer is A. 38. Under IFRS, what must be disclosed under the cost model? So under the cost model, you have to disclose the useful life and the depreciation method. What is not required, that is how you have determined the fair value, because this is not required. And again, reconciliation is not required. So answer is A. Again I repeat, 33, answer is B. 34, C. 35, A. 36, C. 37, A. And 38, A. Now I'm moving to my last concept, that is with respect to disclosures. Okay, so class, again I think that disclosures are not testable in your examination, okay, because they're going to be eventually lot many disclosures. Okay, so giving a rough reading would be more than sufficient. Okay, so these are disclosures that the company has to give in the annual report. So now let's try to learn, but again they are not important from the point of view of examination. So first I want to deal with IFRS. Under IFRS, you have to disclose the useful life of an asset, depreciation method use, then gross block values, accumulated depreciation, asset pledged as collateral. So if you have taken any loan from the bank, so asset pledged as collateral. If there is any impairment, you have to describe the circumstances which led to impairment. If there is any reversal of impairment charges, then again you have to explain the circumstances. Okay. If you are using a revaluation model, how you have computed fair value? So these are the disclosures that are required: useful life, depreciation method, gross block, accumulated depreciation, asset pledged as collateral, circumstances led to impairment, reversal of impairment, and eventually if you are using a revaluation model, how fair value is determined. So these are the disclosures. Now what is not required? Now not required is acquisition date. So when you have acquired the asset, that disclosure is not required. Okay, number one. Second, what is not required? If you are not using a revaluation model, that means you are using cost model, traditional model. So if you are not using revaluation model, disclosing fair value of asset is not required. So which two disclosures are not required? Acquisition date. And if you are using the cost model, then disclosing fair value is not required. So this is the case of IFRS. Now let's solve some problem on this. Disclosures. Question number 30. According to IFRS, what must be disclosed in except for, that is what is not disclosed in the financial statements. So disclosing useful life, mandatory. Amount of disposals, That means one more disclosure is required, that is sale proceeds from selling the assets. So sale proceeds, if you have sold any asset during the period, then disclosing that sale proceeds is again a requirement. So useful life, amount of disposals is required. What is not required, that is the acquisition date. Answer is B. Next, 31. According to IFRS, again exception. Now, amortization rate, that means depreciation rate, you have to disclose. Impairment loss, you have to disclose. But what is not required, that is going to be fair value. Okay, so in majority of the cases we are going to use the cost model. So again, disclosing fair value is not required. Okay, now I'm moving to the US GAAP's requirement. So more or less US GAAP is similar to IFRS. Okay, but one important point is that in case of US GAAP there is no impairment. So in case of US GAAP there is no reversal of impairment. So reversal is not permitted. So no disclosure on that. Since reversal is not permitted, then a disclosure is not required. Same wise, disclosing useful life. So what is the useful life is again not a requirement under US GAAP. But what is required, that is in case of intangible assets, amortization for upcoming 5 years. So this you have to disclose for upcoming 5 years, which management is anticipating. Now, based upon this, 32. Which of the following is required for intangibles under US GAAP? So reversal is not relevant because reversal is not allowed. Useful life is not required, but what is required, that is the estimated amortization expense for next 5 years. So class, I think this much is more than sufficient. Beyond this is not testable. Okay, so having a rough reading will be more than required. Okay, so now we have covered all the LOS. Okay, so again my objective is that your dependency on reference book should reduce. So thoroughly you have to revise page number 1 till page number 4. Okay, so I have covered all the LOS, and in the last part of the video I'm going to solve all the practice problems. Okay, so it's very important that you should try all the remaining ones. Okay, and the next part of the video is only to be used for the purpose of referencing. Okay, now if you are unable to solve question number, for example, if you are unable to solve question number 20, then you are going to jump to that particular part. So in the last part, I'm not going to discuss any new concept, no revision is there. Okay, thoroughly revise all the LOS and try to solve the remaining practice problem, and the last video will only be used for the purpose of referencing. Okay, thank you. Now friends, in this part I'm going to solve the remaining practice problem. Okay, so we have covered 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13, 14, 15, 16, 17, 18, now 19. An analyst in the finance department of a company is computing amortization of a customer list. Okay, she gathers the following information. So you have acquired at 23 lakh. Acquisition date is 1st January 2008 and residual value is 5 lakh. If the analyst use SLM method, the amount of accumulated means total depreciation related to the customer list as on 31st December 2009. Okay, so now 19th. So amount of amortization using SLM 23 lakh minus 5 lakh, and total life is expected to provide extra sales for 3 years. Divide by 3, that is 18 divide by 3, that is going to be 6 lakh every year. Now you want to compute the accumulated depreciation after 2 years. So you have acquired this customer list on 1st January 2008. Now you want to compute what is the total depreciation till 31st December 2009 for 2 years. So for 2 years, the accumulated depreciation is 6 lakh multiplied by 2. Answer is B, 12 lakh. 20. Acquisition cost is 58 lakh. Date is 1st January 2009. And the expiry date is 31st December 2015. Okay. Now, every year, so total production capacity is 175. And in the fiscal year 31st December 2009, you have manufactured 20,000 units. If you are using unit of production method, amortization expense for the patent for 2009, specifically for 2009. So you using unit of production method. So solution for 20, using unit of production method, amortization is equal to 58 lakh minus residual value is not given, so assume it to be 0. Divide by, in totality you're going to have the production of 175. So this is per unit cost. Multiply by, in 2009 you're going to manufacture 20,000. So answer is 58 lakh divided by 175 multiplied by 20,000. So answer is 662,857. Answer is B. 21. A company acquires a patent with expiry in 6 years for 100 million. The company will assume that the patent will generate economic benefits that will decline over time and decides to use DDP. Now you want to compute amortization expense specifically for year 4. So now I want to solve this using calculator. Okay, so second depreciation, we are using DDP method. Life is 6. It will start from the first year. Your cost is 100. Salvage value is 0. And now I want to compute for year 4. So my depreciation is 9.87 million. Answer is B. So directly with the help of calculator, your answer is 9.8765. Answer is B. Okay, now I'm moving to the next one. 28. So impairment of intangible with finite assets affects. So it first affects your balance sheet. You're going to reduce your assets, and then it affects your income statement as well, because you're going to charge the impairment into the depreciation component. Okay, so it affects both the balance sheet and your income statement. Answer is C. The gain and loss on a sale of asset to which revaluation model has been applied. Okay, so this revaluation is irrespective. How we compute gain and loss? So to compute, this is question number 29. To compute gain and loss, our formula is sale proceeds minus the carrying value. So answer is calculated using sale proceeds less the carrying amount. Answer is A. So a revaluation model is only given to only for the purpose of confusion. So answer is A. Now 39. Okay, so we have not covered yet the cash flow from operations. What do you mean by cash flow from operations? Okay, but using the elimination technique, I think I can eliminate A and C. Okay, so let's see. At the end of the year, company reported impairment loss, reducing its carrying amount by 10%. Now, which of the following is least likely? Okay, so first point, impairment is a non-cash expenditure. What do you mean by impairment? Impairment simply means you're charging additional depreciation. So impairment is a non-cash item. It is nowhere going to affect your cash flow. Okay, so clear-cut answer is B. But now I want to eliminate A and C. So option number A, debt to asset ratio to increase. Okay, so question number 39. Now debt to asset ratio, debt to asset. Now debt is constant, but you have reduced the value of your assets. You have charged an impairment. So debt to asset will increase. It is written debt to asset to increase. Yes, this is one of the impact. Least likely. Okay, so yes, it is one of the impact. Then fixed asset turnover ratio to increase. So now what do you mean by fixed asset turnover ratio? So this we will cover in ratios as well. So fixed asset turnover ratio formula is sales upon net fixed asset. Now let's first understand what is the interpretation of this. Now for example, there is an Ola driver. He generated a sales of 6 lakh and he has 6 lakh worth machinery. So what is fixed asset turnover ratio? 1. Now what is the meaning of fixed asset turnover ratio equal to 1? With the help of 1 rupee of asset, you are generating a sales of 1. With the help of 1 rupee of asset, fixed asset, you are generating a sales of 1. So this basically talks about efficiency. Now there is another one more Ola driver. He generates a sale of 12 lakh with the same car. So his fixed asset turnover ratio is 2. What is the meaning of 2? With the help of 1 rupee of fixed asset, you are able to generate a sales of 2. Now which driver is more efficient? Higher the fixed asset turnover ratio, that signifies more efficient you are. Okay, now what happened? Now your sales is constant. Your fixed asset turnover, your net fixed asset has reduced. As a result of which fixed asset turnover ratio will increase. So yes, because of impairment, debt to asset will increase, fixed asset turnover ratio will increase. But what is least likely, that is the cash flow from operations to decline. So important point, impairment is a non-cash. It is simply charging additional depreciation. So it is nowhere going to impact your cash flows. Answer is B. Now question number 40. The most appropriate treatment for intangible with infinite life, example goodwill, is to capitalize them and not to charge any amortization. Answer is B. So intangibles with finite, we are going to capitalize and charge an amortization. But if the life is infinity, then there are going to be no amortization. Answer is B. 41. Now 41, mathematically we can solve after cash flow statements. Okay, but still with the help of limited knowledge, I try to solve question 41 as well. If a company capitalizes an expenditure, okay, the company will most likely report a, okay, so point to be noted. Now if you are capitalizing, okay, instead of expensing, so what you are doing, you are first creating an asset. You're first creating an asset and then you're charging depreciation over it instead of directly transfer to your profit and loss account. So point number 1, it will impact your profitability. Definitely it will impact your profitability, but it is nowhere going to impact your cash flows. So this mathematically we will learn in cash flow statement. So it is nowhere going to impact your cash flow statements. Okay, now a company will report lower cash flow, incorrect. company will report higher earnings in the future period. Higher earnings in the future period. No, in the future period your expenses are higher on account of depreciation, so your earnings would be lower. A is incorrect, C is incorrect. Now answer is B. But how, sir, you have computed that the correct answer is B? This we will elaboratively learn in the reading cash flow statement. Okay, so as of now, if you want to skip 41, that is perfectly alright. Or using elimination technique, we can find out, yes, the answer is going to be B. A is incorrect, C is incorrect. Okay, proceeding further. Now you have to compute fixed asset turnover ratio. So just right now we learn what is the formula. So formula is sales, which is a P&L item, divided by average net block, net asset, net fixed assets. Now sales is 2167670, and since it is a balance sheet item, we are always going to take average, and the average is 12,200. So if I solve, my answer is 1.77. Answer is A. Answer is A. Next, 44. So now in 44 again you're going to make one mistake. Number one, we only capitalize interest, we don't capitalize dividends. First point. Okay, only capitalization of interest during the construction period. Second, whatever the rate is given, that rate would always be, by default, these rates are always going to be per annum. Okay, so now let's go through question number 44. Company prepares its financial statements in accordance with IFRS and finance for the construction of new plant. The company borrowed this much at a rate of interest of 8%, issued 5 million of preference shares with a cumulative dividend of 6%. So this particular line is irrelevant. Okay. And temporarily invested 2 million on the loan proceeds during the first 6 months on the construction and earned 7% on that amount. Now 7% per annum on that amount. If the question is silent, that is always going to be per annum. Now you have to compute the amount of financing to be capitalized. So we only capitalize first of all net interest. So question number 44. During construction, how much interest you have to pay? Interest expense during construction. So that is going to be 5 million into 8%, and the construction continues for okay, so for the first year. Okay, so this is for the entire first year. How much interest I have to pay? That is 0.4 million. Interest earned by temporarily reinvesting the proceeds. So you reinvested 2 million at the rate 7% for 6 months. So for 6 months, this is going to be the return. That is 0.07 million. Now how much interest to be capitalized? Net interest expense to be capitalized. 0.4 minus 0.07. Answer is 0.33 million. So answer is 0.33 million is multiplied by 10 raised to the power 6. So if you want to convert this to multiply by 10 raised to the power 6, so answer is 3,30,000. Answer is C. Then 45th. A company is selling a long-lived asset with a carrying value 70,000 for 80. Okay. Now only this much data is important. Now what is going to be the gain in the year of sale? So sale proceeds minus the carrying value, 80,000 minus 70,000, that is a gain of 10,000. Answer is A. 46. Two pharmaceutical companies A and B develops drugs and drug analytics software. Company A report in accordance with IFRS, B in accordance with US GAAP. Which of the following statement with respect to development cost is correct? So 46. Now IFRS, under IFRS development cost always capitalize. US GAAP development cost charged to P&L. Exception is only software. Software will capitalize. Okay. Now company A can capitalize the development cost related to the software if it meets the criteria. Yes, this is one of the correct statement. Now company B can capitalize the development cost related to the drug development, not with respect to the software, related to the drug development if it meets the condition. Answer is incorrect. Under US GAAP, you cannot capitalize the development cost until unless it is for software. So they're not talking about the software, they're talking about the drugs. So B is incorrect. Both companies must expense all the development costs related to the intangibles. Answer is, this is also incorrect. So which is the correct statement? That is answer A. Company A can capitalize the development cost with respect to the software. Yes, they can with respect to the software if it is meeting the criteria. So under IFRS, whichever development it is, if this development is basically after, if the technical viability has been proven, if you're incurring that, then yes, you can capitalize it. So answer is A. Under US GAAP, it is not allowed to capitalize development except for the software. So they're talking about the drug development, not with respect to software. So answer is A. 47. The company will experience highest asset turnover ratio in which year? Okay, so 47. So now fixed asset turnover ratio is equal to sales upon fixed assets, net fixed asset. That means post deducting the depreciation. Now you want this ratio to be highest. If this is highest, that means net fixed asset to be lowest, and net fixed asset to be lowest, that means depreciation to be highest. Now to compute depreciation, there are three methods: DDP, SLM, unit of production method. Answer under DDP in comparison to SLM in the first year is always going to be higher in the initial years. So they're basically talking about first year. So either the answer is DDP or answer is unit of production method. Okay. Now useful life is 3. You're going to produce 800 total. In the first year 300, and you have purchased for 5 million. So using unit of production method, what is the depreciation for first year? Or what is the amortization for first year? Amortization year 1 is equal to 5 million divided by 800 multiplied by 300. So 5 million divided by 800 multiplied by 300. So this is 1.875 million. Using DDP, amortization for year 1, that is 2 upon life. Life is 3 multiplied by at which you have purchased, that is 5 million. So answer is 5 divided by 3 multiplied by 2, 3.33 million. So under which method the depreciation is highest? So highest depreciation is under DDP. So if you want to compute under SLM, that is 5 million minus 0 upon 3. So answer is 1.67 million. So answer is DDP. Answer is A. Next, our analyst is reviewing plant property plant equipment disclosures, the company uses RFRS, which one would be least likely? So carrying amount, how the fair value is obtained, this you have to disclose if you are using revaluation. So this is one of the disclosure, but one disclosure is not required. That one disclosure that is not required, that is the acquisition date. So answer is C. 49th, a company owns its head office that it purchased in 2011 for 1 million. The real estate market has been volatile and it uses revaluation. That means you're going to report this building at fair value. Following table shows the market value since 2011. Net impact in 2014 will most likely be an increase of, okay. So now you purchase this for 1 million, okay. Question 49. So in 2011, 1 million. In 2012, value declines to 6.6 million. Okay, so if value decreases to 0.6 million, that how much loss you have booked? Loss you have booked 0.4 million through your profit and loss account. 2013, value is 800, that is 0.8. Now you are going to book a gain of 0.2 million, and this 0.2 million will be routed through P&L because already you have charged a loss. Now if there is any reversal, that reversal would be charged through P&L account, okay. And now in 2014, the value is 1.3 million, okay. So again 0.2 million gain will be routed through P&L. So now again you are back to 1 million. So you have charged a loss of 0.4 million through P&L. You have booked a gain of in totality maximum 0.4 million through P&L. Now still you are left with, so 0.8, it increases to 1.3. That means in totality the gain is of 0.5 million. But out of 0.5 million, 0.2 million will be routed through P&L. 0.2 will be routed through P&L and 0.3 will be routed through revaluation reserve. Okay, now you have to answer. So the net impact on 2014 net income will most likely be, so in the income, what is the which is going to affect net income? So your net income will increase by 0.2 million. Answer is A. So now again I repeat the concept. Under revaluation, you are always going to show asset at their fair value. Now if there are losses, that losses would be booked through P&L. And if there is any subsequent recovery of the losses, then that losses maximum to the tune of losses that you have booked, the reversal would be through P&L. So in this particular case, I charged a loss of 0.4. Maximum reversal with the help of P&L, that is going to be 0.4 only. 0.2 you have already recovered in 2013. In 2014, again a recovery of 0.2. And balance increase over and above the historical cost that will be routed through revaluation reserve. So in totality, a gain of 0.5 million, 0.2 routed through P&L, 0.3 will be directly adjusted into equity. Answer is A. Now 52 you have to skip. This we are going to complete covered after completion of reading income taxes. So I'm not solving 52. Next 54. 2015 opening carrying amount of the companies with finite life is closest. Okay, so with the finite life. Now important, group 1 has 0 amortization. Group 4 has 0 amortization. So group 4 has 0 amortization. That means these are the intangibles with infinite life. So we have to ignore group 1. We have to ignore group 1 and group 4. Why? Because amortization is 0. Amortization 0 means they are infinite. They are the intangibles with the infinite life. Now I'm left with group 2 and group 3. Now this is your gross block. So gross block opening value is 320 and 118. But you have to compute opening carrying amount. Okay, so question number 54, opening gross block. Opening gross block of finite assets, of finite intangible assets, is equal to 320 plus 118, that is 834. Okay, but the accumulated depreciation opening value, is that is 45 plus 16, so answer is 61. Now carrying value is equal to 438 minus 61 equal to 377. So answer is A. Important, ignored group 1, group 4 because they are infinite lives, they are the intangibles with infinite. Now you have to compute carrying value. Carrying value is nothing but gross block minus accumulated depreciation. Answer is A. 55. A company purchased a warehouse for 35 million and incurred the following additional cost: 0.2 million for upgrading to the building's roof windows, 0.5 to modify the interior, 0.1 for training sessions to familiarize employees with the facility. So this is the training one. Now the total cost to be capitalized, we are going to consider all the costs except repair, maintenance and training. Okay, so the first two one are not the repair, maintenance, that you're making an improvement in the asset. So how much I'm going to capitalize? 35 plus 2 plus 0.5. Answer is 37.5. I'm going to ignore 0.1 because it is on account of training. So 0.5 was incurred to modify the interiors, okay, so meet their requirements, ready for use. So this is incurred to make the asset ready for use. Yes, consider. 2 million is incurred for the building's roof and windows, again to make the asset ready for use. But 0.1 is not incurring for making asset ready to use, so I'm going to ignore that. That will be transferred to your P&L. Answer is B. Now, holding all else constant, a company develops intangibles rather than purchasing, will most likely, okay, so 56 will be covered. Okay, just try whether I can solve holding all other. Okay, so class 56 to be covered after cash flow statement. So 56 I'm not solving. Now 58, unit of the production method, you have to compute amortization for year 2014. Okay, so acquisition cost is this much, plant capacity is 50,000. So your expected production is, how much you are going to produce is 2 lakh, and in 2014 you are anticipating 30,000. So what is going to be the amortization? That is 265,000 divided by 2 lakh. This is how much you are anticipating to produce, multiplied by 30,000. So answer is 397,500. 397,500. Correct answer is B. Next, 59. New showroom construction started and opening is on 1st January 2014. That means under 2 years the building is under construction. So we are going to capitalize the interest cost. Loan provided, that is 30 million. Interest on the loan is 8% payable annually. Repayment is balloon payment on 1st January 2017. Okay, so question number 59. Now 2 years the showroom would be under construction. and you have borrowed the money on 1st January 2012. The amount borrowed is 30 million at 8% interest payable annually. So now what is the meaning of this? So my interest is 2.4 million. So every year I'm going to pay 2.4 million to the bank, and eventually on the last date, that is 31st December 2016, I'm going to repay 2.4 plus I'm going to repay the principal, that is 30 million. So repayment is in the form of bonds, similar to bonds. Okay. Now total construction cost incurred is 38.5, life is 40, residual value is 5. You're using straight line. Now you want to compute amortization. You want to compute the depreciation expense for the showroom in 2014. So already how much you have incurred? Already you have incurred 38.5. Now I'm going to capitalize interest as well. Capitalize interest for 2 years. That is equal to 2.4, that is 4.8. So total capitalization is 38.5 plus 4.8, that is 43.3. Now this is the total capitalization. Now residual value is 5 million, life is 40. You have to compute depreciation. So 43.3 minus 5 divided by 40. Answer is 0.9575. Answer is B. So 59, answer is B. Now 61. So following are taken from the notes of the company's financial statement that are prepared in accordance with IFRS. Figures are in Australian dollar. During 2014, company disposed of broadcast license that was held for sale for 37,900 Australian dollar. Net book value 23,500. Based upon successful completion of that sale, the impairment losses taken in 2012 have been reversed. Okay, and now broadcast license are amortized over a period of 15 to 25 years. The note leads an analyst to believe that the rapid reversal of the impairment losses was an attempt to manage the earnings, that means to show inflated earnings. If the analyst's belief is correct, her analysis of the original 2013 financial statement would most likely have. Okay, so now what's happening here? So there's a company, and the company has charged impairment over license in 2013, in 2012. So there was an impairment, and in 2014 there's a reversal of impairment charges. Okay, so now when you're analyzing 2013 statements, what will impact? Okay, so in 2012 you have charged a impairment. Okay, so now in 2012 if you charged an impairment, that means you have reduced the asset values. Okay, you have increased your depreciation, and accordingly your equity has reduced. So this happened in year 2012. Okay, now what is going to be in 2013? Now company will understate ROA of 2013. Okay, so now in 2012 already your assets values has been reduced. Okay, your asset value have already been reduced. Okay, now in 2013 what will happen? So if asset is already been reduced, so in 2013 you're going to charge lower amortization because the intangibles have already been amortized. So now in 2013 amortization is going to be lower. Okay, as a result your profits are going to be higher, and thus ROE is going to be ROA or ROE is going to be higher. So first option is understated of ROA, incorrect, overstated. Now in 2013, since already in 2012 you are charging impairment, now in 13 amortization would be lower. That means your ROA is going to be overstated. Now understated of fixed asset turnover ratio. Okay, so now asset values have already been reduced. So in 13 again they are going to be reduced, they are going to remain at lower level. Now if I compute fixed asset turnover ratio, sales fixed asset, now sales upon net fixed assets, so these are lower. If this figure is lower, accordingly your fixed asset turnover ratio in 2013 is going to be higher. So second is understated of fixed asset turnover ratio, B is incorrect. Third is overstated of net profit margin. Now what is net profit margin? This you will learn in the chapter ratios, but again, what is net profit margin? That is EAT upon sales. Now my point is, since asset is already been amortized, okay, since asset has already been impaired, now in 2013 you are going to charge lower amortization. Lower amortization will lead to higher profits, and higher profits will eventually overstate your net profit margins. So which option is correct? Correct is option C. So now what will happen in 2013? You are going to report higher ROA, you are going to report higher fixed asset turnover ratio, and you are going to report higher net profit margin. So answer is C. Answer is C. Next, the following information is for a company that prepared in accordance with US GAAP. Net book value, means net carrying value, is 28.4. Recently, several other companies have entered the market, and now company estimates it will able to generate only 3 million per year for the next 7 years. Cost of capital is 10. You have to find out the impairment charges. Okay, so 62, impairment under US GAAP. 62, step number 1. If carrying value is greater than undiscounted future cash flows. So my carrying value is 28.4. If this value is greater than undiscounted cash flows, you are going to generate 3 million for 7 years. That is 21. Yes, this is the case. There is a need for impairment. Now while impaired, you are going to report your fixed assets at fair value, and whatever the difference between fair value and carrying value, that is going to be your impairment charges. Now first you have to compute fair value. Now what do you mean by fair value of anything? This is going, and in this case fair value is not given, okay, but fair value of any asset is nothing but future cash flows it's going to generate, discount by the required rate of return. Now in my case, in the future, I'm going to generate cash flows of 3 million for upcoming 7 years, and my required rate of return is 10%. Now what is the fair value of these cash flows? So now second, clear TVM, 3 is going to be PMT, 7 is going to be N, 10 is going to be I by Y, compute PV. So fair value of these cash flow is 14.605. Carrying value is 28.4. Now what is an impairment loss? So impairment loss is equal to 43 million. Now impairment loss, I made a mistake. Impairment loss is equal to 13.8. Now option A, B, C. Yes, option is A, impairment loss of 13.8 on the income statement. we will reduce our assets by 13.8. We will increase our expenses by 13.8. So B is incorrect. C, anyways, I don't want to comment anything on the cash flows. So answer is A. 63. Customer list expects to provide benefits for 2 years. Okay, license for 2 years but can be renewed at no cost and will have a life of infinity. Trademark 2 years can be renewed and can sell. Company plans to sell for the infinite. Foreseeable future means for infinity. Now, which of the following is most likely to be amortized? So license is more or less as an infinite life. Trademark infinite life. Customer list is having a life of 2 years only. Okay, so now answer is A. Now the customer list expect to provide benefit for 2 years, expects to sell the product to the customer for foreseeable future. So it is only providing the benefit for 2 years. Trademark expires in 2 years but can be renewed. Okay, so here it can be renewed, so it will keep on providing the benefits, but here the benefits is only for 2 years. So which I'm going to amortize, that is the customer list. Now 64. At the end of the year, company revalues its manufacturing facility, increasing the carrying amount by 12%. Now upward revaluation. Okay, there have not been prior downward revaluation. What would be the impact of revaluation? So whenever we are going to revalue, upward revaluation. So in case of upward revaluation, what will happen? Your asset value will increase, equity value will increase, but no impact over your profit and loss account. Okay. Now return on asset to increase, answer is incorrect. Return on asset will reduce. Why reduce? Profits constant, asset has increased. Return on equity to decline, the answer is yes. Again, profits are same, equity has increased, because of which ROE will reduce. Answer is B. Net profit margin will remain constant. So 64, answer is B. Now 65. A technology company reporting under US GAAP, 3 classes of intangible. So they have provided you with accumulated impairment loss and amortization schedule, based upon which you have to find out which one is having the highest absolute impairment charges. Okay, so now let's find out for goodwill first. So goodwill opening amortization was 65,000 and account of some exchange movement additional is 7324. Now what are these exchange movements? This eventually you will learn in level 2. Okay, so simply because of this exchange movements, your amortization has increased 65 and now 7324. But finally your total amortization is coming out to be 73194. Okay, so that means how much goodwill has been impaired? So 65. Your closing amortization is 73194 and opening value was 65,321. This is opening. Then on exchange, some account on account of some exchange movements, so your amortization has increased 7324, and finally you have impaired. So impairment is going to be X during the period. Now you have to find out X. X is going to be balancing figure. 65321 plus 7324 plus X is equal to 73194. So X is equal to 73194 minus 65321 minus 7324. Answer is 549. So in case of goodwill, the impairment is 549 during the period. Then license. So license Now how to find out? This is in case of goodwill. So now in case of license, X is equal to, what is your closing value? Closing value is 10,856 minus 8243 minus 821 minus 1244 plus 45. Okay, so I want to find out this balancing figure. Okay, so now my balancing figure is going to be, in case of license, 10856 minus 8243 minus 821 minus 1244 plus 25. So this is 573. So license is having more amortization. And finally for software, so X is equal to 8214 minus 5257 minus 334 minus 2102. So answer is 521. Now which one is having the highest amortization? That is in case of license. So simply you have to find out the balancing figure. So balancing figure is highest in case of license. 66. In early 2015, there's a news release that a company, an analyst sees a news report that he follows, which reports under US GAAP, will be forced to reduce output from one of its major product line, as it is highly specialized ceramic plant, in response to new technology introduced by its competitor. That means there's a hint that you have to charge an impairment. The table summarizes, okay, and now you have to find out the depreciation that should be reported for 2015. Okay, so now this table is for 2014. So there's a hint that in 2014 you have to charge impairment, and post impairment you have to find out what should be the depreciation for year 2015. So 66. First let's find out the impairment in 2014. So impairment charges for year 2014. Now carrying amount is under US GAAP. If carrying amount is greater than undiscounted cash flows, undiscounted future cash flows, carrying amount is 1604 greater than 1350. Yes, this is a case. That means there is going to be impairment. Now if impairment is there, now what is going to be the impairment? You have to show asset at its fair value. So they have provided you with fair value of plant, that is 1225. Now fair value of plant is 1225. So now we will show the asset at 1225. Okay, carrying value is equal to 1604. So what is going to be the impairment charges? Impairment charges is 1604 minus 1225, that is 379. So by this you are going to impair the asset, and now asset will be shown at 1225 in 2014. Okay, now your revised useful life is 4 years. You are depreciating using SLM. Salvage value is 200. You have to find out depreciation for 2015. So now depreciation for 2015 is equal to 1225 minus 200 divided by 4. So answer is 256.25. So answer is C. Now important, in one of the previous example that we have solved, in one of the practice problem, they have not provided you with fair value. So how we computed the fair value? Simply we discount the future cash flows. Okay, but in this case PV is also given and fair value is also given. So if fair value is specifically given, then we are going to use that particular value. And in case fair value is not given, then we are going to compute it by discounting the cash flows. Okay, so in this case fair value is given, so I'm going to ignore PV of expected future cash flows. But hadn't been PV, fair value is not given, then fair value is going to be computed by discounting the future cash flows. Okay, so my answer is C. 67. A company decides to exchange a truck it purchased 3 years earlier for a piece of land. Okay, a company that acquires the truck will most likely record its purchases at, now 67. So there's an exchange. Now you are exchanging, in this question you're selling land and purchasing truck. So now important, the company that acquires the truck, that means it is purchasing the truck and selling the land. Now if you're selling the land, ideally what should be the sale proceeds to compute your gain or loss? So while selling the land, your sales proceeds should be equal to, we are going to deem the sales proceeds equal to fair value of the asset. Now in this case, fair value of the asset is given that unable to estimate. Okay, if I'm unable to estimate, then I have acquired truck. Now what is the truck fair value? So fair value of truck is equal to 20,000. Now what is going to be the price at which truck will be, the company that acquires the truck will most likely record its purchase price as, first it should be equal to fair value of land. But fair value of land we are unable to compute because we are selling land and buying truck. So fair value of land we are unable to compute. Now if it is, we are unable to compute, then it is equal to fair value of truck, that is equal to 20,000. Now for example, I'm selling you CFA coaching classes, and in return you are having a tire shop and you provide me with some tires for my car. So from my point of view, what is my sale? Hadn't been I'm selling this to an independent student from whom I'm not buying anything, then my price is 30,000. So I'm going to record this tire at a price 30,000. So I'm giving you a service of 30 and in return I'm buying this. So from my point of view, the value of tire is 30, but it is given that the fair value of CFA coaching is not given. Then whatever the fair value of tire is, I'm going to record my purchases at this particular price. So answer is A. Next, 68, it is to be solved after cash flow statement. 69, to be solved after cash flow statements. Now 70, a company prepares its financial statements in accordance with IFRS, uses the revaluation model. At the end of the current year, the value of the land newly acquired this year has been increased and will be adjusted on the balance sheet. The land is the only asset. Which of the following is most accurate? Now there is an upward revaluation. As a result of upward revaluation, what will happen? Your assets will increase, equity will increase. So debt upon equity, debt upon asset, these both will increase. So debt upon equity, debt upon asset, both will reduce. So answer is B. 71. A company debt covenant, that means a debt requirement, debt restriction, is to maintain an interest coverage ratio of 2.25. Okay, so now what is the formula for interest cover? This we will learn again in the ratios chapter, but let's try to solve with the help of limited knowledge. Now interest coverage ratio is equal to EBIT upon interest. Now if this ratio is 7x, so what is the meaning of this? If you have to pay interest of 1 rupee to the bank before this particular expenditure, you're earning 7x, you're earning 7 rupees. That means your earnings is 7 times of your expense, of your interest expense. Now from the banker point of view, higher the interest coverage ratio, better it is. That means banker is more secured. So if you have to pay 1 rupee to the bank, you are earning 7. Now what is the denominator? The denominator is EBIT upon actual interest to be paid to bank. Okay. And what is EBIT? This EBIT should not include any interest. Should not include any interest component. So this is the formula. EBIT upon interest. Now EBIT, the profit before interest and tax. So while computing this profit, no interest to be subtracted, and the denominator is interest. Interest means actual interest that you have to pay to the bank. Now 71. So this is your profit and loss account, and company depreciation expense for 2014 is 388, and this includes capitalized interest of 34. Okay, so this includes capitalized interest of 34. Okay, interest is allocated and capitalized by applying capitalized to construction in progress by applying the firm's cost of borrowing rate to qualifying assets, and interest capitalized in 2014 is 66. Now what is given in note 11? During the period you have capitalized interest of $66. That means instead of charging it to P&L, you have created a asset. You have included in a asset which was under construction. Okay. So this component is included in the asset component, and your depreciation includes interest component of $34. Okay, so now EBIT, in EBIT none of the interest to be subtracted, and your denominator should be actual interest to be paid to the bank. Okay, now I want to compute my interest coverage ratio. Interest coverage ratio is equal to EBIT upon interest to be actually paid to the bank. Okay, now first let's compute denominator. Now in your P&L, interest is 122, but one interest you have capitalized, that is 66. So how much you have to pay effectively or in totality during the period? 122 plus 66. This interest has been capitalized. How much you have to effectively pay? 122 plus 66. Now you have to compute your EBIT, earnings before interest and tax. That is 11159 minus 9898 and minus 872. So this is your EBIT. Okay, so now what is my EBIT? Sales minus COGS minus selling and administration expense. Now in this selling and admin expense or COGS, depreciation is already included. Now you have deducted depreciation as well, and that depreciation which is already included here, that is of 388, and in this 388 one interest component is included, that is 34. So in totality, let us assume that depreciation is included in selling. So already you have deducted the depreciation. The depreciation includes interest of 34. EBIT is the profits. It's the adjusted EBIT is the profits, which should not include any of the interest component. Profits before interest and taxation. So this 34 is already deducted in the form of depreciation. I'm going to add back. So this is known as adjusted EBIT from the point of view of analyst. Now, or from the point of view of banker. 11159 minus 9898 minus 872. This was your EBITDA. But this EBITDA, in this EBITDA you have already subtracted 34. Add back 34. And now my total interest is 188. Your revised interest cover ratio is equal to 2.25. Now what was your restriction? You have to maintain an interest cover of 2.225. Your answer is 2.25. Now option A, B, C. You have failed to meet it, exceeded it, or just satisfied it. So you are meeting the requirement of the bank. The requirement of the bank was to maintain interest cover of 2.25, and eventually answer is 2.25. Why I added 66 here? Because this you have capitalized. In totality, 188 is the interest that you have paid. And why 34 has been added here? Because in the form of depreciation, this interest is subtracted. So I want a pure EBIT. So add 34 to the numerator and 66 to the denominator. Next, 72. Which of the following is least affected by the estimate life of the asset? So now in the formula of DDB and SLM, we use life, but in case of unit production method, life is nowhere used. So answer is C. Then 73. A company reports in accordance with IFRS does not use the cost model to values investment properties, plant and equipment following in the information. That means you're going to report at fair value. Okay. Now the impact on the net income will be a gain of, now investment property, a gain of 100. This gain will be routed through P&L. But in case of plant and machinery, a gain of 200. This 200 will directly be added to your equity. So the impact on the net income, there's a gain of 100 rupee only. So investment property gain will be routed through P&L, and plant revaluation gain will directly be adjusted into equity component. Answer is A. Then under IFRS, impairment loss. So carrying amount, if carrying amount is greater than, so so this is irrelevant data. Now recoverable amount is NRV, that is 104. Recoverable amount is NRV or PV, whichever is greater. So NRV is going to be 104. 132, if greater than 104, there's an impairment. And what is going to be the impairment charges? So 74. If carrying value is greater than recoverable amount, there's an impairment. Now what is recoverable amount? NRV, net realizable value. Net realizable value is 104, or value in use, that is PV of future cash flows, that is 100, whichever is higher. So recoverable amount is 104. Carrying value is 132, greater than 104, impairment, yes. Now what are going to be the impairment charges? Impairment charges is equal to 28. Answer is C. Next, accordance with IFRS, you have to compute impairment charges. Again, you have to compute NRV. So NRV is going to be 480 minus 50,000. That 480 minus 50,000. This is 4,30,000. Compare this with value in use, whichever is greater. Value in use is greater, 440. Now compare this with carrying value. So these two values. So impairment is going to be of 60,000. Answer is C. 76. Company prepares in accordance with IFRS, owns several investment properties on which it earns rental income. It values the property using fair value model. After 2 years of increase, the values decline. Summary is provided. Okay. So now you purchase this for itna, and the fair value is 50.5, 54.5, and then 48. What would be the impact of revaluation on 2014 financial statements. So this loss will be charged to your income statement. So what is the loss? You are having a property of 54.5 that has been reduced to 48. Now 6.5 would be charged to your income statement. Answer is C. Next, 77. The following information is available for a company that has one type of capital assets, remaining beginning net book value, revenue, and annual EBITDA. If during the year the estimated useful life of the asset is reduced from 6 to 4, that means now you're changing your estimates. Earlier you're assuming that the asset will be used for 6, now for 4. The company using SLM, the change in estimate will most likely results in, okay, now you're reducing the life. If you're reducing the life, the amount of depreciation will increase. If amount of depreciation will increase, your operating profit margin. So what is operating profit margin? That is operating profit margin, that is EBIT upon sales. Now you're charging higher depreciation, EBIT will reduce, so as a result margin will reduce. So A is incorrect. Operating return on asset. So operating return on asset is equal to EBIT upon total assets. Now again your profits are reducing, then operating return will reduce. Total asset turnover ratio or fixed asset turnover ratio. So this is going to be, now total asset turnover ratio is equal to sales upon total asset is equal to sales, where one of the asset is net fixed assets plus current assets. Now this value you're charging, you're going to reduce life, that means you're going to charge higher depreciation. So this value will now significantly reduce. If this value is significantly reduced, your asset turnover ratio is going to be higher. Answer is C. So need not to solve mathematically, simply by applying the logic, answer is C. 78. Under IFRS, reversal of impairment charges are allowed? Yes, it is allowed for previously recognized impairment losses only. Okay. Now 79. De-recognition of a long-lived asset other than sale most likely involves. Now 79. So if you want to remove your fixed assets, there are 3 ways. Number 1, sell off the asset, receive cash and incur gain or loss. Second is to exchange for some another assets. Okay, and third one is the asset is retired or abandoned. Okay, so these are the 3 ways. Now other than sell. So now I'm left with 2 options. Either it's going to be an exchange or retired. Now option A, spinning off a portion of assets from a cash generating unit of a company. So now here we are not talking about a single asset. Here we are talking about a division. Now what do you mean by cash generating unit of a company? That means in this we are talking about selling off the entire division. So what is going to be the accounting treatment for this? This we are going to learn in level 2. But again here we are not talking about a single asset. We are talking about group of assets. So A is incorrect. Removing the carrying value of the asset given up. Add a fair value of the asset acquired if an asset is exchanged, and reporting any difference in values as gain or loss. So B is correct. B is going to be an exchange. And now option C, recording cash proceeds if an asset is retired or abandoned. Now when an asset is retired or abandoned, we don't receive any sort of cash. So which is the correct answer? The correct answer is B. Now there are 3 ways in which assets can be removed with the help of sale, exchange and abandon. Now when it is retired, we don't receive any cash. When there's a sale, we receive cash, and we report gain and loss. And when it is exchanged, we remove the old car from the books, record the new car, and whatever the difference is in the carrying value and the fair value of the old car, we are going to book gain and losses. So correct is B. Now 80. So the annual report of the company, 31st December 2003. Okay, it's a technological company. And now you have to report the carrying value of the license as on 31st December 2003. So 80. Now what do you mean by carrying value? That is gross block minus accumulated depreciation. This is going to be net block or carrying value as on 31st December 2003. Now accumulated depreciation is given. So accumulated depreciation schedule. So starting with 31st December 2002, and now you have to find out the ending value. So this is the value at the beginning. Now this happened during the year. So if I add up all these transactions, so what is the accumulated depreciation by the end of the year? 2142 plus 212 plus 752 plus 52 minus 7. So their summation is 3151. Now sir, why you have added, why you have subtracted? So this I don't know. Simply whatever the schedule is given, so mathematically you have to add up all the figures. If it is negative, you have to subtract. If it is a positive, you have to add up. Okay. Now opening value was 2142. Now what is the ending value? That is 3151. Now I just need the gross block. That means the total cost as on 31st December 2003. So now the cost as on 31st December 2003 is 16,435. So what is the what is the carrying value? So carrying value is 13284. So answer is B. Now holding all else constant, a company reports patent through external purchases other than developing. So it is dependent upon cash flows. This we will cover post reading cash flow statements. So 81 I'm not solving. 82, for a company that prepares under IFRS, which of the following is most likely that it could report using fair value? So investment properties are reported using fair value. Investment property means which are held for the purpose of earning rental incomes. A, B, C. So in B, this is a building and this has been leased out. So this is for the purpose of earning rentals. So yes, this is termed as investment property. Investment properties are shown at fair value. So friends, with this we have covered all our questions. Okay, so I try my level best to elaboratively cover all the concepts and solve all the practice problem. Now question is, why sir you are putting so much of efforts? Okay, so IFRS, financial reporting analysis is one section of the examination where students struggles a lot. Okay, so for this particular, I don't want to take any risk. I'm going to explain every concept very elaboratively and we are going to solve all the practice problem. It's very imperative, it's very important that from today onwards you are going to solve all the practice problem. So only 2 units students find it difficult. One is FRA, second is fixed income, where many calculations are involved. Okay, plus all my upcoming units, that is equity, derivatives, alternatives or fixed income, are usually dependent upon FRA. So it's very important we have a good grip over the concepts, particularly with respect to FRA.